future. So you don't lose sight of them when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Stocks a little bit lower here. Not a huge deal just yet, but some fade from a short-lived pop overnight as the NASDAQ at one point traded close to about 15,200. We're now about 200 points away from that. A little change, though, for the Russell, the S&P 500. I'm watching the small caps really closely today as they were pushed back down below 2,100, the Russell 2000. That was the floor for that index for about a year straight before this sell-off since the end of last year. So watching a test of an important level for those small caps, and then for the NASDAQ, seeing how strong this 15,000 area holds. Big jump in the dollar from earlier this morning. The greenback is firming up. So watching that closely too after inflation figures were in line with expectations, but still quite elevated and causing problems for the economy, as we just heard from Liz Ann Saunders. Let's bring in Jeff Pierce. He's our stock guy today as we talk some analyst notes out for the most part, but Walgreens earnings too. You know, Jeff, CVS has been beating the heck out of Walgreens competitively and as a stock. Obviously, the health insurance part of the CVS trade has been very compelling. Walgreens has just kind of been more a struggling retail trade, but it seems like there's some fresh concern after this report. Down 6%, and it's now back down to its 52-week lows. How come?
Well, some of that concern could be because Walgreens is really trying to transition to compete with CVS. I mean, if we look at the report itself, beat on earnings per share, $1.59 versus $1.38 expected. That's up 26% year over year. Sales beat as well, 33.8 versus the 33.3 billion that was expected, up just about 3% year over year. Comp sales up 14.7%. That's the largest gain they've seen in 20 years in the U.S. UK comp sales up 22%. And the company said they saw growth across all of their categories, especially the health and wellness items. On the vaccine side, they issued about 11.8 million COVID vaccinations. That brings them up to about 62.8 million to date, about 6.6 million in tests this quarter. There's also some question of whether or not they'll see more benefit from the FDA approval of a fourth COVID shot for ages 50 and over. On the outlook side, and this may have been part of the disappointment, they really just reiterated their outlook for 2022, low single-digit growth on adjusted earnings per share. And we know the company, as I mentioned earlier, is kind of transitioning, right? They've been working. They took a majority ownership of VillageMD. That's part of their efforts to kind of put these primary care clinics in their stores that could help them compete with companies like CVS.
There you go.
And they're also looking at what they want to do with their boots business in the UK.
Yeah, and that one, we've heard some rumors potentially of getting spun off, but right now still going into the bottom line figures here. And the vaccinations and the COVID visits are dominating. It looks like the market's main analysis of this company right now, that they may not be able to keep up same store sales of 15%. I mean, this is a stock that would have died for that 3 years ago when the shares were just cratering. So it seems like it's a pretty compelling bearish point that there's a better way to trade this group, and it's CVS, and it doesn't have the same type of reliance so much on the foot traffic that COVID brought for these stores.
Well, that reliance on the foot traffic is a great point. It's something that I think investors have been looking at for quarters now, wondering what could continue to drive this? And I think Walgreens is trying to paint the picture that this opening of these primary care clinics and this relationship that they've got with the fact that they have 9,000 stores in the U.S. and more than 75% of Americans live within 5 miles of those stores. They're trying to paint a picture that they're going to have these clinics available. That's also going to drive this foot traffic. So even as we start to see ourselves get out of maybe some of the COVID testing and some of the vaccination period that we've seen ourselves in, they're hoping they're going to continue to drive that foot traffic in a different way and make themselves more competitive against companies like CVS and frankly, even Walmart. We know CVS and those minute clinics, that's really been a winner so far for the company. I think at this point, Walgreens is just trying to catch up.
Hey, they might get out of the SIG business like Walmart. So I don't know if that helps. I feel like that's a good bit of foot traffic right there.
That's right. I thought they were out and then back in, right? I can't really keep up with it.
Yeah, they pulled me back in. Okay. Let's talk some of the analyst notes out this morning, Jeff. Some pretty notable, I think, bearish tone out there this morning. Pulte Group with the downgrade from Barclays. They had it as a buy. They say no more. It's equal weight. The home builders are looking troublesome, even with all the lack of supply that nobody disagrees with. Everybody keeps talking about as being a tailwind to this group. The stocks haven't cared about that for, depends which home builder, but as long as like 6-7 months. Pulte Group peaked in April last year, and we're near the one-year lows right now.
Yeah, you're right. There is a difference in some of the home builders, but overall, what we're seeing here is really a story where investors are trying to figure out that demand side of it versus all of the other factors that go into play. Certainly higher interest rates, although I don't even know that that's the biggest factor. I think some of it now is cost, right? The cost is going up on these homes tremendously. We're seeing the highest cost that we've ever seen out there. We know that there's a high cost for the materials for these actual home builders. There's certainly issues in terms of labor. So right now, the demand is there. Investors know the demand is there. But I think one concern is certainly a deterioration of this market as well. Could we see that demand drop off? Are the interest rates going to play more of a role? But I would say maybe even more importantly, these extraordinarily high costs that they're seeing on these homes now, I think investors are wondering when that is, really going to start to get rid of some of this demand out there.
Yeah. Ralph, Taylor Morrison also gets the cut, not quite as closely followed, but another one that they say is no longer a buy. TMHC, the ticker for Taylor Morrison. Their Darden priced, their DR Horton price target rather, to 104 from 125. That's a pretty big cut. A pretty substantial drop of expectations. So not a great sign when the very positive coverage for this group starts to break a little bit. The housing data has also cooled somewhat. Interest rates, mortgages. It looks like maybe this group might have been a tiny bit more susceptible than many thought.
Yeah, it does make you wonder, what could cause investors to get bullish on this again at this point, right?
Exactly.
What we know now from an interest rate perspective.
Yeah, what don't we know?
Exactly.
Yeah, because the thing is, if the problem is the supply, and let's say that some of the prices cool off a little bit and we get more supply, then that could potentially bring the prices down. So then their average selling price goes down. It just seems like it was a rate of change momentum story that once it peaks doesn't have an obvious way out. I think you're right about that, Jeff. Okay, how about another cautious note out from Morgan Stanley in the realm of technology? Now, they're careful to really limit this analysis to Dell and HP, but they're saying that it's largely a bearish outlook due to slowing hardware spending. They're downgrading them from buy to neutral, and in the case of HP, an actual sell. So they're downgrading Dell from buy to neutral, HP from neutral to sell. How does that not apply to other tech companies if it applies to these two?
Sure. Yeah. And the price targets adjustment as well for the Dell side, price target of $60 down from 66. I like kind of the look at it. They said the 2020 outlook for data center infrastructure is strong, but cracks are emerging in the PC outlook. Why Dell's commercial and and market exposure should lead to stronger for longer PC demand compared to peers. Its valuation is likely to be capped by slowing PC growth. Very similar thing on the HP side. Price target 31, down from 34. Cautious on that near-term PC demand points. As we've watched these companies, they raised annual profits. HP raised annual profit outlook on their last earnings because of strong sales from the computer business. Commercial PC revenue rose 26% for HP in the last earnings report. Now, consumer PC was down 1%, but they keep talking about this kind of hybrid work education arrangement that could continue to drive these PC sales. I think analysts right now, as this note would point out, are not as convinced that momentum is going to keep going. I think the question right now is, have these PC sales already peaked? We already know that a lot of these companies have really started this hybrid program, right? They've already gotten these computers out into these homes and more computers into the offices.
Okay. So nobody who ever wants to downgrade the sexier tech names, but they share market with some really important companies. And ultimately, if their market slows down, then the supplier, the chip market to them, this is Dell we're talking here. I mean, it's still one of the top makers of PCs and gaming rigs, too, that are going to use some of the chips from NVIDIA and others. So, I mean, this is not an insignificant note by any means, I don't think, even though it just targets Dell and HP. This is the type of thing that has some pretty broad implications. I mean, it's not like they're just saying they're the worst competitors, they're going to lose all their market share, right?
Right, exactly. No, and if you look at the side from Dell, for example, frankly, both Dell and HP, they both companies really noted these supply chain issues, right? So you've got analysts coming out concerned that they're going to see possibly a slowdown in demand from PCs. You've got the companies that are actually out there putting these together saying there is still concern over supply chain issues. So a slowdown could occur from either direction. But to your point, you look at peripherals revenue, which rose 40% for HP in the last quarter. That was largely driven by the gaming side of things. So it'll be interesting to kind of see how this plays out, if the demand does stay strong or if we start to see it weaken, and what portion of that is actually because of the supply chain versus the fact that people are just not in need for as many PCs anymore.
Well, here you go. They've got some commensurate language coming from the team at Barclays on AMD as well. Another note out this morning that is cautious on the chip maker. That's from Barclays, saying that AMD's growth story needs a pause. So obviously another important gaming participant and chip maker. AMD's down 4.8%. Dell right now is down 6%. Ouch. And then HPQ is down 6%. By the way, HPQ, it is kind of a sexy stock now because it was just at the all-time high. So I wasn't even giving it enough credit. For a long time, people panned HP, but actually, last 6 months, it's been outperforming by a ton. So pretty notable cautious note here on companies that have either been doing well or used to, but are still favorites in the case of AMD. There's a positive note out there this morning. Of course, it's energy. Jeff, hit me with the Apache upgrade real quick. Anything we don't already know here?
Sure. An analyst at Mizuho put them at buy from neutral, set their price target to 56, up from 38.
Whoa, to 42.
10%, 10% cash return capacity, along with unique international catalysts from Egypt. The analysts increased their long-term oil forecast to 70 per barrel from 61. With their 2022 to 2025 estimates up $16 per barrel on average. They said it's really driven by an increase in estimate U.S. Oil volume growth and the resulting expected increase in capital intensity. If we look, we've seen other analysts raise Apache as well. We saw Wolf raise them from 34 to 42 recently. Obviously, we know these oil prices have been rising to some of the highest numbers we've seen in years. We're watching, if we look at Apache in particular, they on a revenue side recently, they came in at $2.3 billion. That was up from $1.2 billion a year ago. They beat the estimates of $1.9 billion. And in terms of expectations, they've seemed good during the last report.
Okay. The stock is cruising 2% this morning, $42 now. as stocks are very mixed to lower. Energy is working in the case of Apache this morning, despite the move down in crude. So energy stocks are actually hanging in there today, up about 17 bips right now. Broad sector, not bothered by the drop in WTI overnight. Thanks, Jeff. Excellent. A lot of interesting stuff here this morning. But perhaps the most important is that downgrade on the tech spending for HP and possibly a lot of other companies connected to it. All right, when we get back, let's trade some different sides of the tech market, the fintech market. Payment stocks had been in decline before the broad market peaked in November. In the case of Visa, PayPal, they had been in decline since the summer of last year. They're back the last couple weeks, but still have a long way to go. Can we count on them to do it and get back to the highs? Let's talk about them and trade them next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
I'm Maria Schrader. Here are a few stories to watch this hour. Atlantic Equities initiated coverage of Snowflake with a neutral rating and $240 price target, saying it has one of the strongest competitive positions out there. The analyst says Snowflake has a unique value proposition, dominant market share, and a long runway for growth. He adds that the stock is priced for perfection. Barclays lowered Trex Company's price target to $84 from $90 and maintained an equal weight rating. The analyst is shifting more defensively as interest rates seem likely to rise more than expected. He says that home builder valuations are objectively cheap now, but history suggests valuations don't trough unless rates are at a peak or a recession is ending. And Boeing and ASL Aviation announced an order for up to 20 737-800 Boeing converted freighters. The deal is for 10 firm orders and 10 purchase rights. This is ASL's second order for the freighters, and the deal brings its total to 40. ASL says the planes have a lower fuel burn that reduces its environmental footprint. Boeing shares are higher this morning. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Months before the NASDAQ peaked in November, payment stocks had been in decline, and now they've bounced with the broad market. But they've got a long way to go compared to some of the big tech companies now retesting highs. Let's bring in Jordan Waldrep, CIO at TrueMark Advisors, talk about the group, and then we're going to do some trading as well. Jordan, welcome to the show.
Thank you for having me on.
Okay, so tell me about how your team is thinking about these payment stocks. They had seemingly had some trouble even before the market peaked.
Yes, they did. I mean, it's one of those things where these stocks can get ahead of themselves sometimes, right? The overall thesis, though, is something that I think everyone can buy in on. I mean, the trend from cash to digital, that's nothing special. Everyone knows about that. It's an obvious process that's been going on for years, right? I think there was a report a couple of years ago about how Sweden was down to like 10% cash. I mean, it's where everyone's going. But what's interesting there with that shift to digital, it gives you this opportunity to kind of bring payments and financial services together. And that's really what fintech is all about. It's about offering the kind of almost banking type services on a payment structure at the same time. And when you bring those together, it's disruptive and it offers tremendous opportunity long term.
So there's a few different sides of this ecosystem. There are the processing companies with the traditional credit card names that we know, Visa, MasterCard, and credit card issuers. And then there's more tech-oriented companies like Block that also have the trading component onto it. And then there's some infrastructure plays even through Apple. Which are the most appealing? Do they all look like they're going back to where they were during COVID?
Well, I think with the more fintech type names, the PayPals, the Block, I think you got rid of some of the frothiness there. And I think that they're really at an attractive valuation here. I mean, the addressable market that these companies have is just growing. The opportunity is growing. They're bringing new features to their apps every day. Something like Block has an opportunity just to grow with their existing businesses. Something like PayPal can orient away from eBay more and more and offer a wider range of financial services. And they have Venmo, which is one of the most established in customers' minds products out there.
They've got Venmo, and then they've also got PayPal too, which has much of the functionality. And then Block with Cash App, of course. How many of these things do we need? I can send, and then the banks themselves have Zelle. And if I host a poker night, I can get money 8 different ways, and it's confusing. Why do we need so many of these? How much pie can they share?
I think that's a very fair question, and I do think that this is going to have a little bit of a tournament aspect to it, where there's a race for market share. But at the same time, it's very difficult to pick the winner and loser right now. They all are bringing a tremendous amount of value to the table for the people who make sense of them. For Square, it's much more about small business users, right? With PayPal, it's much more about individual users. I mean, just from the aspect of how you're going to do a transaction at a business, you want to make sure that you're as agnostic as possible. I do think that's one of those things that's going to sort itself out. I mean, the network that you're going to pay through is going to be able to intermesh quite a bit over time, but it's going to take some sorting out for sure. Because I don't want to have 8 apps on my phone for doing this. Yeah. And I do right now.
Yeah, same. Visa, MasterCard have bounced back more compellingly than Square, or rather Block and PayPal. The credit card businesses are trading near kind of the midpoint of their range, whereas PayPal, Square, I mean, still well off those highs. Is there a specific threat to the post-COVID growth for Block or PayPal, though, Jordan? Will we ever get the type of adoption rate that we did when nobody wanted to use cash or transact with anything non-electronic the last couple of years?
Well, I do think that what we saw with the pandemic was a big push to get people contactless, right? And that trend is not something that goes back. You don't put that genie back in the bottle. I mean, from a business perspective, if I'm running a restaurant, I would love to be able to just use the QR code to do my payment. It's safer. It's faster.
Yeah, they still are.
I mean, they're not going to go back on that. What I think is happening.
But eventually, every restaurant signs up, right? And then the growth is where does it go?
Exactly. Yeah, exactly. But eventually, every restaurant. We've got a ways to go. There's still a lot of market to address there. Right now, what you're seeing, though, is you have Visa, MasterCard, those types of companies, they're just right in that kind of safe spot where in continued transactions, they should be in a good position long term. I think that's why you've seen their stocks act the way they have. PayPal and Block, those are definitely more on the edge. I do think that PayPal right now is also suffering a little bit from inflation fear. I mean, when you talk about Venmo, that's much more discretionary spending. If you have inflation laying down on it, that's going to impact it some. I think it's giving you an opportunity, honestly. I think the Block and PayPal, you've got an opportunity down here. Are they going to get back to those highs? Near term, I don't. Those were pretty frothy times. But I do think they're pretty significantly discounted to where they should be right now.
Okay, so maybe a longer term hold to let things shake out and get some of that froth off still. Jordan, thanks for the contribution here. We're going to do some trading with that in mind. Jordan Waldrop, CIO at True Mark Advisors. Tom, let's trade Square first, a.k.a. Block. How would you get long if you want to buy it here? What makes sense if you're going to use options?
Well, I think one of the key things you have to watch for is upcoming earnings at the beginning of May. There's some positive notes on it on the stock based out of Susquehanna. Goldman Sachs yesterday initiated with a buy, so it's still down over 50% from its all-time highs. So maybe giving yourself an opportunity, but I kind of want to avoid that earnings event in early May.
Okay.
Option premium is still elevated due to implied volatility. Is high in this name and the overall market right now. So you can take advantage of that by not being uber bullish, but still taking a bullish stance, but maybe a little bit more neutral where you're giving yourself a cushion. So I looked out in the April 29th weekly series, so avoiding that earnings event that could send the shares down. Selling the 130 strike put as a cash secured put. You're collecting roughly about a $7 credit on that, and if you collect $7, your potential reward on this type of trade is $700 per put that you sell, right? But if it does go down below 130 at expiration over the next 29 days, you get to buy the shares 10% lower at 123. So twofold type trade here. We've talked about selling cash secured puts before, where you either want to keep the option premium, which is elevated, gives you a nice return there, or you want to buy the shares lower if you think it might fall a little bit more. But this might be the safer way to play that neutral to bullish stance.
Okay, interesting. All right, so selling downside is a way to try and buy a stock that's already had a lot of downside. Okay, so not quite as long-term bullish as the take we just heard, but a way to at least bet that it doesn't drop further or too far at this moment. Tom, you got a nice little a wild card for a trade for us here this morning. A Tom White special. You're fading Apple just below the highs. Okay, Tom, you woke up and chose violence, it seems.
Yeah, if you take a look at this, it broke that 11-day win streak yesterday, longest streak since 2003. It's basically flat on the year now. So it hasn't pulled back much. There are reports out today out of Digitimes that they're cutting production. They're cutting some of their orders from some of their component makers, not only on the iPhone, but the iPhone SE.
So do a stock split, they'll be fine.
AirPods, yeah. Well, I don't think we're going to see another one of those out of that company. Maybe some of the other FANG Plus names for sure. But I looked at this from the bearish side just due to the run-up, right? And what happens when the stock runs up like that? Implied volatility is down in the bottom third of the 52-week average. So that allows you to maybe buy directional verticals as opposed to selling something to take that bearish stance that I'm looking at. I'm looking at buying the 180 strike put out in the April 22nd weeklies. So they've got earnings at the end of April. I want to avoid that earnings event. But if you think maybe this stock's run too far too fast over the last 2 weeks, this might be the way to look at it. Buying the 180 strike put, selling the 165 strike put, creating that bearish $15 wide put vertical. If you pay a debit of about $4.60, that's going to be your risk on it, right? It's probably trading closer to $5 because the stock is pulling back here a little bit. But if you pay $4.60 on a trade like that, your break even is going to be $175.40 over the next 22 days. That's only about 1%, maybe a little bit less than 1% below the current share price. And by buying verticals for directional bias, if this stock does fall ahead of expiration in the next 22 days, you can start parsing down maybe your position. If you buy a 10 lot of spreads, and the spread expands to maybe $7, $8 if the stock falls a few more bucks, then you start selling small portions of your position unless you think it's going to go down to 165. Good risk reward setup here, risking 1 to make 2 on this one, $15 wide. Put vertical to the downside, fading what everybody's saying.
All right, the contrarian put vertical on Apple. Thanks, Tom, for the trades. We got to jump. We're already in hour 2 here, and we still got to talk some more AMD. That note we're going to get into, pretty bearish. Then we're going to get an update from Alex in a moment here as the market is bifurcated. It's split. We got the Russell up. We got the NASDAQ down. I'll be right back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
wait.
wow.
I
gotta take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to Morning Trade Live. All 4 major indexes now red, but not by a lot. Russell had been breaking away and then just flipped down. NASDAQ now lower by about 2/3%, so tiny bit of selling here, following on to yesterday's action. We got a lot to talk about here coming up, including a deep dive on that advanced micro note. But first, I got Alex here with me in studio, co-host of Next Gen Investing. Alex, this is, I think, a really interesting stock story we've been talking about this morning. Downgrade on AMD, HPQ. But first, let's do a little assessment here of the action so far. We got that inflation print right in line with expectations. No shock number, but markets are having trouble getting going here.
Yeah, they are. And Oliver, I think we got to put it into the context. Obviously, huge rally off the lows, but also tremendous amount of selling pressure to start the year. And so we've sort of had this moment throughout 2022 where bears were fully in control. Then we had a moment, and we're in that moment, or at least we have been, where bulls are fully in control. We might have finally found, at least for the time being, some sort of equilibrium where the markets are at a bit of tension. And so for investors, that doesn't mean volatility is completely dissipated. We've seen choppy markets the last few sessions, although we haven't really gone anywhere. And so I think it's important to distinguish that intraday noise, that intraday volatility, and this is going to be tied to various things: geopolitical headlines, inflation data, economic data, OPEC, of course, and then even individual stock stories like the one you mentioned with AMD. You're going to get into more. You can see this, though. I mean, this is a market that is trying to digest information that it comes in, maybe a little bit less liquidity than we're used to in years past, as there's added risks right now, not a lot of incentive.
We already got one interest rate hike done.
We got
things
one
have already
interest
tightened
rate,
up a little bit.
We've got one interest rate hike. We've watched the QE at least fade off to a neutral point for now. And of course, there's a ton of interest rates on the near horizon. I think it's very important.
So with that context that we are still dealing with one hike already in, and then the hikes coming down the road, to your point here about how the huge swing down to bear market for the NASDAQ 20%, then up 17%. I think this is the point where even if it's just a day or two where that rally slows, it is important because we want to know how to describe this market. I kind of joked at the top of the show, if you really want to be a stickler and say the NASDAQ's in a bear market, then technically you can because we haven't gotten 20% off that low. But we sure did get close. Apple's real close. But we have to really be a disciple to the specifics on these charts where if we net out lower and that was the end of the rally, this is still a downtrending market.
Yeah, and I think it's best, the best picture for this is the Russell 2000 actually in terms of critical levels if you're looking at it from just solely a technical basis.
I agree.
We had a very sideways trending toppy market for all of 2021 pretty much entirely. It finally breaks through to the downside and started carving out kind of this new basing channel below it. And you can see that here.
When we broke 21.
It peaked above it for a day or two.
Yeah.
Breaks back below it. It's right, I think it's 2102, 2100 if you're going to be just kind of looking for that round number. Well, we're below that right now. That seems to kind of be the line in the sand if you really want to draw one. I know the Russell 2000 doesn't have big mega cap tech exposure.
But the chart's great because to your point, it's very explicit.
And it's also very broad. This is a very, there's a lot of stocks that make up this index. They might not be the biggest in the world, but there's still a lot of them. And we've talked about market breadth being poor. Okay, it's been Apple, it's been Microsoft, it's been Amazon, and it's been Tesla basically putting the market on its back. And it takes the size of the Russell 2000, it's negligible to those companies. And the S&P 500 shows that. You look at the OEX, you're going to see that. You're going to see the NASDAQ 100. But some of the moves under the surface have been vicious both directions. And if you finally got a market where Apple slips, if Microsoft slips, we got a little taste of that. We got a little taste of that, though, at the beginning of the year. Where's this market going to stop?
Russell was a nice little tell for us when it had the fake out breakout at the end of last quarter. Was an early tell that this market was going to be going down. So if it can get back into that range, maybe an early tell again.
One last thing, too, just to build on that. You talked about fake out, breakout. And in this time of a little bit less liquidity, a little bit more volatility, a little bit choppier markets, Oliver, you could see some of those. So think of them as levels that are kind of areas, not necessarily pinpoint line in the sand. It crosses that, trends over.
All right, appreciate it. Nice charts. The Russell 2000, trying to hang on to that to 21 right now. Let's go back to the tech story. Pat Mullally is standing by, our man in Salt Lake, taking a look at that AMD note. All right, Pat, I've been excited to talk about this because it's not often you hear a bearish take on Advanced Micro, but this certainly is one, dialing back the growth expectations.
It is, but it could be an opportunity down the road. We have chips are basically commodities. They're going to be cyclical in nature. And of course, there are some headwinds that go along with this. But if we think about what's occurred in the last quarter, their strengths in revenue growth, Oliver, they have exceeded the subsector. Their debt levels are very low. Their quick ratio is about 1.49. They have great cash flows from operations that increased about 22 million or so last quarter, 48.3% compared to the same quarter a year ago. They're expanding their profit margins around about 52.7% currently. But they have that weakness that they're talking about. Net incomes, their PEG ratio is fairly weak compared to their peers, and their earnings growth is weaker. But as in that note said, their sales growth is higher. So that's going to, we're going to see what happens here. But again, seeing some kind of a pullback. We look at the technicals here, and what do we see? Is we see some support coming in around 100 after it's still in a long-term uptrend, consolidating some of that. Intermediate downtrend, short-term uptrend as it bounces up off of that support area around 100. It did breach today fairly strongly that 200-day moving average, that dash blue line that we have in there. Volume, this is a little bit suspect. That middle pane, Oliver, volume has been increasing, and this could be distributive in nature, especially if we see a break below that 100 area. We have a bearish regime as well in the RSI momentum failing around that 50% area, Oliver.
Sounds like the technicals are kind of breaking down there, Pat. Distribution is not a good word for bulls, right?
Not at all. But like I said, it could be an opportunity down the road if we compare it to the rest, to some of its other peers. NVIDIA, of course, seems to be the big gorilla in the room, continuing to make stronger uptrends. But it's still outperforming the whole the SOX index itself. So we'll see there. They've got some headwinds. They've got to get through shortages. The supply chain issues. Longer lead time for components. Lots of different things going on there. Talent, such and such.
Okay, and so Advanced Micro down 5%, breaking down right as it was trying to push out of that downtrend from the highs. It did find that floor at $100 though, Pat. It didn't make the lower lows as many other stocks did. So I guess that means there is some degree of hope. If you're looking to get in this stock, you might be able to get one more try at $100. But if it breaks that after holding on for so long, this could be a troublesome scenario.
Yep, absolutely. We want to, you mentioned the fake out breakout. Well, that's what we'll watch for at that $100 area. If it breaks below there and can create some kind of an air pocket down below that 100 and then start to rally back up and get back above that, perhaps that would shake out a lot of the weaker positions in here. But it looks like there's been, when we look at that volume, it looks like there's been a lot of selling that's come along with this support area in here. Now, again, after a strong uptrend, distribution versus accumulation, it's always harder to tell versus a longer downtrend. But those levels, that $100 level, has not been breached for over a year. So, like you and Alex were talking about the Russell, it becomes a very important area.
Okay. Nice, Pat. Thanks, sir. Appreciate it. Look at the chart and the analyst caution on growth. The Barclays with the downgrade and price target drop to 115, which is $2 above where we are now, but doesn't give any hope to folks trading this in expectations of another push at the record, 165. All right, Pat, good stuff. Joining us from Salt Lake, our contributor here on the TD Ameritrade Network. Let's trade. Scott Bauer is joining us this morning. Mr. Bauer, good to see you, CEO of Prosper Trading Academy. What's up?
Well, hi there. I love what Pat was saying here. I think that $100 level is very important. I absolutely want to be an owner there. But honestly, this downgrade came at a perfect time. There was so much overextension to the upside here, not just in AMD, but maybe across the entire space. So I think the downgrade came at a great time. And quite frankly, after, seeing the stock down, what is it, $4, $5, $6 this morning, whatever it is, I think we're going to settle in here for a while. So what I really like here in the short run is for AMD to move pretty much sideways, stay in a pretty tight range. And so a trading strategy to take advantage of that, if that's, what you believe is going to happen, is something called an iron condor. So what I'm doing, Oliver, is I'm going out to April 14th, so 2 weeks. I'm selling the 110, 105 put spread. I'm also selling the 120, 125 call spread. I collect $2.50 for that. My break even 2 weeks from today on expiration, 107.50 to the downside, 122.50 to the upside. Anywhere in the middle, I make money. Below that, okay, I'm going to lose below the 107.50, but I'm stopped out. Above the 122.50, I'm stopped out to the upside. But I really think that after a downgrade like this, after this massive rise up that we've seen here, I think we're going to see some consolidation.
I like this trade, Scott. Pretty interesting approach. So the iron condor and looking for AMD to remain to some degree contained. I like it because as Pat and I were just looking at that $100 support, it's a kind of a tricky trade at this point. If you weren't in it before today, then it looks like if you want to be short, you can only really expect it to drop $13 before there's some kind of at least a buying pressure. At the same time, though, it's looking like it's not the best moment to suddenly bet on a breakout either when it was just rejected.
I totally agree with that. And from both from a fundamental and a technical standpoint, I really like this setup here. And again, I always trade where if something goes wrong, I know what my maximum risk is. I know what my maximum pain is the most that this spread could ever go to, no matter where the stock goes, is $5. I'm getting paid $2.50 ahead of time to put this on, so I really like this.
Okay. All right, so looking for a range-bound trade here in AMD, and it does fit with a few of the other notes we were talking about this morning. Caution on hardware spending for Dell, HPQ. I mean, connected obviously with AMD, but then NVIDIA will be supplying chips to those companies too. Scott, if AMD breaks down, I mean, do you think this is a broader signal that maybe our big growth bounce back is running into some resistance?
Well, I think it has run into resistance already. Again, I think it did because we just grew, the whole sector just ran up too quickly, just, massively over the last, 10 days or so. So I think this is a really nice breather. If there is follow through, though, Oliver, I think 100 is a line in the sand. I absolutely want to get long AMD at 100, and I'll take my chances over the long run, on that trade. Short run, that's a different type of setup. A 1 or 2 week trade is different from a longer term investment. But if this thing breaks down there, I absolutely want to own AMD at $100.
All right. Advanced Micro down at 100. Might be time to give it another shot here after some rejection of this strength. Thanks, Scott Bauer. In the meantime, trading it between 122 and $100. CEO Prosper Trading Academy. Excellent application of the options market to our analyst note this morning. When we return, a mismatch between stock valuations and the market. In which way now? Obviously, valuations were extremely elevated during COVID, the highest since .com by just about every measure. Things have gotten a little bit more tame since our sell-off, but the sell-off now has retraced 17% for the NASDAQ.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow.
I
gotta take off. Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
Welcome back to Morning Trade Live. We've been discussing cautious notes from sell-side analysts on tech companies from HP to Dell and even Advanced Micro. Let's keep it going and talk some more growth tech with Scott Gogensky, partner and research analyst, portfolio manager at Biondo Investment Advisors. Scott, welcome to the program. Good morning.
Good morning. Thanks for having me.
Absolutely. So we've been discussing some cautionary notes out this morning on tech, pretty broad in tone. Also following on with the warning from Taiwan Semi this week, too, about production. How concerned should we be about tech in this market right now?
Well, obviously in this environment, we have a test of wills going on right now between the market and the Fed. And, us as investors, we're trying to look at through a different lens than maybe an economist would and kind of look through the abyss, so to speak. And, tech is a space where I think, with the correction that we had, in the near past here, that it's a space that we think that if you're looking at secular compounders, which is, I think, as a long-term investor, that there's a lot of opportunity there. And, in this environment where both companies and consumers are fighting these inflationary pressures, quite often technology is an area that provides some solutions to those pressures, right, through efficiencies and so forth. So, that with more reasonable valuations can provide some opportunities, and we're starting to see some of those.
How do valuations for some of these look after this bounce back? A stock like Apple or an NVIDIA, I mean, they're pretty close to the highs. Apple very close, NVIDIA a little bit further away. But we're talking pretty big percentage moves in the last couple of weeks. Are they still cheap?
Yeah, I think so. I mean, if you're looking like what's going to happen and what are these stocks going to do in, the next 6 months and, in the middle of the Fed's, the actions and, drastic moves and all that. Yeah, maybe you'd say there's still a little bit of price action that might be a little bit discomforting. But, if you're looking at, companies that are selling at reasonable valuations based on versus their, long-term, more secular type of growth prospects, I still think there's a lot of reasonable valuations there.
What about these analysts telling us that hardware demand just won't be able to keep up with COVID norms? I'm a lifelong console gamer, and even I had to cave and get a new PC gaming rig with NVIDIA, AMD, all the different games, too, that are now all cloud connected. I mean, that whole ecosystem, how does it ever top the growth that we saw during COVID?
Well, it might not. We lived in kind of unprecedented times there for a while, but, comparing to the past isn't necessarily the best way to look at it. So, what is an outlook for these companies? And you mentioned NVIDIA, and they're going to be the growth engine for all these, these trends in technology we're talking about, from AI to the metaverse to autonomous vehicles. And we still have a global shortage of chips, and they're a leading maker of GPUs and all kinds of different specialty chips. That's a pretty good position to be in as a company.
What about the case, Scott, that I keep hearing that this is going to be a lasting regime, not necessarily the 6 to 10% inflation regime, but an economy that gears a little bit more towards some of the brick and mortar and the industrial kind of cycle, as opposed to this metaverse and AI. The interesting thing is the metaverse and AI, those are the ones that actually haven't even bounced back that well. I mean, Meta itself, Facebook, the namesake, still way down off the highs, no love at all. And then all the EV trades outside Tesla. I mean, the only thing that's working in that group is Tesla. How come the market particularly has found these themes to be unbuyable still?
Well, I think you're talking about, and it's really that inflationary issue, and how much of this is sustained inflation and how much is still a transitory component. I believe there is some still transitory components to the inflationary argument, and I think the market is really starting to sort those out. So if you look at kind of core inflation and you kind of break it down. It's a lot of the goods that are really driving the inflation. And you're starting to see some of that roll over a little bit. The port delays have been easing. Lumber is rolling over. Car inventories are starting to increase. And then, you kind of throw into the mix the other input with wages and so forth. And, it's really a unique environment. We came out of the credit crisis and we talked about quite often about this jobless recovery. We very well could be entering a period of a fully employed recession. Kind of strange, right? But the labor markets are still so tight. And overall, as far as the impact of a recession, I think that is a little bit of a mitigating factor, because really what worries people more than anything, prospects of a recession, right, is losing their job. So I think you kind of, the market is sorting all those things out, and the commodity heavy plays, infrastructure, the industrials, the cyclicals are still really tied into all those moving parts. And that's why I think we're seeing some movement. And some of the other longer secular stories maybe are kind of taking a back seat right now.
Is it maybe just a different time frame that we have to have in mind now than COVID or pre-COVID? Instead of being able to get new highs every week, every month in a stock like NVIDIA, are we going to have to sit around for a year or two this time?
Well, we might. I think we were kind of spoiled, right? I mean, we had a lot of things driving some of these stocks besides just excessive money printing. We had, the meme stock phenomenon and SPACs and all that. And, I think we got to be a little bit more patient again. And for, shops like us, long-term investors, that's right in our wheelhouse. We're willing to be patient and really look at, what's driving growth in the next 3, 5, 10 years.
Scott, what looks like the most compelling in this category, this growth category that you still have long-term belief in? What had enough valuation wipe out to become appealing again?
I like a stock like Shopify. It's a e-commerce long-term growth story that, got hit by about $1,000 in price. And, it's a situation where it's an ever-growing market, and I think just scratched the surface. They take a little bit different approach from an Amazon where, they're kind of in competition with their sellers, their third-party sellers, and Shopify is in partnership with them. And, that combined with a younger entrepreneurial type of workforce that is looking to create their own business, this just seems like a match made in heaven between valuation and long-term growth prospects.
They got all the way down to their pre-COVID high in that $1,000 plus sell-off for a moment there.
Yep.
Scott, thanks for the thoughts. Appreciate it. Thanks for being here this morning.
Thank you, Oliver. Have a great day.
Sure thing. All right, so we've got the bull takes from our guests on the growth stocks and a little bit of the bearish response by the market this morning, but not a big decline, just about 50 bips right now for the NASDAQ. Chartmaster's coming up next. We're going to talk some retail with Five Below and PVH after a big sell-off in PVH yesterday. We'll take a look at those technicals.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Time for the chart master, Ben Watson, to get technical this morning. Ben, on a few companies in the retail space, Five Below and PVH. But first, you've also got a look at Baidu. Since we're talking so much tech here, let's switch it over to the Chinese market for a moment after the company is being dropped. SEC lists for possible delisting. It's now joined that group, and that's not a good one for bulls.
It's not, and I'll tell you what. I mean, there's a lot of market truisms out there, Oliver, and one of those is that the market hates uncertainty, and Baidu's kind of been caught in that washing machine of uncertainty here recently. Is that, you know, will they or won't they delist? Will they or won't they create additional regulations? Will they or won't they on the part of the Chinese government? And so we can kind of see that scenario playing itself out here. This is getting compressed, but still part of this longer-term downward trend. Maybe at best we could say this is a short-term sideways move, but we get the gap down sell-off today that's taking this price down below that 136 support level that's kind of been that floor for the last 2 quarters, minus that little excursion that we saw a couple of weeks ago to the downside, which came back pretty hard and pretty quickly. Now this gap down sell-off, if it holds below that, that becomes a break of maybe what's kind of becoming a bit of a descending triangle type pattern. Long-term sentiment kind of hovering at that overbought line, maybe starting to roll over, although we're not really seeing that yet, even with this downside move. But look at intermediate term sentiment. I mean, it had been progressing nicely up into overbought along with long-term, and then the last 2 days it has reversed and come almost back down to that oversold line. So we may see this continue to move to the downside. You've got a bit of a support there at 119. You've got another support down around that 100 level where that excursion took the price to. So really some pretty significant bearish pressures in the near term on this stock on Baidu.
Okay. Nice, Ben. Interesting chart here where that sharp down and up swing that we got can kind of be removed from the overall analysis. To keep it simple, generally that level has for the most part held. It was just a 2-day back and forth. So if it breaks down again, then suddenly that really is a major deal.
It is, and again, that 136 level really kind of becomes the line of demarcation here, that line in the sand where, you know, it broke on the excursion to the downside, but for the most part, it's been holding up. So this is really the first time that we've seen another move down. And again, the critical factor comes if it closes below and stays below that 136.
Okay, all right. Ben, let's take a look at some retail stuff here this morning. Interesting look at Baidu for sure. Five Below, it's up about 1% right now. You've got some interesting analyst notes out, a mix of cuts and hikes, but for the most part, it seems like some cuts here on Five Below. Stock's doing okay anyway.
It is in the near term, right? It's been in this kind of long, gentle downtrend, but maybe this kind of intermediate long sideways. Now this intermediate term upward trend, which is consistent with kind of this idea that's building here, which is an inverted head and shoulders below that 172 neckline. So we get this kind of gap up into a little bit of a rally today on the upgrade. The potential is to move up and beyond that neckline, although it's got a ways to go even to get to that 172 if it were to break out and move to the upside. This has kind of gone back and forth, and this candle has toggled back and forth between green and red in today's move, coming up off of this right shoulder support right around the 160 mark. Now, if it breaks that right shoulder support down to perhaps that 150 low, then it may very well invalidate this inverted head and shoulders. So in order to get to that being a reversal back to the upside, it's got to come back up and break up through that 172 neckline.
Okay.
Long-term sentiment's rising. Intermediate-term sentiment falling off a little bit here.
All right, so Five Below is trying to make a move and try and rip above that potential resistance. So pretty interesting, unique chart compared to some of the other stuff we've been looking at, and the one we're going to look at in a sec with PVH.
Yeah, and it is interesting, Five Below in that kind of quasi-discount space.
Yeah.
Right? So we've seen Dollar Tree showing some strength, Dollar General showing some strength, Five Below seeing that, but maybe not following through with it.
Okay. Nice. And some of those prices, I believe, have gone above 5, but that's been just the deal, It's what you got to do with inflation. Dollar General is making a move almost back to its high at 240. It's about $14 away. So some of the stuff in its peer group is also standing out, a relative performance compared to some of the other retail businesses. So Five Below, the focus of a lot of analysts this morning. Loop Capital dropped their price target from 210 to 165. Craig Hallam by $10 to 230. Truist by $9 to 205. Jeffries $10 to 250. A $20 drop to 210 from Morgan Stanley, and a drop from Telsey Advisory to 230 from 235. So that's all in reaction to earnings from yesterday that were a little bit below the, they're about at expectations, but not enough, and the company missed the top line. So just a string of cuts to expectations. But stock's doing okay. Interesting. Very fascinating stuff. All right, Ben, PVH, let's talk about that big sell-off that's now in day 2. Down 6%. PVH is getting its clock cleaned.
They are, for sure. This long, gentle downtrend, which was moving into a little bit of an intermediate.
Yeah, not gentle anymore.
Trend. Not gentle anymore, for sure. And that bounce down hard from that resistance right around 89.5. That comes on the heels of that bull flag rally. It was pretty strong, although a little bit of kind of up and down churnedness there, but now seeing this move to the downside. So the breakdown through the 79 mark, which was kind of that holding pattern there, and then down possibly as low as the 72, kind of that first little bull flag blip, could take it down even into that 65 range where that kind of very quick, sharp drop happened a few weeks ago. We could see this double bottom down around that 65 level and then perhaps bounce. But long-term sentiment still rising a little bit and oversold. But intermediate-term sentiment reversed quickly from a higher high out of overbought, now down below midpoint. So definitely some bearish pressure here, watching this gap down sell-off materialize and continue today. Although it is up off of the lows just a little bit this morning.
Yeah, okay. All right. So a little bit of buying since the bell, but another rough session, down 6%. 2 days in a row, just some savage selling and rejection from an attempted rally. A lot of price target cuts. Barclays drops it by $13 to $90. Citi still says to hold it if you've got it, but not buy it, even though they say it's worth $94. Their neutral rating there is also in line with Barclays' neutral rating. Morgan Stanley joins the crew of neutrality, as they had said to buy PVH, but now say it's neutral, it's equal weight, worth $89. So the analysts have all got these 3 at least higher price targets than where we're trading now, closer to about 88 to 90. But market not going that way. So they might have to get in line with this chart, that gentle downtrend, Ben.
Right. Yeah, exactly right. Some bearish pressures in the space for sure.
Okay. All right, Ben Watson. The chart master, thanks, sir. Good stuff from the Salt Lake crew this morning. When we get back, let's get our market meetup panel and discuss some of the action from that inflation print this morning, in line with expectations, and a jobless claims that was a little bit worse and can't hold a candle to last week's epic number relative to what the market was looking for. But so far, the bears are not getting too far. Plenty of pushback this morning and an attempted sell-off. But keep in mind, there was an attempted rally overnight. So call it a stalemate for now.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. All eyes on energy markets with crude oil back to $100 overnight on expectations. The White House will announce the largest release in the near 50-year history of the Strategic Petroleum Reserves. It's expected some 1 million barrels per day for 6 months will be released, a total of 100 million barrels. If so, the third time the United States has released reserves in the past 6 months. It's expected to come in conjunction with the IEA. They're calling for an emergency meeting on Friday with Australia, New Zealand, and Japan. A spokesperson for the IEA said the amount of the potential collective release has not been decided, and OPEC announced plans to increase production targeted levels by 432,000 barrels per day through May 1st. WTI trading just below 104 is down 3%. The crude lower, while natural gas is higher on the day. We just heard from the EIA. They said weekly natural gas inventories increased for the first time since November of last year, up 26 billion cubic feet. Expectations were for a build of 21 billion cubic feet. With the war on Ukraine, the U.S. is exporting record amounts of natural gas to help ease Europe's dependence on Russian energy products. Russia supplies the EU with roughly 40% of their gas and quarter of their oil. Russia's President Vladimir Putin said he plans to halt gas contracts if buyers don't pay in rubles effective tomorrow. Natural gas futures are currently trading, well, up on the day, over 3%, around 570. This has been your TD Ameritrade Network Futures Market Update. Now back to Morning Trade Live with Oliver Rennick.
Stocks are refusing to go down without a fight. The Russell having a nice session here so far. NASDAQ still red, but barely. We did see Bitcoin drop off pretty notably, down to almost lower by 2%, but has also found some support. So we're keeping an eye on those two, NASDAQ, BTC, slightly in the red. But overall, we do have some interesting stocks up here this morning, too. Scott Durfee and Nick Diderakis are with me. Scott's a contributor here on the TD Ameritrade Network, and Nick's a financial risk management director. Cruise lines are having a nice session. RCL's up 3.5%. Jets up about 1%. So something's working here a little bit. But maybe we go back to where the day began, Nick, and that is with inflation. Coming in line with expectations. I thought maybe this would be a decent start for bulls today, with no big surprise or shock there.
Yeah, it's sort of a weird day, right? I mean, we're actually turning positive as we speak in the NASDAQ, so we're breaking the news here, right? But it's, we're right back to unchanged. And to your point earlier that you made, there's sort of this push and pull. There was a pretty decent rally overnight. We actually sold off a bit on these numbers this morning, and now, kind of back to stable. So I think it's hard to interpret, right? I've been saying for months now, when the analysts get the expectations right, there's just not a lot to digest right now. And I think when we saw COVID first happening and these expectations were missing the mark by so much, it's just not happening right now. So one kind of silver lining here is we're basically in line with expectations. The bad news is those expectations for a continued inflation are very high. And if you really dig into these numbers, and what I would encourage everybody to do is, instead of just reading the top of line numbers, particularly on the inflationary and the income side of things, you have to dig a bit lower. And when you look at the spending side of things, spending was up a bit, net. But when you dig into it, it's like we bought less stuff. It just cost us a lot more to buy the things that we had to buy. So I think there's this sort of slowdown element in there. Like, we can't afford to buy as much, and we've all been saying that now for a couple of months. But it's like that's coming through in these numbers. Like, numbers a little better than expected. A revision last month, okay, fine. But like, we can't afford to buy as much stuff because things are just net more expensive.
Exactly.
And Ben just hit the futures and on the oil and gas, and it's a little bit, 1 million barrels a day is different than what we were committing to before in terms of the release. But the market's just saying, hey, that's not enough, right? It's no pun intended, but it's a drop in the barrel here, in terms of what Russia can produce. And if they tighten up supply, as a political tool, I think it's going to be tricky because we just don't have a way to get all these goods around the country cheap without gas, right? You can't do it, so it's expensive, and that's a tough thing that keeps kind of fueling the inflationary concerns here.
Once again, no pun intended. The crude line in the sand, $100, holding yet again this morning. Down 5%, $5, but still hanging out above $100. We've got the NASDAQ turning positive, as you just mentioned there, Nick. And we've also see the dollar kind of cool off a tiny bit. So we'll see if bulls can make a stand here. What's interesting is the point about inflation eroding at the consumer's ability. We looked at a chart with Liz Ann Saunders this morning showing that the consumer contribution to GDP basically now adding at a rate of where it was pre-COVID. So it seems like, Scott, we kind of spent some of our savings that built up, and then the areas where we are willing to spend, maybe it is in a cruise line or an airline. Maybe that is what we're willing to pay up for at this point, as we see those stocks doing okay this morning.
Yeah, you're probably right. There's a lot of pent-up demand around that get out of COVID trade,
yeah,
right? And when I say get out of COVID, yeah, you got to, and you were talking about it with Tom yesterday, about the travel trade, and all of this. I think that, Nick's right. We've got a lot of pent-up anxiety and stuff going on around all these numbers. But here's the thing, we can release new oil, we can increase production, we can do, but as soon as we start tapping into that reserve, which it looks like now we're going to also be doing, at some point that's got to be paid back. That's why the reserve is there. And so, are we really I think we're doing a lot of what we have to do, but how much of this are we just kicking the can down the road? Because eventually the day of reckoning is going to come on all of these things. And, we get all the stimulus that started happening 2 years ago at the beginning, at the onset of this COVID. Now we have the hangover from all of that going on, and so many other things. It's kind of an unprecedented time. I don't think anybody can argue with that. And so what's going to happen going forward with the Fed, with all of the inflation, all of the things that we're facing right now, it's just one man's guess against another. But there are some fundamental things happening here that, investors and traders really need to be paying attention to, especially as it comes to what's happening in the geopolitical scheme of things, Oliver.
Crude oil hanging out $100, so gold up this morning. Seems like crude definitely responding to the strategic reserves, but with that still lingering backdrop of geopolitical driven supply problems, it can't get too far down, it seems. It seems the crude just really refuses to drop. But gold's refused to drop too. Gold's sitting here at 1,900 still, even with the dollar near the highs. And bonds have even caught a little bit of a bid. But gold, too, kind of looks like crude in that whatever got priced in the last month maybe has ebbed to a degree, but not enough to reverse any of the strength here. It's one of the few things that still is pretty steady in this market, Nick.
Well, let's take all the volatility you guys just mentioned and jam through like 6 or 7 more rate increases this year, right? I think gold maybe is catching a bid for a reason. I don't know. I mean, you take all this uncertainty and this plan that the Fed's like, now we're going to do this. We're going to just sort of plow ahead and do a bunch of rate increases. I mean, I think there's room for a gold bid here, along with other market kind of sector rotation still, because you see a day like today where the rates are down a little bit. Like you said, bonds have caught a bit of a bid. Financials get pretty beat up on these days because the expectation that rates are just going to be straight line up is there. When we correct, you see the financials directly tied to that. And but there's still no easing concern. There's no ease of those concerns about inflation. So I think gold has a place in this marketplace, in a diversified portfolio, because there's just a lot of, again, kind of sector rotation and churn around this. And the Fed's saying, look, all this uncertainty is out there, but we're going to raise rates. And that when that is the top of mind thought, that bodes well for gold for sure, regardless of what dollar is doing, I think, because you have that safe haven kind of feel of like, we know rates are going up.
It's interesting that gold's held on as the real interest rate has risen with yields. A lot of times that pushes gold down. The fact that it hasn't maybe speaks to the point that there's some conviction here in something longer term for gold. Bonds have been pretty calm, though, and oftentimes that's what the market wants. So with bonds calm and no shock inflation, an interesting test perhaps by the end of today, Scott, on if we are higher or lower, because right now there's no real obvious news reason for us to sell off from overnight, with the exception of crude. So I guess this just comes down to who's got more gumption at this point, bulls after a 17% rally, or bears that have lost most of what they gained in the last couple months.
And what we've got too, Oliver, is, as a horse trainer, if I go to a pen and the horses are uneasy and they're going crazy and stuff like that, I'm going to be a little apprehensive around those. And that's what's happening happening right now with the trader investors, right? I mean, yeah, we have all of this stuff, and we have some good news. We have some reason to kind of exhale right now and so forth, but there's a lot looming. And that a lot looming factor there really can play into the angst around what's happening in the market. I heard Ben earlier too, and one of the comments Ben said was, and he's right about this, the market just does not like uncertainty. We still have some uncertainty, not just about what's happening overseas, but about how we're going to react. And when I say we, I'm talking about the administration, I'm talking about FOMC and all of that. But how are they going to react, and how is this reaction going to be taken by the consumer, by the investor and trader? And so, that unsettledness and that angst that's filling that a lot of investors and traders are feeling right now is going to, make things so that they could potentially even be a little more volatile. In other words, what stimulus might create a small reaction in the past, or typically might create an over-exaggerated reaction right now. Something we also need to kind of be paying attention to.
An exhale. I like that description. An exhale here with some of the more positive developments in the discussion between Ukraine and Russia, and maybe an exhale on inflation not coming in too hot. But angst enough to keep the VIX at 20 this morning, but it is dropping too. So it looks like bulls are going to try and make a move. And here we go. Thanks, Nick Ditaraka, Scott Durfee, for the conversation. That's it for Morning Trade Live. I'll see you this afternoon. Market on close at 2 p.m. Of course, Trading 360 with Nicole Petalides is coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360 live from the New York Stock Exchange. I'm Nicole Petalides. It's my pleasure to be with you this morning. You can see somewhat of a mixed bag here on the major market averages as they try to clock in the third winning week. We'll have an oil story for you, but take a look right now at the major averages as they are turning into the green as oil is falling. The Dow is at 89 points to the downside at 35,139. The S&P 500 down fractionally at 4602. The Nasdaq gaining, though, up 12 points, 15,082. And the Russell is up almost 0.5% at 2099. Here's a look at some of the big movers on the day. We're watching Walgreens. It's down over 5%. Walgreens dropping. It did have an earnings beat. The company said it saw growth across all of its categories, including a consistent demand for COVID-19 tests and vaccines. The comp store sales rose 14.7% as the pharmacy company focusing on its U.S. businesses. Now, Walgreens said it plans a strategic review of its UK-based Boots business after rumors of exploring a possible sale. Take a look at Boeing. Boeing announced an order for 20 737-800 jets. Ireland-based ASL Aviation will now have commitments for up to 40 Boeing aircraft. Jefferies analysts maintaining a buy rating and a 270 price target on the aerospace company, noting that deliveries to China continue to be in focus. 737 MAX flights have yet to return to service in China despite test flights. And discount retailer Five Below was upgraded over at Citi. The analysts lifting their rating to a buy from neutral with a price target of up to $205 from $176. Citi says there is still very long runway for growth, fueled by highly productive and profitable store expansion. The shares of Five have been gaining. They're up over 1% now. Chip maker AMD was downgraded over at Barclays to equal weight from overweight. The analyst said that the growth story needs a pause, with cyclical risks looming in 2023. Barclays lowering the price target to 115 from 148. Shares of AMD are down 5% in the session today. Now let's take a look at the futures products. Of course, so much to discuss here. Here's a look. Let's get to the crude story, which is the White House announcing the large oil reserves release in history. 1 million barrels a day over the next 6 months. Crude oil is down it's about 4.5% lower at 102.91. There's been a lot of talk about Bitcoin today. In fact, we saw it rolling lower at one point an hour ago. It's down 395 at 46,845. And we have a special panel on and focusing on crypto and all the different ways to get in, much of the exposure into that space. So we'll have you covered there. The dollar gaining some, gold at 1946 a troy ounce, and the VIX at 22.10. Let's get some insights on the news shaping the markets, and for that we welcome in Colin Martin, Managing Director and Fixed Income Strategist at Schwab Center for Financial Research. I feel like we have so many different stories, including the data on jobless claims. Where would you like to start? What's jumping out at you?
Hi, Nicole, and thanks for having me. What's jumping out at me is the inflation data. That's still center stage. I think what's important when you look at today's release is not just the headline number, but that core PCE reading, which continues to rise. And that's important because it's the Fed's preferred gauge of inflation. And at 5.4% year over year, with still a healthy month-over-month increase, it shows that inflation is still front and center. And unfortunately, it shows that it's not just an energy or oil or gas price story. It shows that excluding food and energy, we're still seeing these price pressures. So when you look at that, that just really confirms what the Fed has been telling us, that inflation is likely to stay high, and they're likely to act aggressively to try to bring that down.
Right, so that's a big story there, as we'll wait to hear from the Fed. Are you still thinking at least 50 basis points on the first meeting? I know everybody's thinking 50 basis points on 4 meetings, at least that's what Citi said. Is that where you stand, at least 50 basis on the first round coming up?
It seems pretty likely right now. They've been laying the breadcrumbs, and they're priming the market for that 50 basis point hike right now. So that seems like it's not a certainty, but maybe a near certainty, and the markets are certainly pricing it in. We're certainly short of 50 basis point increases over the next 4 meetings. That's just a little too aggressive for us, because that can tighten financial conditions a little bit too much. And a theme that we've been focusing on for a while with the Fed is that they are in a tough position. They need to act aggressively to bring down inflation. We know that, but they also need to not choke off growth too much. They've stated that they're willing to do that. At least Fed Chair Powell has said that. But that is a risk, and there are no shortage of risks out there, especially with the conflict in Russia and Ukraine. So if they do hike that aggressively, we think there's risks there. When the Fed hikes, things break, and that's been an ongoing concern for us heading into this year.
Yeah, understood. Can we get to the jobs pictures? We got the jobs claims today, ADP yesterday, and we're waiting on the print, the big print, tomorrow. What jumps out at you? What are you waiting to hear tomorrow?
I'll be looking closely at the average hourly earnings number, and not just the year over year, but the month over month. Because with last month's release, there was basically no change, no gain in the month over month average hourly earnings. So we'll be looking to that to see if that was an anomaly or the start of a trend, because earnings have been growing at a very healthy clip lately. And that brings, to the forefront the risk of a wage price spiral. So we're going to be focusing on that. But at the end of the day, it's a very healthy labor market. We know that, the markets know that. Powell has told us that. He told us that the market is strong enough to withstand this aggressive pace of hikes, but we'll be looking specifically at average hourly earnings to see if there are maybe some sort of cracks there, because that can alleviate some of those inflationary pressures.
And at the same time, you mentioned that the inflation is big picture and it's not necessarily about oil, which I agree with you. I mean, it's across the board. But the oil picture, at least we got a little reprieve here because we have the OPEC news, OPEC Plus basically sticking to the modest oil output, that the hike that they had planned on. Now you have the administration with this unprecedented release of the strategic petroleum reserves as we look 1 million barrels per day for 6 months. That should provide some relief to consumers for their gasoline prices. Any thoughts on this?
It should provide some relief, but as you've seen, the drop in price is still somewhat low, and we're still over $100 a barrel, and that's the risk. And this is where things can get a little bit funky when you look at inflation and what a change in price actually is. Let's say the price of oil stays around $100 for the next year or so. In a year, the inflation rate would be near zero, but that $100 price is still really, really high. And that would translate likely to still elevated prices at the pump, which, as we all know, are eating into consumers' savings, and it just limits what we can spend elsewhere. So, it is good news. It can help the rate of inflation, but unless we see that come down even more, it's likely to result in still high gas prices, and that's been a challenge for a lot of consumers for the past few months now.
Right. And by the way, with this energy story, I'd be remiss if I wouldn't announce here that the S&P 500, I looked at some of the leaders, is all the cruise lines, right? Some of the airlines are doing well on the heels of lower oil prices, because obviously that'll cost them less and maybe people will have more money to get on a cruise. Let's turn your attention to what we're seeing with yields, right? We looked at the 210 quick inversion there, but it seems that everybody's focusing more on the near-term 3-month 10, which still is steep. Your thoughts on what this means? What should investors watch out for here?
Yeah, we're looking more at the short-term yield curves, whether it's the 3-month 10-year, which is still very, very high, or that near-term forward spread, as you alluded to. That's something that Powell has mentioned, and the Fed has done a lot of studies on that lately. And that looks at really what the current, short-term rate is relative to where markets are pricing it in 18 months' time. And that still is steep, which the Fed views that as saying that conditions aren't too tight yet. That allows them to hike rates. If we look at the flat yield curve, the 2-year, 10-year is one that makes a lot of headlines. Nicole, you mentioned that it briefly inverted the other day. From 2 years to 30 years, for all intents and purposes, the yield curve's flat. There's a few basis points here and there, but it's relatively flat. To us, that's just the market pricing in what it expects the Fed to do over the next few years. It expects a very aggressive pace of rate hikes where they'll get to, say, 2.5% relatively soon, but it's also telling us that at some point they'll get too high and they won't need to hike anymore, or they'll actually need to cut. And that's why we see all these yields in that 2.5% area, which unfortunately means the neutral or natural rate of interest is still around 2.5%, which means the Fed only has so much room to hike before it really tightens financial conditions. So it's not too concerning just yet. If you see headlines of the 2s, 10s inverting or totally flat, it doesn't mean a recession is necessarily imminent, but there are negative consequences of the Fed tightening, and when other curves, like that near-term forward spread, when that starts to flatten, then we'll be a little bit more concerned. But any way you slice it, we're expecting growth to slow a little bit, and it poses a risk in the next, say, year and a half.
All right, excellent. Thank you for what to watch for there as well. Colin, it's always great to have you on. We've already had a lot of breaking news this morning, and you help us sift through some of this. Colin Martin, thank you, Managing Director and Fixed Income Strategist, Schwab Center for Financial Research. Thanks for being here with us. Plenty more to come right here on Trading 360, our 360 Spotlight. We'll look at Alignment Healthcare as it celebrates its 1 year of being a publicly traded company. Our disruptor is Snowflake. The company was downgraded this week, so what should investors really be looking for here? George Sillis is all over that. And our 360 round will focus on cryptocurrency. Will Bitcoin continue to be the king of crypto this year? Much more to come on that. And it's time for the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals, and Joel Hawthorne is standing by from the morningsnapshot.com. He'll take us through the trades for Lululemon, Microsoft, and CrowdStrike next on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. It is time now for the big three. 3 stocks, 3 charts, 3 trades, and Ben Lichtenstein will take us through the charts as he does every day. Here to take us through the trades, Joel Hawthorne, head trader and CEO at the morningsnapshot.com. You have 3 great names for us. It's great to see you both this morning. Thanks for being here. First is Lululemon, which of course had a nice quarter and raising guidance and a buyback. 1 month, it's up 13%. It's off that 278 low. Joel, your thoughts here?
Nicole, thanks for having me. And by the way, you being on the NYSE is pretty cool. Glad to see you there.
Thank you. We're all there together, right? Our whole team now. This is super. Thank you, Joel.
Absolutely. That's pretty cool. So I like Lululemon. I like some of what came out after earnings. Definitely, we've seen over the past couple of days, we saw a ton of price target raises. So I think that there's just a bunch of optimism here in Lululemon, and I think that coincides with the overall market. I mean, just a couple of weeks ago, there was a lot of uncertainty, a lot of fear, and to see a name like Lulu really just kind of catapult here. I would say over the past maybe 4 trading sessions, just before earnings even reported, we saw a lot of upward momentum. I'm going to go along with that. I'm not going to fight trend. Because of that, I'm bullish as well.
Okay, so bullish and going with this trend that's happening. Ben.
I can see why. Good morning, Joel. Good morning, Nicole. And Joel, credit to you in terms of picking these 3 names today. These are some good examples to take a look at here, so well done. Let's jump right into the 5-minute time frame. Not often do I take a look at this granular of a time frame, but I think Lulu is a pretty good example of the two separate phases of development that I always talk about. That vertical phase, we have high conviction to the upsides, higher highs and higher lows in this instance, and then you'll see that we transition into the horizontal phase. The nice thing about looking at price activity through this lens is there's really only two phases. You have, again, the vertical and the horizontal, and they oftentimes, well, they do transition from one to the other in an orderly fashion. Now, oftentimes more easily identifiable than others, but this is a good textbook example. Again, Lulu up to 389, and you can see the spike in reaction to earnings here. Now, I wanted to move away from the 5-minute and get into the hourly. These are 60-minute candles, so you can see we just recently bottomed out around 278, and that's a key level. I'm going to show you why in just a second when we look at the weekly, but you can see how, well, in Lulu, February traded below the January lows. March took out the Feb lows, so a series of lower lows and lower highs, and now we just rip into the end of the quarter. So a sizable rally from the March lows into quarter end activity. Let's take a look here at the daily time frame with some moving averages. The 50-day is the blue dashed line. The purple line is the 200-day. So you can see we broke above the 200 or above the 50 back to the 200-day. Look at RSI, though. It does look a little bit overextended at this point. There's been good volume here, but I want to remind everybody we can remain overextended for a prolonged period of time. So if Joel's right in terms of this approach here, this long-ended approach here, you're going to want to see RSI remain at this upper level for a while. But again, as mentioned, good volume. And I mentioned 270 was a key level. Well, take a look at the weekly. You can see not only did we bottom out there, again, the lows from March, but I want to point out that coincides with the lows from March of last year as well. So there's a possibility that we're going to kind of form a bit of a balance in this larger area here, 275, we'll call it up to 485. But Nicole, Joel, you guys know how I feel about it. If we build momentum through the middle of this range, so up and through 400 with energy, conviction, follow through, opens up the door for a retest to 485.
Okay. So, Joel, as Ben is talking about this momentum to the upside and possible retests here, tell us about your trade, Joel.
Absolutely. Just with so much of the volatility we've seen as of late, I don't really want to be that aggressive and trying to time that upside momentum. So I'm going to be bullish, but I'm also going to use selling some options to kind of see some gradual uptick, if you would, in the price. I'm going to sell the 370 250 put while simultaneously buying the 350 put. That expires next Friday. This is a very short-term trade for me. Taking in a credit of about $6.42, risking $1 to make 40 cents, and my break even is 366.08. What that does for me is allows me to, in the event we do get a bit of a pullback or even some consolidation at this range, as long as we're above that 366-ish level, I stand to keep the premium that I'm collecting.
All right, good. And what do you think there, Ben? A final thought here.
Final thought. I'm looking at this weekly chart. The thing I think that could become a bit of a hurdle is I pointed out how that level that we just came off of, we'll call it 280, coincides with the March lows, if you remember from last year. But what concerns me a little bit, and the bulls need to keep an eye on this 400 level because we have a spike high we saw back in August of 2020. If we reach that level and are unable to get up above it, we could set up for a bit of a head and shoulders pattern here. So I guess this gives us something to watch here for both sides. Again, you're going to want to see that energy up and through this 400 level with conviction, with follow through to avoid the head and shoulders and open up the door for a retest of the all-time highs.
Yeah, understood. Okay, so that's a good point that he made there. Thank you for that, Ben. So let's move to the next name, and that is Microsoft. Obviously, a lot of the tech stocks came under pressure, but this week, Microsoft has made investors happy. I saw just this week it's up 3% for the month of March. It's up 4.7%. Joel, you like this trend here for Microsoft?
I do, and I think it's sitting at a very key level. I think just that 315-ish level that we're just trading just slightly below right now. I think that's a level that we really have to see. If we can kind of break above that level, I think Microsoft could really get on another run, maybe even go to that 320-ish, or maybe even get higher than that. So that'll be a very, very peculiar price action for us there. I'm bullish Microsoft. I do like the resiliency of Microsoft as of late. I think this is one of those names, even with a lot of the volatility that we've seen, I think this is another one of those names that when investors are looking to put risk on, this is one of the first names that's at the top of their list. So because of that, I'm bullish also.
Okay, so that's an important point. Ben, your thoughts when you take a look at this Microsoft chart? Are you seeing something similar?
I'm seeing a real kind of a breaking point at this point, one way or the other. We're at a high inflection point, as I like to call it. We're at an upper extreme right now of a range that we've been in, and I don't expect it will stay here very long. Whether we go higher or lower at this point, it's tough for me to tell. But again, I think that we're going to move quickly from this point in a swift fashion. And the reason I say that is because, by definition, the market doesn't spend a lot of time on extremes. You can see how it didn't spend much time on these extremes to the downside here, this lower extreme around 270. Every time it touched on it, came off quite rapidly. And the reason I say, again, that we're at this make or break point here is we're now retesting these Feb highs, the lower mid-range for January. And again, right around this 315, 320 area seems like a level that we've kind of struggled to get up above recently. Now, I do want to point out here, as we take a look at the daily time frame, kind of similar to Lulu. You're going to see how we're, well, here in this instance, above the 50, above the 200-day. But look at the RSI. Remember, Lulu was a little bit overextended. The RSI has a little bit of room to go to the upside here, so potential some more participation. Not as much volume as we saw with Lulu, but take a look at the weekly time frame. We looked at Microsoft recently, and I talked about these areas of consolidation that were kind of stacking up, and I mentioned how, well, it's sort of weird that we're forming a number 6 at a lower area. Again, after 1, 2, 3, 4, 5 to the upside, you expect trend to continue, and that continuation would mean, well, 6 would form at a higher area. Now that we kind of work our way towards the upper extreme of this area 6 and kind of right back to, again, this 320 area, what I'm starting to wonder, Nicole, is are we just starting to form kind of a larger area balance? Sometimes we'll kind of lose that well-defined migration of value to the upside and then just sort of start to kind of chop sideways for a while. And if that's the case, I think the best way of looking at it would maybe consider just all sort of one sort of balance of area consolidation and consider this just number 4. But again, in each instance, I think for the most part, if we can continue higher right now, again, in this case through 320, well, just like we were talking about with Lulu, it opens up a door for a retest of that 350 area in this instance. But in either case right now, through 320 with the follow through here would be a very bullish scenario. And if we sell off here, well, then you're kind of going back into this scenario where we're just sort of, you know, if we sell off and work our way back down to this 275 area, we've just kind of lost conviction to the upside. The bulls want to see this up and through 320. And again, if they can do that, opens up a retest for the 350 level.
Yeah. And you know, and it's interesting because there's all this talk about Microsoft versus Apple and the runs to new highs. And Joel, you know, you picked Microsoft over Apple, and sometimes people look at the two of them. What made you, as you consider all the things that Ben pointed out on the chart, what made you say, I want to do my trade in Microsoft as you take a look at this trade?
Particularly, one thing that I noticed about Microsoft is they're probably a little bit less in the headlines in the news as of late. With you know, we saw Apple talk about kind of redirecting their finance just here yesterday. I think also just prior to that, there was conversation about just the kind of making the cheaper model iPhone a little bit more accessible. So I think some of the headlines cause knee-jerk reactions. I kind of want to stay away from the headlines a little bit, look at some low-vol names, especially collecting some premium here in the overall market. So that's why Microsoft was definitely on that list instead of Apple. I love Apple, but Microsoft was my favorite child today.
Yeah, so this put vertical, we're taking a look at it right now, and yeah.
Yeah, so because I want to be bullish again, writing more options, using those puts, collecting premium to do so, selling that 312.50 put that expires next week, next Friday, while simultaneously buying the 300 put as well, risking $1 to potentially make 40 cents. Break even is 308.90. So just like Ben mentioned, the very well may run into a little bit of resistance and not being able to break above to those higher highs. That's why that 308 price level is my break even, just to kind of give me a little bit of protection if we do get some downside market auction, if you would.
Right. Okay. Last but not least, let's look at CrowdStrike here, because it was so choppy, right, around the earnings. If you took a look at this chart, which Ben will do a great job at in a moment, but it is higher today. It has been on a move higher this month of about 17%. So, Joel, your thoughts here on CrowdStrike?
I agree with you completely, Nicole. Yes, very choppy around earnings. That's where I like to call just that coffin of congestion, if you would, on the chart. And then we saw yesterday a bit of a breakout of that congestion, And then we've kind of slightly double topped there today. Not wanting to anticipate much of a breakout to the upside, playing these levels on a bullish trade as well. So we'll see what happens here in the next week.
Okay, and Ben, your thoughts as you take a look at CrowdStrike?
Well, I've got to adjust my chart here. I apologize. Give me just 1 second. But, you know, I was looking at CrowdStrike, and the bid that we've seen here recently, I think is important to take note of. Nicole, you mentioned up on the day by about 2.25%. But let's take a look here at the move that we've seen, a similar pattern in terms of what we've looked at as far as some of these other tech names and the run-up we've seen. I want to point out, keep in mind that the NASDAQ took out the February lows in the month of March. It was the only one of the 4 majors that was able to. Here's a situation where we saw, again, a higher low in February above the Jan lows and a higher low in March. So, again, trying to regain composure here. You can see how the bottoming pattern is trying to establish itself here. And, again, in similar situations, what we talked about with Microsoft and with Lulu, you really want to see the extension now to the upside, a sign that the bulls are really in charge here. And those that were kind of doubting or betting against this and now have to start to cover, basically, and kind of, again, get out of that position. Take a look here, though, as we move away from the hourly time frame and just to see where things stand in terms of the 50, the 200-day moving average. We're back above the blue line, the 50. We're testing the 200 right now. RSI right up into this overextended level. So kind of a mix between what we looked at in terms of Lulu and in terms of Microsoft. But I wanted to show the weekly time frame here. And when I looked at this chart, Nicole, Joel, I'm not sure how closely you've been watching Bitcoin recently, but it almost reminded me exactly of, here you can see, nice run up the last 4 weeks to the upside if we close higher. This week, it looks like 5 out of the last 6. And you can also see a nice little double bottom pattern here around this 148 level. But take a look here just to kind of put these two side by side. I've got Bitcoin on the left, I've got CrowdStrike on the right, and you can see here how they are almost an identical pattern, a very kind of unusual circumstance possibly, but I'm not sure what to make of it. It just sort of kind of made me chuckle a little bit. Interesting to see some of the strength in these few names that we've seen and talked about here today off the March lows. Really sign of some strength we've seen in the broader market as well into the end of the quarter.
It's interesting you put those side by side. We're going to have a great discussion later in the show all about crypto, especially we saw crypto selling off about an hour ago, so we'll have much to discuss. Thanks for that side by side. Joel, final thoughts here on CrowdStrike, which obviously has been running up. Cybersecurity worries, attacks with the Ukraine conflict that has been occurring. The company will have an investor conference on April 7th, so I think people will be waiting to hear something from them at that point. But your thoughts on the trade here, Joel?
Absolutely. I think all of the reasons that you explained are definitely why I think a name like CrowdStrike is going to be actionable from right now and for a time to come. Because of that, I do want to be in CrowdStrike. I'm bullish. I'm going to actually sell a 227.50 put, buying a 200 put. That 200 level is very important to me because that is just below some of that auction that we've seen as of late, that consolidation range. So if we do test some lows there, I think that will be a strong support level. Picking up a credit of about $6.95, risking $1 to make about 34 cents, and my break even is 220.55. So right now, CrowdStrike trading 229, almost 230-ish or so. So that puts me in a great position here between now and next Friday.
All right. Thank you both. What a great big three. Fun names, too. Lululemon, Microsoft, CrowdStrike today. Thank you, Joel, for your good wishes here at the New York Stock Exchange. We've had a great footprint this week, a nice start here, so thank you for that. Wonderful to see you both. Joel Hawthorne, head trader and CEO at morningsnapshot.com, and Ben Lichtenstein. Thank you both for being here. Coming up next, we're going to spotlight Alignment Healthcare, ticker symbol ALHC. 1 year celebration and the growth that they've had. They're ready to talk all about it. Live from the New York Stock Exchange, Trading News 60 continues.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. the existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Trading 360. I'm Nicole Petalides, live at the New York Stock Exchange. Let's take a quick look at the markets. We've had this back and forth action over the unchanged line as stocks are trying to put in another winning week. It would be the third winning week. Take a look right now, though. You can see all the major averages, in fact, have now turned to the downside. The Dow is down 142 points, losing 0.4% at 35,086. The S&P down 10 at 4591. The Nasdaq down 43 points at 15,027. And the Russell is the only one gaining there, interestingly enough. The small caps holding on to that little bit of a gain at 2092. It is time now to spotlight Alignment Healthcare, the ticker symbol ALHC. And joining us from Las Vegas, John Kao, founder and chief executive officer of Alignment Healthcare. Thank you so much for being with us. This is the celebration of 1 year for your company. I know you're feeling very successful and proud, as you should. I saw some of the statistics. 1 year, congratulations. Thanks for being on with us. Your thoughts?
Good morning, Nicole. Thanks for having me on. I am so proud of the company. All of the financial performance has been fantastic. We've beat and raised every single quarter for each of the first 4 quarters. The thing I'm most happy about, though, is the way in which we serve our seniors. And we're serving over 93,000 seniors now. We treat each one like our mom or our dad, and that just makes me feel fantastic.
So, yeah, I saw every member is like a family member, and that's, you know, really a good mantra to live by, because that means you're trying to deliver your very best patient care for seniors. You've expanded your footprint geographically. Tell us a little bit about that, because now I see you have access to 7 million seniors, eligible seniors with Medicare. Why was this expansion important?
The whole theme is to replicate this model in order to change healthcare throughout the country. It's just a better way of delivering healthcare for seniors. And the whole thesis is based on knowing who the people are that are the most vulnerable, that 20% of the population that cost 80% of the spend. So if you can identify who these people are, you take care of them at the home, you take care of all of their needs. What that does is it'll help bend the cost curve. You lower costs, you provide higher quality at a lower cost, and what that does is you create higher value. If you can do that, you're going to be able to reinvest those savings into richer benefits, and that's how we've been growing.
Mm-hmm. You know, when I looked through some of the analyst reports, everyone has an outperform or a buy. It's not always that you would see that, particularly for a newer company, but, you know, I looked Morgan Stanley, Goldman Sachs, Barclays, Cowen, all with outperforms and buy ratings. That really is a testament to their belief that you're doing something very right. Your 1 year was successful in the press release, saying that financially and operationally. The financial side, what was so great about it?
We're going to I think 2021 we hit 1.2 billion dollars in revenue. We've grown 22%. For our health plan members, we're growing 28%. But the most important thing is it's profitable growth. It's not growth at all costs. It's profitable growth. And the chassis that we're building is designed to scale. It's designed to be replicated, and it works with any market, whether it is rural or urban, high income, low income, ethnic. Any single market we can take this model to, and that's what I'm most excited about.
Yeah, and it is exciting because you're delivering the needs to these seniors in a way that what they value, and giving them exactly what they need. This care delivery model scale that you're talking about and expanding here, you have proprietary technology. You've expanded in these 4 states, giving you access to many. Any other expansion plans? What would say to you to move further on?
Extreme bullishness in the confidence in the gross margin engine producing. And so we're very, very confident in that. Every single one of our existing markets is gross margin profitable. And our largest market, California, is EBITDA profitable. And so we just have confidence that the investment thesis and the business model works. We will be expanding in 2023 to additional states, and we'll be expanding into additional counties in our existing states.
As you look at the senior picture, what is it that you find that they need most, and how are you delivering that to them?
That's such a good question. Seniors, the 20% that have polychronic needs, they just need a lot of care. And they need care coordination amongst the different subspecialists. We have nurses that go to their home for free that just take care of them. We offer them virtual interactions so they don't even have to do anything in terms of going out to see their providers. If they want to see their providers, we have transportation to take them there. So we make the whole experience really easy for them. And most importantly, we're their advocate to help them navigate this very complex healthcare system. And it makes it simple for them. And to make sure that all their healthcare needs are dealt with. The other thing I would say is there's a convergence between traditional healthcare and social determinants of care, or health equity. And so we got to make sure that all people get access to this quality of care, irrespective of income levels, and we just take care of them, period. And literally, we treat everyone like our mom or our dad. My mom's a member.
That's good. I like that you added that in. Well wishes to you and your mom and the team there. Congratulations, John Kao. Thank you very much for being with us, founder and chief executive officer, celebrating 1 year, publicly traded Alignment Healthcare. Thank you.
Thank you, Nicole.
Coming up next, the disruptors. George Silas is standing by. He's taking us right to the cloud. We have a big mover for you, and that is Snowflake, the latest analyst calls and an example trade. George is all over it next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our Active Trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. I'm Nicole Petalides. It's time for the disruptors. Every day, George Sillis is here on this one, and today he's taking a look at Snowflake. A couple of the analysts are weighing in on this one, including one downgrade. Tell us a little bit about what's going on here, George.
Yeah, Nicole, there's sort of a back and forth going on with the analyst on Snowflake, which actually reported earnings on the 2nd of March. And the stock actually dipped quite considerably on that day. And that was, again, part of the overall market sell-off before the rebound we saw on the 16th of March. But overall, the company itself is still growing considerably. For those who don't know Snowflake, this is a company that essentially is a data warehousing and cloud-based analytics company that competes with behemoths like IBM, Microsoft, Amazon Web Services, Oracle, again, are all these legacy technology names that Snowflake competes with. But the company itself has got a unique technology. It actually allows flexibility for users, primarily large enterprise customers. They have about 30% of the Fortune 500, which is a good thing because these customers generally offer low churn rates. In other words, once they deploy a software like Snowflake's in their business model, they're apt to or reluctant to actually discontinue using it. But the thing about Snowflake is it allows flexibility. In other words, it's agnostic in terms of the storage. It can be utilized across multiple public and private clouds. But the other thing is it decouples computing and storage. And this is actually a value proposition for enterprise users because it allows them flexibility to choose their respective needed vendors as well as storage providers that can be separate. So that's a unique feature of Snowflake. Now, if you look at the analysts that have been covering the stock, there is quite a variance. If you look at recently, Atlantic Equities actually started Snowflake with a neutral rating at $240, but yesterday, BNP Paribas actually downgraded the stock to underperform from neutral, and they brought their target from 220 to 190. Now, 190 is actually the lowest price target by analyst consensus. The high is over 500, and the median right now is 325. So there's a huge variance in the analyst estimates in the next 4 quarters for Snowflake, and I can certainly see why. Now, the company is growing considerably, but its growth rate is decelerating. Last quarter, its product revenue on a year-over-year basis was up 102%. The other thing is this net revenue retention ratio was up 178%. So that gives you an idea the company is actually selling more and getting a lot more dollars spent by existing customers versus new customers. That's what you want to see to expand the projections for EBITDA margins. But the company at the same time, despite that phenomenal growth, is guiding 66% for product revenue in 2022, which is certainly lower than last year. But at the same time, the valuation on a multiple basis from price to sales is quite high. If you look at the price to sales on a trailing basis at around 57 times, on a forward basis, 35 times, that's still considerably lofty. And that's why I think the analysts have such a wide disparity. Growth is still very phenomenal, respectively, but at the same time, valuation is still rich compared to the price. And maybe we'll see a multiple compression both on a price to sales basis and perhaps on a price to forward earnings basis before the stock eventually finds a tradable bottom.
Right, yeah, and I think people were really excited about Snowflake expanding that partnership with Amazon Web Services. They'll be able to forecast demand and things like that. But I'm glad you brought this one to us, and it seems a little bit, you used the word variant, right? Really has a little bit of a wild card feeling at the moment. Nice to see you, George Sillis. Thank you for that. The disruptor to keep an eye on.
Sure, Nicole.
Thank you. Coming up next, our panel takes a look at Bitcoin, cryptocurrencies. What do you need to know before you jump right in? Let's find out what the big trends are in crypto next on Trading 360.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to wait for it.
I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com to all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Stock and Stocks Index futures products are lower on the open, and to begin the last trading day of the first quarter, the ES back below 4,600. It's down by about 0.25% after a strong weekly jobs report, personal income and spending data that was mostly in line with expectations. And as investors and traders gear up for tomorrow's more closely watched monthly jobs report, the Dow's back, well, it's kind of hovering around 35,000. Recently back below. It's down by about 0.3%. The Nasdaq's down by about 0.25%. Now, as the ongoing war on Ukraine and a more hawkish Fed and inflation concerns weigh on risk appetite, again, indices lower today. The White House is set to announce the largest release in the near 50-year history of the Strategic Petroleum Reserves. It's expected to again, well, they did announce some 1 million barrels per day for 6 months will be released, a total of 100 million barrels. If so, the third time the U.S. has released reserves in the past 6 months. It's expected to come in conjunction with the IEA. They're calling for an emergency meeting on Friday with Australia, New Zealand, and Japan. Spokesperson for the IEA said the amount of the potential collective release has not been decided. Today, OPEC announced plans to increase production targets by 432,000 barrels per day through May 1st. You have the WTI trading just under 104, down by 3.75%. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Petalides.
Welcome back to Trading 360. Thank you, Ben Lichtenstein, for that report. It's time for our 360 round, live from the New York Stock Exchange. We want to focus on crypto. Is Bitcoin the king of crypto, and for how long? Let's get into some of the details. And Konstantin Anisimov is with us, COO of CEX.io. Konstantin, thank you so much for being with us. So I'll start with, when we think of Bitcoin, some people think it's so obscure, but you're able to use Bitcoin to do travel accommodations, to buy real estate. A lot of companies are starting to accept it. It seems to still be the king of crypto. What say you?
Hi, Nicole. Thank you very much. And I would agree with you. Yes, it's definitely the largest cryptocurrency out there by market capitalization, and also, I would say, by the number of people that hold it. However, there are many others that are within the crypto community are very active, and there's a lot of innovation going on with the other blockchains as well.
Such as?
Well, for example, a lot of different L1 and L2, what's called L1 and L2, so but built up from the ground up new blockchains, which allow for to solve for problems like power consumption of the Bitcoin mining. So those blockchains use a different technology called proof of stake, which is much more energy efficient, and that addresses some of the concerns of the Bitcoin mining, as an example.
And when we look at where Bitcoin is, I mean, even this morning we saw some volatility. One of the traders said, "Oh, look, quick, you know, Bitcoin's cratering." It wasn't necessarily cratering, but he saw a quick move, and he wasn't wrong, because it was down almost 2% in a fast moment. It's come back since then, but these are very volatile. They do have an element of risk. Which way do you think Bitcoin could go? I mean, people talk about Bitcoin 100,000, and we're well off the highs that we saw last November. Tell me your thoughts on the direction of Bitcoin. Are you a believer?
I personally, myself personally, I am a believer, and the reason why I am a believer is because my first degree and education is engineering. So I trust numbers and I trust logic. And one of the things about Bitcoin is it's one of the few assets in the world, probably one of the, maybe one of the very few assets in the world that has limited supply. And if the demand stay, then the price has to go up in the long term. That doesn't mean that the volatility is not going to be in the medium to short term, and it doesn't mean that it won't drop considerably. However, if people still keep trusting it, and it is the most trusted blockchain as the store of wealth, store of value, then the demand has to stay the same or keep going up, and the supply is becoming less and less. So the price long term, I believe, should go up.
Right. I know you've spoken of Coinbase as a way to expand internationally. I mean, a lot of people were really excited when they had access to BitO. There's other ways to do this with Ether and Binance and Litecoin and whatever. You can get Square. What's the way to go here? I mean, I'd love to start with some of the bigger names like Coinbase and BitO.
Yes, I'd say if somebody who wants to try out cryptocurrency and wants to get into cryptocurrency first time, look out for the trusted regulated exchanges. If for this audience in the US, they would normally hold an MTL license, money transmitter license, in a specific state of residency of be it a corporation or an individual. There aren't that many. We are one of those. CXO is one of those licensed and regulated exchanges. And you've mentioned Coinbase. There's quite a few more, but the list is probably, my guess is 10 to 15 names.
Okay. And last, certainly not least, on March 9th, we heard from the Biden administration as they move forward with an executive order, signing an executive order. And we saw some excitement in the trade, right, where Bitcoin jumped about 10% on that day. I know we've had volatility since then. What does that mean? Does it just bring the regulatory clarity that people were waiting on, Konstantin?
I would say so, yes. I think I wouldn't say it brings the clarity. It's not where we want to be, but it's a very important step where the US administration is essentially saying, let us all work together and bring clarity for regulating crypto in the developed world, at least. And one of the things that a lot of our clients and future clients, prospective clients, which are hedge funds, for example, are commenting on is that in order for them to get involved in crypto directly and in a much bigger capacity, many firms would require federal level regulation in the US. the similar things happening in the EU with the micro regulation, and this executive order is essentially, I would treat it as a very assertive nudge towards getting to that level.
Yeah. Wonderful to chat with you. Thank you so much. I'm glad we were able to have you on a day where we really saw some big moves in Bitcoin as well. But as you said, you're a numbers guy and you're a believer. Konstantin Anisimov, CEX.io. Thank you. Thank you, friends, for being with me here at Trading 360 every morning at 11 a.m. Eastern Time. I'm Nicole Petalides. I'll see you at 2. Fast Market is next.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. Select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
Good afternoon, traders, and welcome to Fast Market. I'm your host, Tom White, and we've got a great show lineup for you today, including discussions and example trades in Apple, which broke its 11-day win streak yesterday, and Salesforce.com, which is still down over 30% from its all-time high last November. And like Folio, will break down consumer sentiment data on Coinbase, which was initiated at a sell rating this morning. Now, 2.5 hours into the trading day, stocks are mixed as investors wait a drop in oil prices as the Biden administration announced a massive release of crude from the U.S. reserves to fight inflation. Today marks the last trading day of March and of the first quarter, and stocks have rallied in the second half of the month, but are still headed for their first negative quarter in 2 years at the start of the pandemic. Now let's take a look at the 4 major indices. I did say they were mixed, but they're mostly down. The S&P 500 down nearly 0.2%. Dow Jones Industrial Average down 0.34%. The NASDAQ 100 down 0.2%. The only major indice in the green is the Russell 2000. The small caps up just minimally. But to help me break down the market action, let's bring in my co-host for the day, and that's going to be Nathan Peterson, Director of Derivatives at Schwab Center for Financial Research, and Alex Coffey's joining us in the first block, the host of Next Gen Investing right here on the TD Ameritrade Network. Welcome to the show, guys. Alex, I'm going to go to you first. Pretty flat day, not a lot of volatility, not a lot of movement into the end of the quarter here. But we've had a lot of headlines news, whether it's economic data, the release of 1 million barrels of oil a day from the strategic reserves by the administration. Your thoughts on the market action here today?
Yeah, Tom, I think it's interesting. You look at the market, obviously it's been a year of pretty extreme moves. You look at how we started 2022, we make a new all-time high in the equity markets, and then we basically go straight down for the better part of 2-3 months and saw some pretty vicious volatility. NASDAQ entering bear market, Russell as well. Then the S&P is a little bit stronger relatively, but for the most part, just tremendous destruction under the surface from companies that aren't those mega cap tech firms to what was a very, very impressive rally over the past couple weeks and also very extreme rally. You're talking about 17%, I believe it was, in the NASDAQ 100 in a very short period of time. You saw a complete cratering of implied volatilities, things like the VIX going from the low to mid 30s to under 20 in a very, very short period of time. And of course, what's been very extreme macro headlines. I think for the first time now in 2022, it's almost ironic that it's as we're closing quarter one and moving into the next quarter, that we finally have found ourselves in this place of equilibrium or tension for the time being, where buyers and sellers seem to be in far more agreement that we're in a place in the near term where prices are more reflective of the uncertainty. And I think that's why you're seeing a lot of intraday chop, but on balance, we're not really going anywhere.
Yeah, it seems that way. Pretty uneventful session so far. Don't have a lot of earnings events either. We had Walgreens Boots Alliance this morning. But Nathan, if you look at the risks to the market here, I listed some earlier today. I was talking about them, the risk to the markets, whether it's the Russia-Ukraine war, it's the Fed policies, it's quantitative tightening that's going to be starting, and it's the Fed in general. What's your outlook here for risks for the market? Because we've had a pretty good snapback rally here in the last couple of weeks.
Yeah, we certainly have. I think the risks are known. It's what you're talking about, quantitative tightening. It's this hawkish Fed. It's inflation that we're still kind of a question mark. Has it peaked? What's the trajectory of inflation from here? We saw PCE prices basically came in line with estimates, but still at 40-year highs. At 6.4%. With the war situation, of course, that is also tied into the inflation situation in terms of the supply chain issues and what's going on there. So that's also a known risk. I think the bullish case for the markets is really that the consumer is strong, and that yes, the Fed is hiking, but it's doing so for the right reason because the economy is strong, and a lot of these inflationary pressures are going to be alleviated through the Fed tightening and because of the supply chain release, or at least that is the hope that the bulls have going forward. So, we'll have to see what happens as we move into the Q1 earnings season here coming up. But I will say this, very impressive rally off the March 8th low. But guys, we reversed right at a spot where you would not want to reverse if you were looking at this from a near-term technical basis. And what I mean by that, as you've got the NASDAQ that ran up into the 100 SMA and turned around. The NASDAQ 100 ran up into the 200 SMA and turned around. The S&P ran up into that 4,600 resistance level from which it hit 2 times in February. We're slightly below that right now. And then lastly, the Russell looks like it wanted to break out above 2,100. And then last 2 days, we pulled back below that. So, at least in the near term, technically, we're encountering some of these resistance levels. they could turn into bull flags, but let's see what happens from here.
Yeah, just the parabolic move that we've seen in a lot of the major indices. And you did mention that I've been watching the NASDAQ pretty closely. It did starting to fail at that 200-day moving average right now. Does that become a big point of resistance here for that particular sector, which is still down about 8% so far this year? But Alex, Nathan mentioned some of the data points here. Let's go through what you saw out of the PCE. Ex-food and energy up 5.4%, the highest since 1983. The headline number was above that. But when you look at the preferred gauge of inflation that the Fed follows, is this just a warning signal or is this just expected? We've got crude oil trading $104 a barrel. Prices are going up across the board for everything that the consumer wants to buy. Your thoughts here on some of this data today?
Tom, I think it's important to acknowledge that the Fed is a slow-moving, almost if you imagine it as a ship, it's a giant cruise ship. It's an aircraft carrier. It's not a little speedboat that makes quick shifts. And the reason I say this is we started seeing signs in the data points as early as June, even before that of last year, that was saying, hey, inflation's going to be an issue. And the Fed, it took them until the end of last year to realize that, or at least acknowledge that they realized that, and ultimately start implementing tightening policies just as recently as December, when they started to scale back their purchases. And then in March, we've started this liftoff. So I'm actually looking far beyond what the inflation data says, because the Fed sort of told us what they think the inflation problem is and that they're going to do something about it going throughout the rest of the year. You see it in the dot plots, you see it in their projections. We also see in their projections, Tom, that they're not worried about the job market. They see a stable unemployment rate going out 3 years. Of course, any real surprises, be that positive or negative, could change those trajectories. I actually, within that component of personal income and outlays, was most focused on the actual PCE component, personal consumption expenditures, or as some see it as personal spending. And this is actually somewhat contrary, I think, to Nathan's point that the consumer is strong, because you're actually seeing signs now 2 days in a row, both in the third revision to GDP that shows consumption coming down quite substantially in terms of its growth rate, and also in this report, which goes back to February. So if we're starting to see signs of spending or inflationary impact on the pocketbooks of everyday consumers take place before we even pull liquidity from the system, that's not exactly a great situation to be heading into for the rest of the year.
Yeah, we did see that pullback, and actually savings rates went up, so maybe people are kind of preparing perhaps for some semblance of a recession or at least a slowdown in growth. The Atlanta Fed GDP now is actually negative. I saw that Liz Ann Saunders had referenced that earlier today on Morning Trade Live with Oliver Rennick. But if you look at the moves in crude oil, Nathan, now the administration's coming out, going to pull 1 million barrels a day from our strategic reserves. That's equates to about 5% of the daily need that we have here in the U.S. We're the largest consumer of crude oil. What are your thoughts here? Is this just a political play, or is it going to negatively, affect the price of oil where it goes back down? Because we're up from the lowest point that we saw before the open.
Right. Yeah, it's tough to ascertain. I mean, we're certainly seeing, some pullback from that. Oil's still in an uptrend, and this is something obviously that's tied directly to the consumer, not just the consumer. It goes into everything. It goes into, transportation, logistics, all of that. So it's certainly one of those key barometers that you want to keep an eye on. And if you're the Fed, what you need to see is some of these leading inflationary indicators basically turn over, or at least you could say oil is off its high, but we're also in that seasonality period where oil typically bottoms in February and then peaks in August. So we're in this kind of this boom that people have been talking about. That's also helping keep oil up there as well. I also saw the EIA report, the crude inventories report from yesterday. Yesterday was about, the drawdown was maybe 3.25 million versus a 1.02 million estimate. That was the largest drawdown in 7 weeks. So there's no signs of, that basically abating there. But yeah, Natural gas is another one. Natural gas looks like it wants to break out to new highs. We've heard what's coming out of Germany there. So I guess oil is exceptionally important to the consumer and to the economy. And then into this whole inflationary discussion, you want to see oil get back down below 100 and really get back down towards that 90 level. You want to see natural gas turn around. You'd like to see more resolution out of Ukraine and Russia, of course, or at least moving in that trajectory. But these are some of the leading indicators that you want to take a look at, because the Fed will have an excuse to not be so aggressive if they can point to some of these leading inflationary gauges that are showing some softening, or that they're moving in the other direction, or at least that we peaked. That they can use that as their argument as to not being so aggressive. So that's what you need to keep your eye on.
Yeah, you did mention that uptrend that we're seeing in oil over the last 4 or 5 months continues to find support at that 50-day moving average over the last several sessions and last couple of weeks here. And I had this feeling as long as the Ukraine-Russia conflict continues that they're going to be buying dips in crude oil. Maybe we start seeing lower lows, but right now we've got some good support levels here for crude oil, which will play into that inflationary pressures. But Alex, you mentioned the consumption component of some of the data that we talked about. And Kevin and I have been hitting on this for like the last month where, hey, maybe these high inflationary pressures are going to help correct the inflation theme that we're seeing, where if people pull back on spending, demand kind of wanes a little bit. That's going to only help the month-over-month numbers. But if you look at some of the consumer names that reported earnings this week, whether it's Five Below, RH got hit. The CEO was out there banging the table and saying, hey, Fed administration, you've got to do something. But you're starting to see the consumer pull back on maybe some of their purchases.
Yeah, and I think this is an important point, but it's not necessarily a good reason for prices to start coming down. I'll explain why. First off, to your point regarding and asking the question about the strategic reserves being released, well, I'm not going to get into the politics of it or whether or not it was the right way to go. At least it's actually addressing a problem, which the problem right now is we have shortages of supplies. Yeah, obviously we have a strong demand component, and if prices go up to some extent, Tom, you're going to see a curtail in demand. But that's where other government action or even easing monetary policy kind of artificially inflates that demand, and again kind of starts this spiral of kind of self-fulfilling inflationary stories. The issue right now, Tom, is we have shortages of supplies in semiconductor chips. We have shortages of supply in energy products. We have shortages of supplies then, therefore, in things like fertilizer, which is increasing prices there. So then if you're a farmer, you're faced with the decision, do I spend more for fertilizer, or if I can't, I don't use the fertilizer, therefore I get, a less yield on the crops that I grow, which means there's then a shortages of food, which increases the prices there. So it's this spiraling loop, Tom, that creates more and more of a problem. And the issue now is we're kind of caught between a rock and a hard place. As we kept demand, maybe rightfully so, throughout the pandemic high, by sending out money and doing things to keep that stuff in check. But the problem now is we're finally seeing those price surges, and because there was so much disruption in terms of production and so many of those products during that pandemic period, it's all kind of coming to a crescendo at the moment now. And so, you see all the signs. You see things like yield curve inversions. It's very hard to see how we're going to do this in a soft landing. And the question then is what is going to be the impact for asset prices? Is it just going to lose in terms of real terms, or is there actually going to be nominal declines where you see, actually asset prices go down?
Yeah, and one of the biggest assets out there that drives a lot in our economy is the housing market, Nathan. We had Barclays analyst came out. He cut price targets across the board in this particular sector and downgraded Pulte Homes. Pulte Homes is hitting 52-week lows here, PE under 7. Now, he says that these stocks are cheap now because they've pulled back so significantly. But with an unclear picture on the health of the economy, the inflationary pressures, That's why they're basically, kind of downgrading this segment. They're kind of late to the game because most of these stocks are down over 20% so far this year. But when you've got a 30-year mortgage rate approaching 5%, and it was at 2.9% a year ago, that's also going to price people out. And it's a big driver in the markets because a lot of people have their assets in their homes, right?
Absolutely. Yeah, that's been one of the bright spots from the wealth effect to see, home prices last reported, up 19%.
Right.
As of January, really impressive. If you're a home builder, you've got to be a little bit concerned, like Alex was mentioning too, one of these kind of quandaries that you have the rising input prices that you're seeing. So, can I pass that along to the consumer? And then now we have mortgage applications that we've seen basically drop for the last, 4 or 5 weeks here, suggesting that those higher rates are affecting the end user. So, home builders aren't, asleep to the fact that, hey, home prices are at all-time highs. Here's not where we go all in terms of trying to, even if they can get the supplies, let's not even forget about that, go out there to produce these new houses because they would like to see a little bit more stable environment there. So, yeah, you have those rising costs. And so if you go back to the charts where before 06, 07, 08 and looked at the home builders, they telegraphed basically the move in the housing market, what happened there as prices tend to come down. If you look at 2022 and you look at a lot of these home builders, that they're down, they've been in this steady downtrend all year to date. Are they kind of portending what's going on within the housing market? We haven't yet seen it so much in the data, perhaps. We've seen it in the mortgage applications, but I've been pretty surprised to see how healthy the demand is out there for the housing market still with what's going on in the whole economy globally.
Yeah, there's no inventory out there, Nathan, that's for sure. I actually just purchased a house, and it was like going to the dentist. It wasn't a fun experience because there's nothing out there right now, and home prices, as you mentioned, the numbers that just came out, up 19% as a whole sector across the country as far as prices going higher, and that demand element is still there. But the input costs, Alex, are really elevated at this point, whether it's lumber, it's it's drywall, it's copper, anything that you're buying to put into a house equates to higher home prices because everything's up a third to a half of what it was in 2019 as far as costs going in. Your take on this sector, and I know this guy's late on his call, right? I get it. And Nathan mentioned the mortgage applications. The refi is down double digits for 3 weeks in a row. Nobody wants to refi because, mortgage rates are going up, and they probably refied a year ago when they were still low. But your thoughts on this sector downgrade, basically?
Yeah, it's an interesting one because from the standpoint of the actual house building company or the builders, you look at it as, okay, they have a very big advantage right now, Tom, which is the fact that there's just not a lot of inventory or supply, and there's still a tremendous demand for a place to live. For many, it's the biggest investment they have, their greatest asset in the sense that that's where the bulk of their wealth is isolated. And so whether you see that as a liability or an asset remains to be seen, and I think it's different for different people, but it's still where the bulk of the majority of Americans and those across the world keep their cash or their money. It's tied up in their home. And so in a time of low interest rates, you could see it financialize as the refinances allowed them to, basically pull money out of their home in many ways, and that's been able to you've been able to utilize that wealth effect of increasing prices of homes to your advantage. In a time where that's off the table, and potentially the higher interest rates price out the new first-time home buyers or the potential, marginal demand that's down the road out of the market, or at least put them in a lower bracket of that market, it makes things a little bit more dicey in terms of how it projects. But for now, because supply and inventories are so low, it's hard to see how quickly things are going to crack, even in the event that things do turn a little bit more sour for the economic picture, Tom, just because if there's so little supply, that's the main input, the main input in terms of how much a home price is going to be. If you have only one house on the block for sale, it's going to sell for a lot more than if all of them were for sale.
Yeah, the analyst did mention that valuations have come down significantly in this space, even though home prices or at or near record highs across the country. But, you know, if interest rates are going up, they have massive backlogs too. So, you know, I always think, like, if people start piling on to an industry like this, eventually they're going to be wrong because, you know, maybe somebody's sticking their neck out here, taking advantage of these pullbacks, because if you look at historical valuations for a lot of these companies, they're at the low end of what they normally are on a historical basis. But one of the stocks that's done really well over the last couple of weeks, Nathan, has been Apple. Just yesterday, broke an 11-day win streak, longest since 2003. The stock's basically back to flat on the year, but this was a big, substantial parabolic move, and it didn't seem like anything was coming out besides a few analysts kind of pounding the table on their price targets. Dan Ives from Wedbush that we have on all the time, he, you know, has kept his price target the same, but they just come out with notes that says things look good. But then I'm hearing out of Digitimes today that they're pulling back maybe some production on the iPhone, AirPods, the iPhone SE, and pulling back some orders for components. Your take here on this parabolic rip that we've seen in Apple over the last 2 weeks?
Well, you know, I think Apple's just been seen as a safety trade. I mean, they are, look, they have a war chest of cash. They did announce, you know, the hardware as a subscription as one of the potential revenue streams they're looking into. Demand has seemed to be healthy, that we know that there's supply chains within there. But I think the move that we've seen basically coming off of the low from March 8th, that tells you everything you know in terms of where investors want to put their money on the rebound. It's just perceived as one of those safe haven type plays with the tech exposure within there. But they are expensive. They did kind of run up into that 180-ish or so resistance level there. If they can, you know, I've heard Dan Ives comment on that's the hardware subscription service. If they can continue to expand more growth and justify their roughly 30 PE or so, then perhaps the stock can hang in there. But, you know, within AirPods and iPads and iPhones and everything else, I mean, consumer discretionary, yes, everybody loves Apple, but perhaps you're not going to upgrade as often or look to go make those purchases with inflation doing what it's doing in terms of denting disposable income for the consumer.
Definitely, and this ecosystem that Apple's built up, Morgan Stanley's Katie Huberty came out with a note, pretty positive on what the average person spends on not only the hardware but the services side of the industry, slightly less than $1 a day. And hey, I just got hit with something on my app store that I'm subscribed to through that, and I get those a couple times a month, Alex. So it seems like the revenue streams are there for this this company, but inflation will hit everything, right? If you're paying X amount to fill up your car at the gas pump, does that equate that, hey, I'm not going to get that new edition of AirPods this quarter?
It might, Tom, but I always think of Apple, excuse me, almost in a way that it's its own stock index. And the reason I say that is you think about all of its businesses. I think you can make a strong argument that the iPhone itself, their primary revenue driver, is a consumer staple product. So be it the iPhone or an Android device, the majority of Americans, I think, carry a smartphone because of how integrated their work, their social life, maybe their hobbies, all of it may be integrated into that device, that handheld device. And Apple being the primary, deliverer to the market within that market here in the U.S. with their iPhone product, of course, that's going to be a crucial component. But to Nathan's point about the upgrade cycle, and I don't even necessarily think that it's just tied to economic activity. Simply, I consider myself somewhat engaged in the tech world and understand things, but I can't tell the difference anymore between iPhone 12 or 13 or 14 or whatever we're on and the next edition. The technology has just gotten so good. The cameras are so good now that it's such a negligible difference that I'm not as excited about the new product. Ultimately, though, down the line, if I break mine or it becomes such a difference, I will upgrade it. But Apple's noticed this as well. So they're integrated in the financial world. We have the Apple Card up there that they partnered with Goldman Sachs, and of course their Apple Pay. They're within the fitness world with things like the Apple Watch. They're in the content space with Apple TV Plus. You go down the line, this ecosystem that they've created has made them a discretionary, it's made them a tech firm, it's made them a consumer staple. It's made them just about everything you can think of, And that's why, if you throw in the fact that they carry the massive war chest of cash, that this is a safety trade for so many, but there's also growth components to it too. It's almost the best of both worlds for investors.
Right.
They feel like they're investing in the future, but they also feel like their investment is somewhat relatively safe because of Apple's position in the markets. And so if we look at a trade in a second, Tom, it's going to kind of combine all this together.
That's a great point because, people kind of, the people that bash on Apple a little bit say that historical, valuations for this company are higher than what they used to be, right? But at the same time, they've got many more growth drivers moving the stock forward. And I think that's the reset that a lot of investors that used to think that, hey, this should be trading at a 15 PE and it's double that now. Well, have you seen the growth of this company? It's an ecosystem that they've built out. But you've got an example trade for us here, Alex, that you kind of did. Implied volatility's come down quite a bit, but it seems like the stock over the last couple of days starting to consolidate after that rampant move to the upside over the last 2 weeks.
Yeah, we've just had a tremendous realized volatility in the sense of the 11-day winning streak off the lows. Apple, for the most part, was pretty resilient throughout the down move, outperformed tremendously many of its peers, and for all the reasons that we described. And so with this particular trade, it's a 4-leg trade, so transaction fees are a little bit higher than some of the other trades we look at. But setting that aside and just looking at the concept behind it, I'm selling an iron condor. And so first key point, it is risk defined. In the event that you do see some type of market volatility inducing event that sends everything lower, we are protected to the downside. But also in the event that Apple does continue higher, we are protected from some tremendous rally that break out to the upside. However, throughout much of this year, Apple's actually been the most range bound of many of its peers. Its ebbs and flows have been a little bit more subtle. And so we're looking to play those ebbs and flows. If it's just the kind of constant back and forth market at tension environment that I'm describing, you could anticipate that buyers in their comfort of Apple will step in if this stock moves lower. And at the same way, as we approach those all-time highs just under 183, maybe you see sellers come in and actually put a bit of a cap on that. And so the idea here was selling the 170 and the 185 call and put, but then we'll define the risk by those $5 wide legs. We're only going out to April 22nd, Tom, because I believe the earnings event is slated for April 28th. So
right.
I wanted to stay ahead of that in this particular example so that we didn't have that volatility-inducing event on our trade's duration. But collecting $1.50, nearly a third of the width of the strikes, or as Kevin often talks about, 30 cents on the dollar of risk. That leaves $350 in risk, break even of 186.50, which is above the all-time high, and then a break even below of 168.50, which is relatively, modestly below where we're currently trading, about $8 lower. And in a stock like Apple, if it's moved down $8, you can anticipate that the market itself is likely moved down as well.
Yeah, about 22 days till expiration on this one, risking $350 outside of the 190 strike on the upside and below the 165 strike on the downside. 3-week trade, collecting $150. Alex mentioned those break-even points. Nathan, just wanted to get your take here on, real quickly, on the Iron Condor as basically a neutral strategy where you just want time decay or positive time decay or theta to take hold and maybe a continuation of falling volatility.
Right. So, I mean, it's obviously, yes, you're taking advantage of theta there. And basically, by identifying those levels like Alex done, 185 and 170, you're basically saying within the next 3 weeks, I expect Apple to trade within this range. If so, I'll get my maximum gain here. It's about a 3-to-1. I like that he's not going to the earnings event. That could always create some extra volatility there, although you do get extra IV typically. With Apple pulling back around that 180 level, this is the third time. Alex mentioned that 183, I believe, is the all-time high. But this is the third time it's done that. So I like the way he positioned that 185 strike. And then going down to the 170, there may not be a support level right there. We got the 50-day at 166. But given the buoyancy in the snapback of this rebound and the tendency, remember, after we had the Oscars, Apple came in, it was down $2. It ended up closing higher that day. This is kind of speaks to that buoyancy where the market kind of wants to send. So I think you could probably feel pretty comfortable at that 170 level with about $7 to the downside. But neutral strategy, as you said, keep it between 170 and 185 for the next 3 weeks. We've got also a holiday in there as well with the weekends to assist with the time decay. So I like the strike selection. I like the setup.
Yep, and avoiding that earnings event, which could cause some additional movement and volatility. All right, great stuff as always. But thanks to Alex Coffey, the host of Next Gen Investing, which is coming up after Fast Market right here on the TD Ameritrade Network. But coming up after the break, Nathan and I will be joined by Landon Swan from Likefolio for a discussion on Coinbase. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host for the day, and that's Nathan Peterson. But let's bring in our next guest for our cash tag segment, and that's going to be Landon Swan, the co-founder of Likefolio. Welcome to the show, Landon.
Hey guys, good to be here.
All right, good to have you here. So we're talking Coinbase. I always look at Coinbase, and then I usually overlay a comparison chart with Bitcoin. That's basically what I do. We've seen a lot of commentary on this name. Jim Chanos from Kinnikos Advisors, he's shorting the stock, and then you've got other people that are bullish on Bitcoin that love the stock here. It's pretty bifurcated as far as your assumptions on this. It's down 24% this year, Landon. What kind of data are you guys seeing in Likefolio?
Yeah, so this is an interesting one. This is one that we were pretty bullish on a couple of years ago, and things are turning a little bit. And I think there's, the Likefolio data is supporting a bearish case on Coinbase, and there's some other things that I think that are a little bit more general that would support that as well, and I'll get into those. But when we look at just overall growth, they are lagging behind Square, they're lagging behind PayPal. When we look at happiness, again, they're lagging behind both of those. And even though they've had unbelievable growth over the last couple of years, I think that you really got to look at some of these factors. I mean, look at this happiness decrease. They're at 2017 levels when it comes to happiness, down to 58%. That's pretty low for an exchange or for a custodian, whatever you want to call them. And so I'm concerned with that. And again, their revenue numbers and their growth has been unbelievable. 144% year-over-year growth in 2020, 545% in 2021. They went from losing money in 2019 to 3.6 billion in profit in last year. So they're crushing it. They're absolutely crushing it. But when you look at just kind of how they're operating and the space that they're in, there's a difference between a company that like TD Ameritrade that holds your stocks for you and that goes by the book and is regulated, and that's what you want. Crypto is a totally different animal. And when you think about the kind of people who are, leading edge when it comes to investing in cryptocurrencies, having a really large company sort of oversee and make judgment calls and do things like that, it kind of goes against what crypto is. While this chart's up real quick, crypto's exploding. I mean, look at all these numbers. Paying with crypto, trading, investing, selling, all those numbers are tremendous growth year over year. So crypto is not going away. They're on the right side. They've got a rising tide. But I think that they may be a victim of their own success a little bit. So when you think about, again, the type of person or the type of entity that's investing in cryptocurrency, it's a little bit more in favor of deregulation and outside the box kind of finances, decentralized finance, that kind of thing. But when you get as big as Coinbase has become, then they start making decisions like they recently blocked 25,000 accounts that were Russian or possibly suspected of doing wrong things. And I think it rubs the cryptocurrency community the wrong way, because the idea here is that cryptocurrency is off the grid. We're not part of the system, right? But then you have a custodian that's just saying, you know what, those accounts are out. And that's not how cryptocurrency is supposed to work. It's kind of goes to the old saying, if you don't have the keys, it's not your coins. And if you have cryptocurrency on Coinbase, you don't have that currency right now until you withdraw it. So I think it makes people a little bit uneasy. I will say that our score, they're not reporting right now, but if you look at what our score would be if they're reporting, they're at a negative 91, which is a really big number. It can only go down to 100. So everything's turning downward. The happiness is a big indicator, big drop in happiness. I think some of it has to do with the decisions that they made around those individual accounts and making people uneasy. But then also the fact that the purchase intent, while it's doing well, and again, they've grown tremendously, they're far behind their competition, and their growth is slowing while cryptocurrency is booming. So I think it might be in the wrong industry to be a huge player in cryptocurrency, because I think people in cryptocurrency want the small guy or they want the decentralized guy. Love to hear your thoughts, though.
Hey, Landon, this is Nate. So curious on that happiness factor. So how much of that is, I don't know what goes into that component, but three things come to mind. And I think first about the fees. And I've heard from, other people that are in the crypto space that they are relatively high. Customer service, I have a crypto wallet at Coinbase. Customer service is non-existent. It's gotten a little bit better recently. And then thirdly, how much that happiness is tied to the actual price of Bitcoin, meaning if Bitcoin's at all-time highs, then all of a sudden they're happy and they love their provider. So what kind of components go into that happiness measure?
Sure. I don't think the price of Bitcoin has a lot to do with it. We take out bullish, bearish, that kind of thing. We're looking at people talking about the service itself. But I do think the fees are a big factor. I mean, if you look at what it costs to trade equities on a platform like TD Ameritrade, it's basically zero, or it is zero. You look at, want to go on Coinbase and buy a Bitcoin, you're going to pay $60, $70, $80. It's ridiculous how high the fees are. I mean, it reminds me of 1999 in the stock market when people were charging that much. So this is very early in crypto, but I think the fees are way too high. And I agree, there is no customer service. So they've gotten a little too big, and I don't think that they can support the number of clients that they have, and B, I think that they're now becoming one of the type of institutions that crypto is supposed to go against. These really big bureaucratic companies that are going to make decisions not based on that are going to make decisions where they're banning accounts, they're blocking accounts just because of something that's happening geopolitically. They shouldn't do that. I mean, they should just be neutral. They should say, hey, if you want to trade crypto, this is where you trade it. And that's it. They shouldn't get into the mix of all this stuff. And I think they're hurting themselves PR-wise with that. And then, of course, the fees. I agree, Nate. That's going to come down as competition comes up. But I think that it's, people are somewhat nervous thinking, well, this is a really big company and I'm holding a bunch of coin in it. Maybe I should pull it out to my hard wallet, my cold wallet. That's what I've done personally. And I think a lot of people are doing that.
Now, with that, some of that data, you mentioned only 58% positive on that, but then you hear all the mentions, your other chart on this, Landon. I mean, is the pathway for Coinbase, once they get their fees in order, the competition's already heating up from Block, from PayPal, from anybody, right? And there's more coins that are probably going to be publicly traded down the road. I mean, they're like the first in on this particular cycle, and it seems like the mentions are just exploding across the board. There's got to be some semblance that, hey, Coinbase might be the last one standing, because I remember, you know, other stocks in different sectors or areas, it's the same thing. Once they get their footing, everything starts to work out.
Sure, and they have a huge first mover advantage. I mean, They are by far the leader, and they're the most trusted. I mean, if you go up to somebody and who's just got into cryptocurrency and you say, where did you buy? The answer is almost always Coinbase. That's the first one. But I think as you get a little bit more advanced, I mean, think about the demographic that's trading cryptocurrencies. They're out there on all kinds of platforms. They're doing all kinds of swaps and whatnot. I think Coinbase is the on-ramp. And then as users get more advanced, they start to drift out into other things. And Coinbase is defending that by adding a lot more coins. They're adding NFTs. They're taking the right moves. But I do think that they may be in a position where they're a little bit too big, which is weird. There's almost no other industry where being big is a bad thing, but I think cryptocurrency might be one of those. They've got to really hammer in the trust. They've got to show that they're neutral and they're not going to step in and do different things with accounts. They're just going to let accounts be accounts, which I think they should do. They are, like I said, they're jumping into a lot of these other coins that people want, some of the altcoins. They're getting into NFTs. So they're making the right moves, and they have the strong user base to support it with that first mover advantage. So I like where they've gotten themselves to. I worry, though, based on some of the decisions they've made and some of the just the general way that people think about cryptocurrency as being small, decentralized, and neutral, if they're putting themselves in a position that goes contrarian to that, and that may drive people off into other areas. So great, love the on-ramp, love the fact that they're the leader. It's a rising tide. They got a lot of things going for them, but their growth is slowing and their happiness is very concerning.
Happiness is concerning, and maybe that has something to do with Kathy Wood out there buying 385,000 shares this week. People seem to like to fade her on a daily basis at this point. All right, great stuff as always, Landon. Appreciate it.
All right, have a nice day. Thank you.
All right, that's Landon Swan, co-founder of Likefolio.com, giving us the negative data, Nathan, minus 91. I don't think I've ever heard that out of Likefolio as far as the sentiment data that they gather. When you look at this stock, and we've got a comparison chart of Coinbase overlaid with Bitcoin, and they're highly correlated at this point. Now, kind of diverging here a little bit. On the candles, you've got Coinbase stock, which has fallen from those $590 highs the day that it opened publicly for trading. But Bitcoin kind of moving higher and Coinbase still down. How do you want to look at this for an example trade based on what Likefolio has as far as their sentiment data?
Yeah, and I'd say real quick, Tom, that divergence is kind of telling. When Coinbase came public, they provided three financial guidance scenarios based on where Bitcoin was trading, because of that transaction fee being a percentage basis tied directly to the price of Bitcoin. So when it first came out, it was really tracking that like a laser. And now it's kind of diverging, meaning it's underperforming. Bitcoin just made a year-to-date high this week, and Coinbase is still down 20% for the year or so. So, you know, if you look at the analyst estimates, they've actually been coming down. It was about $6 for their forward EPS about 90 days ago. It's $3 now. I think this speaks to Jim Chanos's thesis that competition's going to basically eat into this transaction field that they have. You know, stocks used to cost $300 to buy. Now they're zero. So we can kind of see where the trajectory of that is heading. So if you had a bearish thesis on Coinbase, and by the way, you know, they did get it back above their 50 SMA, but they look to be in a trading range of basically 150 to 210. But pointing out that they are beginning to diverge from the price of Bitcoin. What happens if Bitcoin goes down? That's going to make it even worse for the stock. So if you had a bearish thesis on Coinbase, I was looking at something like out on the May 20th expiration. Just do a simple bear put spread, $30 wide. buying the 190, selling the 160. And when I looked at the time, it was about $10.50, $10.80 to put that on. So basically a 3-to-1 ratio. But you really, I think, Tom, when you position yourself in a name like Coinbase, you have to have some kind of fundamental thesis about the company and the trajectory. You're either bullish or bearish. You believe in the NFTs, or you believe that the transaction fees are coming down and that's going to hurt the stock. And then you also probably want to tie in some kind of outlook of where you think Bitcoin is going, since there is that correlation.
Right. It's currently trading where you're buying the May monthly 190 strike put, which is slightly just at the money, selling the 160 strike put, paying roughly about an $11 debit for that. It's $30 wide. It can expand to $30 if it goes back to those 52-week lows or those all-time lows of $150. So risk-reward setup looks good on this one, Nathan. That break-even of 179 is where you're profitable at expiration over the next 50 days or so. Your final thoughts on a bearish put vertical on this, because implied volatility has come down because Coinbase has rebounded over the last couple of weeks. So you're getting in at a cheaper debit.
Yes. So, their earnings, I haven't seen an official earnings date. It's probably going to be somewhere in May. But if you look at how they've reported, even when they beat, their guidance has always kind of provided some kind of softness, and the stock has not performed well. So if you're putting on a strategy like this and you see the earnings date comes up with before the May 20th expiration, then you may not be worried about that as well. We'll see if that affects implied volatility when they announce that earnings date. It could be after May 20th. But the other option, I would say, you could put on a bear call spread, so you can have time working for you. But again, you want to keep your outlook for the price of Bitcoin in mind. If Bitcoin rips, it's likely Coinbase is going to rip with it.
All right, great outlook here for this example trade based on the data that we got from Likefolio on this particular trade. You do have the what you pay for that, $11 basically, $1,100 per risk per spread with transaction costs, no commissions on that for that bearish position. All right, great look at Coinbase based on their data. But coming up after the break, Nathan and I are going to take a look at Salesforce, which is down over 30% from its all-time highs last November. Fast Market will be right back after this short break.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. Keep an eye on rates into the close as we head into the end of the first quarter and pull back from the March highs. The TNX topped out at 2.5. It's back to 2.3. Yields have come off some the last few days as the futures have rallied back. Bonds to 150, 4 points off the lows from earlier this week, and supported by benign inflation data earlier this morning. As of recent, here in the U.S. for the most part today, personal income and spending mostly in line with expectations. The core PCE month over month actually inched lower. Tomorrow the jobs report and the wages component will be closely watched. The TYX is at 2.44. The TNX is holding just north of 2.3. With rates coming off, gold is getting a lift for the third day in a row after testing below 1,900 earlier this week. We're back to 1,950. Futures sold off when Russian negotiator Vladimir Medinsky said they plan to pull back troops and that talks with Ukraine had been constructive, but it was short-lived. The shelling continued. A reminder, a ceasefire was not part of the agreement. Medinsky said he would bring the Ukraine proposals to Putin's attention, and a meeting was possible. Gold up $8 on the day, or 0.4%, with the U.S. dollar higher as well, a reflection of how many traders believe actions speak louder than words. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market with Tom White.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host for the day, and that's Nathan Peterson. Nathan, we're talking CRM, Salesforce, down about 15% on the year, over 30% from its all-time highs that we saw last month. These cloud-based stocks, Nathan, were some of the first ones that got hit as tech kind of sold off from those highs that we saw in mid-November. But yeah, I look at this stock, is it inflation-proof? Companies, will they pull back on CapEx spending where they're not going to use as much CRM in Salesforce as they used to? I think the opposite, that corporations have to kind of get on the tech bandwagon, and this company continually buys up competitors and reaches out, whether it's buying Tableau or Slack. They integrate it into their systems right away. They're always looking for new companies to buy. Your take here real quick on Salesforce.
Right, yes, a stalwart blue chip cloud name in the company. You've got that ARR that's working with Salesforce. The TAM is still there. Tom, probably the question is, there was a lot of pull forward because of the pandemic as businesses realized they need to get basically to the cloud and, make adjustments to accommodate their employees. So the stock is down quite a bit. I will say this, technically, it's pulling down. It was in this downtrend for about 3 months since its last earning report in November. It's broken out of that, and it's consolidating just above its 50 SMA. So technically, it looks good. Valuation, we know, is a little bit high, but because of their status and because of their growth rates, it's not high on a relative basis. So technically, it looks pretty good. This could be one of those names that you could see money come back to because it's that higher quality type of technology name, a leader within the cloud for sure. But they've gotten caught up with a lot of those cloud and software names coming out and the valuation coming into light, and people getting really scrutinizing guidance and how much the growth rate is and whether it's justified, but looks to be stabilizing here.
Yeah, and Mark Benioff, the CEO, came out with some positive commentary after their earnings at the beginning of March. And one of the things that stuck out to me, the recent partnership with Ford, making the new F-150 Lightning a mobile office based on a lot of the technology that Salesforce uses. So he's pretty positive, and he typically is on his conference calls. Implied volatility is about at the median of its 52-week range, so you still have some elevated volatility like we do in the overall market. You mentioned it's now above that support level of the 50-day moving average after being in a death cross for about a month and a half here, still far below its 200-day moving average. But the example strategy I wanted to look at, Nathan, was to take advantage of that higher implied volatility, because I think if the overall market pulls back, maybe Salesforce does also, we don't know. But I wanted to give myself a cushion for maybe a neutral to bullish type strategy for this example. So I looked out at the April 29th, a weekly series. So you're giving yourself basically a month in this example trade where we're going to sell an out-of-the-money put here, and it's going to be the 205 strike put. You can collect roughly about a 410 credit on that cash secured put, where it's a twofold type trade. You either want to keep that option premium that's elevated, or you're comfortable with owning the shares at a lower price point. And in this case, if you sell it for 410 on the April 29th weekly 205 strike put, you're basically buying the shares at $290 as your break-even point. And that 200 area will probably be a support level at this point. Your take real quick here, Nathan, on selling a cash secured put. If you want to own the shares, but if it stays above 205, you're fine with just keeping option premium.
Absolutely, yeah. So you got, basically a $9 cushion, as you mentioned, at $4 and change there. You're looking about a 2% yield between now and April 29th. Earnings aren't until May, so you're going to miss that. The stock has broken out of a downtrend and it's kind of stabilized. It's chopped, like I mentioned. The 50 SMA here is at 210, which is above that 205 strike. So yeah, if you have that belief that, hey, it's been really trying to form a base here, it's gotten out of the downtrend, it wasn't a head fake or doesn't appear to be, it's consolidating with the 50 SMA. Should I believe that this will continue, then here I've made a stance where I'm going to make 2% by August 29th if it remains above 205. If not, you're also implying that you're okay buying it at that 200 level, like you said, Tom. So yeah, it's a good way to have time work in your favor here for the next couple of weeks.
Yeah, and I think traders and investors that maybe want to buy a stock that's been beaten down, selling cash secure puts in a higher implied volatility environment allows you to collect more option premium. And as you said, you have to be prepared to buy these shares if you hold that short put through expiration and it's below the 205 strike on this. But your break even, just under 201 on this particular trade. But great look at an example where you're taking advantage higher implied volatility while giving yourself a cushion. You're still taking a directional bias on this type of example trade also, but you're neutral to bullish. So you do have some cushion, some room to the downside. All right, great stuff, Nathan. Thanks for joining me today.
Thanks, Tom.
All right, that's Nathan Peterson, Director of Derivatives at the Schwab Center for Financial Research. But stick around right here on the TD Ameritrade Network. Next Gen Investing is coming up with hosts Alex Coffey and Jenny Horn. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CNE Group, where risk meets opportunity.
Happy Thursday, everybody. Good afternoon, and welcome to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, I said it yesterday. I'm going to say it again. This week has flown by. The month of March has flown by. First quarter, bit of a dragger, but I would say we finished strong.
First quarter actually expected to close out lower for the first time in nearly 2 years. So that is a milestone, at least, not maybe the most positive one, but we are seeing the four major indices lower today. We are seeing Some weakness in the markets, which is not necessarily a new tune, but it is the last day of March, so we will be able to see some of the best and worst performers once the session closes. But as always, we will get to our upvote and downvote segment. Following that, we will chart and trade our upvotes, and we will look at our FOMO stock of the day. Today, that is in ticker symbol PATH, that's PATH, selling all following their fourth quarter earnings. Then we will discuss the importance of financial literacy. I sat down with Carrie Schwab-Pomerantz to dive more into that discussion. And last but not least, we will look at Nokia, seeing sizable volume today, Alex. And we also got news that Cowen named Nokia a top European idea. So more on that name coming up later.
Very interesting list. Looking forward to it. We got upvote, downvote on the agenda for now, though. Some heavy hitters here today.
Some heavy hitters, yes, and our first name is one where the video we often play always makes me hungry, and it's around lunchtime here in Chicago, so this is a fun one, and that is Chipotle. Now, Wedbush reiterated its outperform rating on Chipotle, saying it sees same-store sales growth upside for the stock. They believe that Chipotle is actually poised to accelerate their market share gains in a post-COVID environment, resulting in sustained growth above pre-COVID levels. They also said that you could see expanding premium relative to its pre-pandemic valuation. Now, Chipotle is higher today, as you can see there, the stock moving to the upside of our four names, but has fallen about 8% year to date, but is pacing to close the month up about 6%.
Yeah, having a nice last couple weeks, nice morning here today. Interesting note out of the Wedbush analyst. This is one that we talked about quite a bit. It's always kind of on our minds, both as consumers and also from a stock trading standpoint. One of the few big stock price names that's going to be still out there after you get the split from Amazon, Alphabet, and maybe even Tesla now. So it'll be interesting to see how things play out there on that front. But I'm going to say downvote here today, Jenny. Just a little bit less liquid than some of the other names we talk about because of that bigger stock price. Bigger volatility too. You got a little bit of a heightened near-term volatility in this one with a $19 market maker move going out for the rest of the week, indicating that some of that short-term volatility is higher than those further dated volatilities. So we'll see how things shape up.
Yeah, a hefty price tag on that stock, and one that has a very loyal consumer, as I always see lines nearly out the door at Chipotle pretty much any time of day, which is always remarkable to me. But our next name today is Microsoft, another huge name in these markets. Morgan Stanley reiterated Microsoft as overweight, calling the company one of its most preferred names in that software space. And the analyst said that the first quarter of their CIO survey again showed that Microsoft's strength with widespread leadership across key growth and defensive categories is really something to note. They also said they see further improvement in its cloud positioning. As we know, its cloud presence is one of its most notable aspects of its business, but it really has its hand in pretty much everything. This is a company that operates in so many different aspects of that tech world. The analyst also said a combination of their durable growth and reasonable valuation keeps Microsoft as one of their most preferred names in software. Very positive note, not seeing such a positive move today, down about 1%, but it has recovered a little bit as you're looking at a lot of these big tech names, Alex, nowhere near their November highs, but down only about 7.5% year to date is far better than they were about a month ago.
One cannot understate the importance of Microsoft for the overall market, and so for that reason, I'm going to say upvote, but I also think this chart's quite interesting. I'm going to see if Rick has his eye on the same level that I did looking at Microsoft, and I think it's going to be a fun conversation.
I do too, and you always forget, I always forget Xbox, another huge company that stands sort of on its own that Microsoft owns. So it just goes to show really its reach pretty much everywhere involving tech. Our next name, another huge name, arguably one of the biggest names, that is Amazon. Wedbush kept its outperform rating on Amazon, saying its most recent survey checks show it's still, quote, the king of e-commerce, which is no small title. They said that accompanied by category strength, the firm continues to see strong consumer spend, with Amazon being the leader. And now, also, according to reports, we had separate news today that Amazon has renewed a deal that will allow JP Morgan Chase to use its flagship rewards credit card. This is a pretty big deal because Amazon has been in heated discussions with other issuers like Amex and Citigroup for months now. Now, Amazon's Prime Rewards card is one of the industry's top co-brand deals because of its scope of its loyalty program. It's enormous. It has about 150 million U.S. members. So no small deal for JP Morgan, but obviously, Amazon is one that we always keep on our radar. It has fallen about 1% year to date, but similar with the tune that we just discussed with Microsoft, has recovered fairly well this month, up about 7%.
Yeah, meteoric rise in Amazon stock price as of late. A little bit of a pullback here today, which is out of sync with these strong positive words from the Wedbush analysts. So to say downvote for that reason, but one could argue Amazon not only the king of e-commerce, but also the king of cloud. So hyper important company, one we always keep our eyes on, but a downvote today.
A downvote today, and our last name is BlackBerry, so different than the names of Microsoft, Amazon, but maybe once was some kind of king of tech. King seems even like a strong term, but BlackBerry was once the reigning smartphone maker and has since been sort of crushed by Apple. But they have earnings today after the bell, and the street is forecasting losses per share of about 3 cents, which would be a 200% year-over-year decrease on revenue estimates of $186 million, which would be down about 13.5% from last year. Now, this company did top estimates back in third quarter, but issued soft guidance, which has been sort of a concern for a lot of investors. They operate in now two of their most powerful segments being cybersecurity, as well as the Internet of Things, which we saw that segment actually surge 34% in the third quarter, but cybersecurity revenue fell 1.5%. But more notably than that, their licensing and other revenue fell 77%. The company said this was due to negotiations regarding the scale of their non-core portion of their IP patent portfolio, which is a process they admitted is taking much longer than expected. They essentially sold all of that non-core legacy patent business back in January for $600 million. They are offloading these patents, which we've discussed actually with George Tillis, how that is a good majority of their business now, because we were once wondering sort of what they do now without that phone, as they did actually drop pretty much all of their phone sales back in January. So they said goodbye to the smartphone and are moving on to hopefully bigger and better things. But I would say that 77 nosedive in their licensing revenue is one that maybe analysts are hoping for a recovery this quarter, but we will get more on those numbers this afternoon.
Massive implied volatility, very low stock price, interesting chart, all the recipe here pre-earnings for an interesting conversation. I'm going to say upvote.
Upvote, and one that we definitely need more on the technicals. And, you know, BlackBerry, also a meme stock, which we can't even forget the importance of that, as they have seen a lot of short interest as of late. But to tell us more on both of our upvotes today, those being both tech names, Microsoft and BlackBerry, is Rick Ducat, TD Ameritrade Network contributor. So, Rick, we'll start with the bigger of the two, definitely maybe more, I would say, popular of the two as it stands right now, and that is Microsoft. Microsoft, one that is very powerful, has fallen this year, but is looking fairly better.
Yeah, it's definitely recovered a bit since the lows that we were seeing before, but we're still down about 10% off our yearly highs. The implied volatility in this name in the lower third of its yearly range, so a bit on the lower side. We're seeing about 162,000 options traded today, 60% in favor of calls. The biggest trade I saw, the largest single trade, was selling 1,009 June 19th, 310 calls at a $16 credit. So if you factor in the credit received, this trade needs Microsoft to stay below 326 to make money. But the options are actually already in the money, and then they're vulnerable to assignment risk now.
Yeah, super interesting, Rick. Looking forward to the Microsoft conversation. But for now, give us the preview here on BlackBerry as well. Pre-earnings look.
Yeah, BlackBerry is another interesting chart here. We had the meme stock kind of craze earlier in the year, so that kind of throws everything off. But we're up 27% since the yearly lows on February 24th. If you factor in how much we were down, though, that's, you know, less impressive. Implied volatility, relatively low, but you have to consider, once again, we had these very large values earlier in the year, so that is a bit of an outlier. Notable strikes with this Friday's expiration for earnings. The call side, 8, 9, and 10. Very large open interest in all these strikes. And on the put side, 7 and 750.
Not so surprising to see that uptick as of late, Rick, as we have seen such a surge in interest in those AMC, GameStop, meme stock names. But sometimes you just have to wonder sort of why. There hasn't necessarily been a huge news catalyst behind that move, which is not unusual for the meme stocks, but definitely worth diving into the technicals more. Coming up next, we'll be discussing Microsoft as well as BlackBerry. Rick will be sticking around. Alex and myself will also be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate tdameritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. We're still joined as well by TD Ameritrade Network contributor Rick Ducat to go through some charts here. Jenny, on the upvotes, we got Microsoft and we got BlackBerry. At one point, they were both very, very influential companies. Now, one is still very, very influential on the overall markets and the world, and one less so.
Yeah, Microsoft has really stood the test of time because they were once very successful both at the same time, but as you can see how trends have changed and evolved, and Microsoft's really push into this cloud space seems to be its bread and butter and a lot of its success story. And Rick, this is a name where I would say pretty much everyone's familiar with Microsoft Offices, Microsoft Word, Excel. They are very integral in all of our lives, but it also operates so many other segments of tech, with their Azure cloud being one of the biggest clouds out there. So a big name, a huge presence in the markets, big impact on the equity markets. Lower this year, but seeing some degree of recovery.
Yeah, and it's finding itself in an interesting kind of middle point right now, I thought, looking at the chart, because we're kind of right in between some important support and resistance. And we also stopped within the past couple days right at the gap that we saw from the earnings event on October 27th. Alex and I were talking about this just before the show, about how interesting it is when stuff like that happens. But I decided to include Keltner channels today on our chart. And this is a study that's similar to Bollinger Bands with a few kind of key differences. Bollinger Bands uses a simple moving average to create some channels for price. Keltner channels uses an exponential moving average, and it's also based on average true range rather than standard deviation. So they kind of do a similar thing, though. They show us the whether volatility is expanding or contracting, and gives us some points where price is at a relatively extreme level to its own history, and then you can make the decision, do I go for a mean reversion trade or a continuation trade? So looking at point A here, We are crossing above that upper Bollinger Band today. We also saw that the Bollinger Band slope switched from being downward to upward. So those are typically both regarded as being bullish developments. We saw for a long time that price was riding that lower band and trending downward. So this is a pretty good about face here that sent us all the way back up to the other end of this range. Looking at point B, to the upside, if you were thinking you were more bullish, this is probably an interesting point to watch because this 344 level is a triple top at near the yearly highs. So that would be a key point for the bulls to try to overcome to send us into some new yearly highs there. To the downside, we had a similar support level near the 280 mark. So we saw the lows near September, October, and then several other points that we did go through it a bit before, but it was only mostly on the intraday aspect here of the price movement. So 280 is another level to watch. Finally, looking at our momentum here at point C, momentum is still bullish. The MACD crossed above the MACD signal line crossed above the 0 line recently. That's a bullish signal. Not really rising anymore though, so a bit of a slowdown to the upward momentum, but the overall picture you can still argue is probably bullish here.
So Microsoft may be starting to stall a little bit after what was a pretty solid month and a pretty solid week. Shares have gained about 2.5%, but you highlighted that 280 level as potentially an area to watch if looking for support. So say, Alex, we're taking perhaps maybe a more contrarian stance that you say you look at Microsoft's activity over the last few weeks and even this week and say perhaps things might start to slow.
Yeah, and so I think this is important because Rick's talking about the overall picture. A lot of analysts have a 1 year or 6 month horizon. I'm looking at this in the case of all that, can't discount anything that Rick said, anything analysts have said. I'm just solely looking at this massive move higher and where it ran out of momentum. It's not a surprise, and it's not on accident that we ran out of momentum here. If we pull up the chart real quick on the platform and take a look, where we ran out of gas was right to that gap that Rick had highlighted, and also where there's a lot of overhead supply in the case of Microsoft. And so if you just see a breather in the case of Microsoft and a little bit of a subtle move lower, what possibly could happen is that the overall trend still stays intact, yet you do see a downwards move. And so what we're looking for here is just a little bit of a move lower on this particular trade. And what we're looking to do is just go on a couple weeks. We're staying ahead of the earnings release, which is in the later part of April. And we're just going to the April monthlies. This is the 317.5, 302.5 put vertical. And we're looking to spend about $550 for this. So if we spend $550, that makes our break even $312. Well, the stock's a little bit below that already, so it's a bearish strategy. It benefits from a move lower, but our break-even's at or higher than where we're currently trading. And I think that's important to note because you think of bearish, you think of strategies, you think that you need something to happen. In this case, we just need that to happen to be profitable. We don't actually need something to happen in order for us to break even. So I think that's an important distinction. If the stock does continue to rally and it rallies through 317.5, which is above that place where it ran out of momentum just before, we would be at risk for our full debit. If we flip over to the chart here, you're going to see what I was talking about. That line representing this point back in October around earnings, corresponding perfectly to where we ran out of space. So if this is a near-term top, also corresponding to where we ran out of momentum in February, we only need to move down to some of this area where there's tons of activity in the lower 300s to be max profit. So we're not asking for much here, you know, maybe a 3% or so decline, and this could be max profit.
So very much unlike our next name, which is BlackBerry, we don't need a ton of volatility for this trade to be successful. We need it to hang out around that $300 level or sort of stay right around where it currently is. I think that's important to know, as you don't need huge swings all the time when you're making options trades. But our next name is one that is a friend to volatility, and they have earnings this afternoon. Rick, that is BlackBerry falling over 20% year to date, but also just has, I would say, some negativity surrounding it, being that they sort of have an identity crisis with them offloading their smartphone business back in January. But earnings is obviously an event where we see a lot of premium, a lot of activity, and this is a meme stock, so there's often a lot of activity in BlackBerry.
Yeah, that's true. I was surprised to see how much trading activity we saw in this name for it being a, $7 stock at this point. But the chart actually looks pretty similar to the last one we were at, in that we're kind of in the middle of both an important upside point and an important downside point here. But starting with point A, where it's a bit more extreme, though, I would say. We had this very long slide downward, riding along the lower Keltner channel band, and then we did another quick reversal, and we're now riding the upper band more as price advances. So the momentum is also showing a bit more of a bullish situation. We had a bullish crossover recently. The signal line is crossing over 0, but we're not really seeing that momentum is increasing anymore at this point. So perhaps a little bit of a slowdown there, but because we're on the verge of earnings, anything can happen either way. We don't really know what's going to happen in this report yet. So I thought it was useful to highlight both an upside point and a downside point for this one. So for starters, point B, 950 has been a frequent point of support and resistance for most of the past year. This is often a point where price topped out or bottomed out. Old support becomes new resistance and vice versa. And we can see that most recently we had another of these double top style price patterns. So that's where we are with the 950 level. To the downside, check out point C. Right around 580 we had a double bottom. So the mirror image of our double top here. Price bottomed out at one point, then it bottomed out at roughly the same point again down the road, and then bounced a little bit. So we have some pretty clearly marked areas to keep our eyes on going forward here. And remember, too, that the more often a point like this is tested, the more significant it becomes.
And as we know, the earnings season, particularly in these tech names, has been very unforgiving. So they have to report pretty strong numbers, guidance, a lot of enthusiasm to meet these streets' very high expectations. So thank you, as always, Rick Ducat, for your thoughts and all of the technicals on both Microsoft and BlackBerry. Now, Alex, when we're trading BlackBerry, earnings is sort of what we're trading around, being the catalyst. But a name that is a friend to volatility, sees huge swings pretty frequently. It also has a ton of volume and, like Rick pointed out, just a good amount of liquidity when looking at options.
Yeah, low stock price, so accessibility. Liquidity means, at least if that holds, it's easy to get in, potentially easy to get out of trades. A ton of volume and activity means that there could be some excitement around this. You talked about implied volatility. While relative to itself, as Rick has highlighted, is low, relative to the overall market is like 5 times higher. So still a high volatility asset, despite the fact that it's certainly seen higher volatility in its days. But I was looking at the chart, a 5-year chart going back, and it's almost like an EKG, just how like it's up and down, but we've gone absolutely nowhere in 5 years. We're like exactly where we were 5 years ago. And so that is something to consider when looking at this. For the trade itself, what I looked at was selling a put vertical. Thought about just looking at a cash secured put, but in the case of something like BlackBerry, while it would still be somewhat cost effective because the market maker move was only like 85 cents to 90 cents, if you're short term enough, those out of the money options decline in value so quickly that you can actually do a put vertical and you're not giving up all that much of the credit received. And so in the particular example I looked at, if we flip over to the Analyze tab, I looked at the April monthly, so gave ourselves a little bit more time. And the April 14th monthly, the $7 strike put, the $6 strike put to round out that risk, collected 30 cents. So we talk about 30 cents on the dollar being sort of a loose guideline to get that risk reward parameter somewhat in the range that we like to see it. 30 cents means we can make 30 bucks, 70 cents in risk left over means we can lose $70 if this stock gaps down and stays below $6 to the downside. Break even is $6.70. Which is pretty close to that market maker move. The stock right now is trading about $7.40, $6.70, so you're looking at about a 70-cent difference. The market maker move like 85 cents, so a little bit inside of that. But most importantly, I think this is a unique chance for us to explain some of these strategies in a very accessible name, one that has liquidity, volatility, in the sense that if someone was willing to risk $70 to make 30 using some of these concepts that we talk about, this candidate presents that opportunity around an earnings event in a name that is $7.
Yeah, that's a really good point. We talked about how Chipotle actually has that sort of high price tag, so oftentimes higher capital needed. This name's so different, $7.38 right now. falling about 2.7% on the day, which could make it then, I would say, maybe an easier trade to swallow if you're looking at this ahead of earnings, just being that it has that low price tag. But that does it for this segment. Coming up next, we'll be talking ticker symbol PATH, falling on the day pretty sizably, seeing outsized volume following their fourth quarter earnings and guidance that pretty sizably disappointed.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Welcome back. I'm Alex Coffey alongside Jenny Horn. You're watching Next Gen Investing here on the TD Ameritrade Network. It's time for FOMO. We're talking UiPath. Stock ticker is PATH. I got to be honest, Jenny, it's the first time I've encountered this company.
I think me as well, and I learned a lot about this company this morning, particularly because it's making a sizable move lower, which is how it caught my attention following its fourth quarter earnings, which were released Wednesday after market close. Now, if robots taking over the world is something that frightens you, this company might frighten you a little bit, because the CEO is actually quoted on their website saying that Bill Gates used to talk about a computer in every home before that was normal. He wants a robot for every person. Now, this seems excessive because I don't exactly know what a robot would do for me all day, Alex, as I'm pretty boring. But hey, I respect the vision. However, it seems like execution seems to be missing a little bit here. This is a company that is focused on building the best robotic process automation software, or RPA software as they call it. But they did report weaker than expected outlook, which overshadowed the fact that they actually did beat on both top and bottom line in the fourth quarter. Now, they fell over 7.5% yesterday and have continued that nosedive since releasing these earnings after hours. But we saw yesterday's close, which was roughly $29 a share, which sits now 48% below their IPO price of $56 a share when they went public back in April of 2021. Now, for the fourth quarter, losses totaled $63 million versus the net income they actually saw of $26 million a year ago. Revenue rose to almost $290 million from $208 million a year ago. And now ARR, which is a significant metric to track, often used by software as a service companies to show how much revenue can be expected based on projected subscriptions, rose 59% year over year. Now, this is interesting to me because typically earnings and guidance is something, it's numbers that you already have. So I would say that ARR seems like, does this actually matter to the company? Clearly it does, as it's used by other software as a service companies, not just UiPath. But it does seem interesting to be banking on subscriptions you don't yet already have. That was something I thought was unique. Now, additionally, UiPath said their chief revenue officer is leaving the company and a former Microsoft executive is actually taking over. So potentially a positive there. Now, following these earnings, we saw analysts at Credit Suisse, RBC Capital, Wells Fargo, BMO, Oppenheimer, and Mizuho all trim their price targets. But I would say things were a little bit cautious because all of those analysts actually kept their ratings, some of which had a buy rating, so it didn't seem like they were fully committed into a potentially bearish stance on this company. Now, another thing, when I was reading about this company, Alex, because I saw they're obviously newly public, they've only been public about a year now, is they greatly expanded during the pandemic. On January 31st of 2020, the company had about 6,000 customers, and this showed that in the year of the pandemic alone, they were able to grow their customer base by 33%. So a lot of these software companies and tech companies we saw grow very sizably during the pandemic. We have seen some weakness this year, down about 50% year to date. So that's pretty painful. But I do have to say that even though we're saying they saw widespread adoption during the pandemic, it wasn't Zoom-like levels of adoption, just a slight surge, 33%. And it seems as though they haven't really been able to hold on to that.
Oftentimes, companies that are very futuristic in the pitch are a lot more binary than something that's already very established, like a consumer staple. And so what I mean by that, and of course there's countless exceptions, is companies like this either cease to exist or there's significant returns on capital. So patience a lot of time is the name of the game when it comes to these things. Probably explains why many of the analysts are hesitant to cut their rating, as they still maybe believe in the plan that this company has or the outlook for its prospects going forward, but acknowledge there might be some near-term hurdles. And so I think the fear of missing out in this particular case is likely to the upside. It's not that you're going to miss out on picking a company that didn't make it. There's certainly that could be for some, and there's certainly strategies that could look to profit on that. But this stock's gone from 90 to 20. Much of that erosion of stock price has already taken place. So we're going to keep that in mind. And so I wanted to approach it in sort of this, in lieu of this recent information, or taking that into account, but also thinking about the concept of risk. And so oftentimes when you'll see a major move around earnings, so think of something like Netflix, made a massive move lower, it really hasn't recovered from that. There's been volatility, it's traded a little bit above it, it's traded a little bit below it, it's chopped around. It almost establishes a new price range. Always exceptions to this as well. But if we think of that as sometimes that's what happens, and if we apply that logic here, whereas maybe in the long term we want to be invested in this name, maybe in the long term or even the medium term we're scared of that upside risk in case something's a big breakthrough or something happens and it causes the stock to shoot higher. But in the near term, there's a ton of volatility, and maybe it just kind of bounces around this level. How can we use that to our advantage? And so what I looked at was a skewed call butterfly. And so it's very similar to how an iron condor or an iron butterfly would perform in the sense that it's a somewhat range-bound strategy here, Jenny. It consists of 4 option contracts, 3 different strikes, in which we're buying 1 in the money at 17.5, selling 2 out of the money at 22.5, and then buying 1 at 25. So what have we really done here? Well, we bought 1 $5 wide call debit spread. That would cost a debit. And then we're selling an out of the money call credit spread, the 22.5, 25 one time, collecting a credit. And so on balance, because we're buying a bigger call debit spread, it costs a debit overall. But where this net debit lines up in this particular illustration is very important. It's $2.50. That's exactly the width of our call spread to the upside. So we have no upside risk at all. The risk would be if it goes through 25, this stock or this example trade would just break even. 22.5 is perfect in terms of best case scenario, is right to our short strikes. But if you add that 2.5 to 17.5, it gets a break even of 20. So the break even is slightly below where we're trading, and we have a profit window between $20 and $25, where the closer it is to 22.5, the more profitable this can be. This is one that takes advantage of volatility maybe declining, and also one that looks to take advantage of that thesis I laid out, where sometimes after earnings, we've just established a new range. I know the stock's gapped down, but it doesn't necessarily mean it's going to recover overnight.
Yeah, and that's something we've actually seen in the nature of this earnings season, where a lot of these names where you think, we joked, it's the catch the balling knife scenario, where you think stocks cannot go any lower, and they've proven that they can either hang out range bound at these new lows, or they can go even lower, which is always a risk. But looking at this trade, we are risk defined both ways. And I actually saw that according to Benzinga, they have seen 18 uncommon options trades today due to high volume and volatility. And we're seeing a split actually between these trades, 72% bullish and 27% bearish. So the momentum in this name today from a trading perspective is fairly bullish. Maybe people looking to get in on some of this downward momentum. But I mean, that is always interesting to me when people are pouring into this name on this day when there's a lot of volatility and feeling fairly positive, I guess, Alex.
Yeah, it's a good point. And assuming many of those option trades are actually buyers of options, that's going to keep that implied volatility elevated, which gives us an advantage when looking at this kind of trade.
Yeah, I mean, it's a brutal intraday chart as you're seeing shares down almost 28% on the day. So a lot of times, I will say in defense to UiPath that they are still a relatively new company. They've only been public for about a year. It's not completely uncommon to see with these new names, to see these big swings, or in this earnings season for that matter. But there is a question of really their business model going forward. And a question I have to say also that I actually read a report that they're planning on automating the workforce. And that is a little bit scary because I would like us all to keep our jobs.
Yeah, there's a lot of things that are going to be interesting coming down the pike. Of course, I don't want to project or think about what that's going to be, as a lot of it's unknown. I will say, though, for a new company in this tremendous volatility and sell-off, it's an $11 billion company. There's just so many billions out there that you just hear about, and you're like, never even heard of UiPath, and $11 billion company that's come down by over, 75%. So that means at one point it was like a $40 billion company.
Yeah, that's ridiculous. Actually, when you think about all the billions and billions and billions of dollar companies out there, it will sort of blow your mind. But that does it for our FOMO segment today. Now, coming up next, we will completely switch gears. We will be talking financial literacy. I previously sat down with Carrie Schwab Pomerantz to discuss a very important topic, one more people need to learn about.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I'm going to take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I'm Jenny Horn, and I'd like to welcome back Carrie Schwab Pomerantz, the Managing Director at Charles Schwab and the President of the Charles Schwab Foundation. So as always, thank you so much for joining us today, Carrie.
Thanks for having me, Jenny.
So April is Financial Literacy Month, so very topical time to discuss this. And I wanted to start by knowing why financial literacy is so important to you.
Because the lack of financial literacy contributes to so many social issues we see in our society today, Jenny. For instance, people don't really realize the correlation. The lack of financial literacy affects college access. We know from studies that young people who have financial literacy are more likely to go to college, or workforce readiness, which is such a big topic right now. Right? There's such a talent war, but it really does affect whether some people will get the job of their dreams or not. And financial literacy to me is all about financial security. It's foundational. And yet if we all were to have financial education, financial literacy, it would be a great equalizer for our society.
I completely agree, and I wish I had all the access to educational tools that I do now, or I even knew about them so many years ago, because it does feel like you cannot start young enough. And that brings me to the question of what we can do to really help kids make these smarter money choices.
So financial literacy starts at home with the parents and the conversations at home. Allowances are a great way for young people to learn the value of money. Budgeting, you learn how to live within your means. And of course, saving and investing and managing credit and debt is so important to building wealth and security. It's all about demystifying financial literacy and finances with the young people. And also make sure that you have equal conversations with your daughters as your sons. What we have found, even to this day, that parents will talk to their daughters differently than their sons. With their daughters, they talk about savings and budgeting and household expenditures, which is super important. But with their sons, they talk about investing and debt management, which we know are important tools to building wealth. And so the bottom line is we want all our children to have financial security.
Absolutely. And I do think it's such a shame that stigma still exists, but of course it is something that we need to be aware of in order to break down. Yeah. And that also leads me to the question of why isn't financial literacy taught more in schools? Why aren't we having, more of these conversations?
Oh boy. It is a wonder. Now, today only 21 states out of 50 mandate some level of financial literacy. Now that's a good start, but unfortunately only 10% of unresourced schools have financial literacy for their kids. And that, those are the kids who need it most. And unfortunately, when it comes to educators and schools, teachers aren't necessarily comfortable with finances themselves, right? They weren't taught about it. And many schools and states are under-resourced in terms of their budgets, or teachers are overwhelmed with all the different topics that they have to talk about. So it's a lot of factors that get in the way of financial literacy in this country.
There absolutely are. And so the next question is a little bit, the $1 million question, as I think that so many are working to address this. But in your opinion, how do we go about starting to address the financial literacy problem that is in this country, but I think really throughout the world, actually?
So I remember when I was on President Obama's Financial Literacy Council, and Michelle Obama took on childhood obesity as her cause. And she rallied everybody in the country around this issue. Schools and nonprofits and employers, parents, everybody was involved. And a few years into her campaign and her work, childhood obesity went down. And so it makes me think this is what we have to do with financial literacy. We need all institutions of society to come forward and make financial education just part of our culture, a responsibility that we all need to take on. So that's what I think really needs to happen.
I completely agree. And I think having advocates in several different communities are so important. And an advocate like yourself, what's the #1 money tip that you would give to teens today?
Okay, that's a tough question, Jenny. Only one thing.
I know.
I'm going to give you a couple. Save, invest early, as soon as you can. It'll make such a huge difference in your life. And then save and invest in an IRA as soon as you get that first job. Again, it will make a big difference in your future.
Start early. It's something I hear time and time again. That was Carrie Schwab-Pomerantz, the managing director at Charles Schwab and the president of the Charles Schwab Foundation. Thank you so much for all of your knowledge today, Carrie.
Thanks, Jenny. Talk to you soon.
Jenny, thank you to Carrie. It's Old School Phone Company Day. We talked some BlackBerry. Now we're going to talk Nokia. George Tillis is going to join us right after this break. We'll be right back.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
Maria Schrader, here are a few stories to watch this hour. Guggenheim raised Roku's price target to $145 from $135 and maintained the buy rating. The analyst says data from major online retailers in the US, UK, Canada, Mexico, and Brazil shows Roku's market share is improving, especially in Latin America. However, shares of Roku are down over 2% on the day. The information reports that Qualcomm was not able to land Meta Platforms as the flagship customer for its AI data center chip. The deal reportedly failed because of the software accompanying the chips after Meta questioned whether it was mature enough to wring the best performance from the chip. Despite this, Qualcomm is trading higher today. And Bloomberg reports that SunPower announced at its Analyst Day that it is in late-stage discussions with First Solar to develop residential solar panels. SunPower's CEO said the goal is to develop a panel that will change the world. Alternative energy is continuing to take market share. The BBC reported yesterday that wind and solar made up 10% of global electricity in 2021. This has been your TD Ameritrade Network Market Update. Now back to Next Gen Investing with Alex Coffey and Jenny Horn.
Thank you, Maria. Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Let's talk some more old school cell phone companies here. Jenny, I wanted to bring in George, but we'll wait a second. We're talking Nokia. We were just talking during the break. I remember the Motorola Razr is like my first phone that I could tell you what it was called, but I think I had one before that. Maybe it was a Nokia.
The Nokia Brick was the first cell phone I think I knew that my sister and my mom had it, and then I got the LG Strawberry Chocolate, which was bright pink and it slid, and that was like the coolest tech of all time. I had that thing for years because you could like really throw it on the ground and it wouldn't break. But the Nokia reminds me of those days when you had various cell phones. They were like $100, no data, T9 texting. Those were the good old days, Alex, I have to say. Now Nokia is a surprisingly old company. It's actually a Finland company. It was founded back in 1865. but it has seen some turbulence. I mean, shares are up actually year to date, up this month and up this year, but I did see that there is an actual novel published that is called The Declining Fall of Nokia. So the waters for this company have been definitely rocky, but we got some news today that Cowen actually named Nokia a top European idea. So to tell us more on this is George Tillis, TD Ameritrade Network contributor, because George, I would have said that Nokia was in the BlackBerry bucket where it's old school tech that's trying to claw its way back, but clearly these analysts actually see some real value here for Nokia.
There is. I mean, look, I've got a Nokia phone and probably a Motorola Razr phone somewhere in some drawer in the house. But these were effectively the two phones that I started using when it comes down to text messaging. And in fact, Nokia at one point in time was the largest handset manufacturer in the world. And they were very popular. They actually sold their handset division in 2014 to Microsoft, but they actually renewed it about a year later under their original brand. Now, if you look at Nokia, it's actually the largest European telecom infrastructure company. It's not just cell phones anymore. It's a 5G equipment manufacturer, network, internet protocol. They're essentially one of the European leaders in mobile networks and, of course, network infrastructure. The thing about Nokia is overall, it's a really stable company. It hasn't done much in the last 5 years price-wise. It's been trading at a range somewhere between $3 and $6. But between Ericsson and Nokia, they're the second largest telecom provider, network providers, if you will, in terms of gear and infrastructure behind Huawei and ZTE, which actually are the global leaders. So if you're looking for something outside of the Chinese manufacturers, which ZTE and Huawei are the largest two globally with respective market share, about 38%, Nokia and Ericsson are second and third and fourth. And overall, these are two suppliers, Nokia included, that are in high demand from the European Union, but also in the United States. And they're one way, again, for telecom providers to get away from some of the issues some of the Chinese manufacturers have had in the past.
George, I love that you bring this info because if I'm hearing you correctly, this is an example of a company that was able to transition as part of their core business, fell out of favor. Maybe Nokia isn't the recognizable brand that it once was, or maybe it's just nostalgic for so many of us, but that doesn't mean that its relevance within the marketplaces has changed. It just provides a different service. It brings a different product to the table. Still a $31 billion company.
It is. And if you want to kind of compare this company to one we know of in the United States, is Cisco Systems. They're, again, the largest American network gear manufacturer and deployment of optical technologies here in the United States. This is also a core business of Nokia's. The other thing is the business is making a transition into the cloud, and this includes things like business applications, Internet of Things, industrial automation. These are other areas that Nokia is moving into. But, Nokia last year really got caught up in this short squeeze phenomenon, and I think it has to do with the fact that it's not necessarily highly shorted. In fact, less than 1% of the shares are shorted in terms of the total float. It was nostalgia. It got caught up in that BlackBerry phenomenon, which had a higher short interest than, of course, Nokia. But based on the price of the stock, it got pushed up quite a bit. Now, Nokia is not growing very much, respectively, year over year, less than 1%. But they do have about $8 billion in cash with a market cap of about $32 billion. So that's, again, about 25% of the market cap is cash. They're buying back shares. They don't pay a dividend. But overall, it's been a steady name. In the last year or so, it's been up about 38%. So again, it's a real business. It's got real technologies, licensing revenue, equipment revenue, as well as now cloud-based revenue. And again, it's not a highly shorted stock, but again, it got caught up in that meme phenomenon of the high short interest names earlier last year in 2021.
So, George, basically what I gather from that is that us American investors who didn't do our due diligence messed everything up, because this is a company that does have scale, just not in the United States. I think it's really important that you pointed that out. But I have a question sort of about 5G, as that rollout in the United States specifically has been very disappointing. What does that look like in Europe right now? Because obviously there's infrastructure, there's components needed to really evolve that 5G infrastructure. And are we seeing that come to fruition yet in Europe?
That's the thing. If you look at Nokia and Ericsson, both these companies, in terms of global market share, have close to 30%, and they are the largest providers in Europe. So the 5G rollout in Europe is reliant mostly from technologies from Nokia and Ericsson. They are both Swedish companies. They compete with each other. They effectively have a duopoly in the European Union. And the United States as well utilizes Nokia's technologies as well. So 5G deployments going forward, Nokia is one of the leaders globally. There's no doubt, with about 15% total market share in the world. And that's what you have to think about when you're investing in a company like Nokia. It's not necessarily a momentum stock. It's more of a value-oriented name that really is deploying stable technologies, but also is generating stable earnings per share.
George, because of the uncertainties in investment in China, things that you had talked about, we've obviously seen a ton of pressure on those Chinese ADRs. Being that this is a Finnish company, Scandinavian company, and at least for now, the relationships between America and the EU and those countries seems to be a little bit more stable than in other parts of the world. Does that in some way ease some of that uncertain risk of investment overseas?
Yeah, I think so. I mean, I think the investment overseas, I mean, you look at the Chinese ADRs in the last couple of days, and again, we're getting news about delisting worries. These are always concerns for investors who are long-term investors. And I don't think these concerns really apply to companies like Nokia. I think at the end of the day, they're basically founded and headquartered in business-friendly, westernized, legal framework-based nations, Sweden, United States, Finland, if you will. And so you have to think about that as an investor. And of course, their technologies are in higher demand by Western private sector agencies as well as the public sector.
Yeah, George, a really good point. Maybe some insulation from those Chinese headwinds, which wouldn't be a bad thing for a company like Nokia. But thank you so much for joining us, as always, George Hillis, TD Ameritrade Network contributor. Alex, we're seeing markets pretty much where we started the show. Things are lower but relatively quiet, with that VIX hanging out below $20. I mean, just barely below 20, but I'll still take it below 20.
Yeah, about as quiet of a two-day stretch as we've seen in financial markets in 2022. We'll see if it continues. That does it for us. Thanks as always for tuning in to Next Gen Investing. For more market coverage, stay tuned. We got the watch list coming up next with Nicole Padalides. For Johnny and myself, we'll see you tomorrow.
America, with American products and American values. We need to embrace all the tools and technologies that can help us free us from our dependence on fossil fuels, move us toward a more homegrown clean energy. Technologies made by American companies and American workers, so we can bolster domestic supply chains here at home and export those technologies around the world to reduce greenhouse gases. That's why today I'm issuing a directive to strengthen our clean energy economy. I'm going to use the Defense Production Act to secure American supply chains for the critical materials that go into batteries for electric vehicles and the storage of renewable energy, lithium, graphite, nickel, and so much more. We need to end our long-term reliance on China and other countries for inputs that will power the future. And I'll use every tool I have to make that happen. Yes, building a made-in-America clean energy future will help safeguard our national security. Yes, it will help us tackle climate change. Yes, it's going to help us ensure that Americans create millions of good-paying jobs for generations to come. But the most important thing my plan will do right away is save your family money. And here's what I mean. Under my plan, which is before the Congress now, we can take advantage of the next generation of electric vehicles that a typical driver will save about $80 a month from not having to pay gas at the pump. If your home is powered by safer, cheaper, cleaner electricity like solar or heat pumps, you can save about $500 a month on average. Don't take my word for it. The CEOs of 11 of America's largest utility companies came to see me at the White House several weeks ago. They told me if we pass my plans before the Congress now, typical families will see savings show up in their utility bills immediately. Costs will come down even more as we innovate and develop cutting-edge energy storage technologies, clean hydrogen technology, advanced nuclear technology, carbon capture and sequestration technologies. And by the way, this week's the benefit I included in the bipartisan infrastructure law to help families weatherize their homes are being delivered. My administration is making $3.2 billion available from this legislation to provide up to $6,500 direct payment for working-class families to be able to weatherize their homes, to save them money, to keep them warm in the winter and cool in the summer. It's a direct grant. This program has been around for a while, and in the past, it's delivered to families, average families, another $327 in savings when they weatherize. But now, we have the ability to reach 10 times as many families because of the legislation that we already passed in the legislation. In addition to that, we're also setting new standards to boost fuel economies for new vehicles sold in America. Within 5 years, we're going to travel 10 miles more on every single gallon we have because the average fuel economy of 49 miles of the gallon is going to be required. That means hundreds of dollars in savings for families at the pump. We're also setting similar standards for appliances, from your air conditioner to your microwave, your refrigerator, washers, dryers. It's just one of 100 actions we're taking to save the average family $100 per year in utility bills. Look, the bottom line is this. Between ramping up production in the short term and driving down demand in the long term, we can free ourselves from our dependence on imported oil from across the world. Look, I know gas prices are painful. I get it. My plan's going to help ease that pain today and safeguard against tomorrow. I'm open to ideas to strengthen the plan, but I will not be put off and put it on hold. It's time to deliver true long-term energy independence in America once and for all, and I'm going to continue to use every tool at my disposal to protect you from Putin's price hike. It's not time for politics. Americans can't afford that right now. So let's meet this moment together. Remember, we're the only nation that has turned every crisis we ever faced into an opportunity. We have a crisis, the price at the pump. So let's show some true strength in this nation, show our unity, our resolve, our innovative spirit in America, and come out of this long-term much better off. If we stand up to the bullies of the world, the autocrats and dictators, we stand up for those who are ready to unite with us, United States of America. So may God bless you and may God protect our troops. Thank you.
Mr. President, how badly is Vladimir Putin being misinformed by his advisors?
That's an open question. There's a lot of speculation, but he seems to be, I'm not saying this with a certainty, he seems to be self-isolating, and there's some indication that he has fired or put under house arrest some of his advisors. But I don't want to put too much stock in that at this time because we don't have
action of the news down to 100, but let's take a step back and just that granular look at the most immediate reaction to, and here you can see how we're still holding up above the lows from earlier this week. So again, the market's reaction to somewhat limited in terms of the selling we've seen, and those lows that we just looked at from earlier in the week down around the $98 level, well above the lows from earlier this month on the 15th. We were down at $93.53. So you can see how we're holding near the lower extreme of the range that we've been in for March. But for the most part, crude's been a pretty well-defined trend environment to the upside. Now, I mentioned in terms of the Biden administration putting a ban on Russian oil exports. Keep in mind, Russia is responsible for the world's third largest oil producer. Now, the IEA getting involved, so it's not just the U.S. here, Nicole. They're calling an emergency meeting tomorrow with Australia, New Zealand, and Japan. They're expected to announce, again, a collective release of strategic petroleum reserves. Here you can see crude oil, a couple pullbacks recently, only back to the 50-day moving average. You can see how we've been holding above that key level basically since the beginning of the year. Crude and the elevated prices we've been seeing feed right into the inflationary pressures the Fed's been dealing with, and, well, the rise that we've seen of prices at the pump. We've got AAA reporting that the national average for a gallon of gas at $4.24 is up from $3.60 just last month, $2.90 from this time last year. So again, and lastly, I just want to point out it'll be the third time that the U.S. has tapped into the strategic petroleum reserves over the last 6 months. And Nicole, look at what's been going on basically over the last 6 months. We're talking about, well, we'll call it September on. I mean, you can see it hasn't really pulled prices back so much. We were talking earlier in the day on the Future Show with Wayne Kaufman from Phoenix Financial Services. He talked about how this is really just an example of how we've seen terrible governmental policies and how they're really just hopping from one crisis to the other. He talked about how, again, lower prices, though, at this point could just increase demand, which could bring about higher prices as well.
Yeah, and they call it a Band-Aid, right?
Yeah,
that
it
it's
is.
a Band-Aid when they start to do a release from the SPRs, the Strategic Petroleum Reserves, because it's just a quick fix. The difference is on this one is that it's over a period of time, right? I mean, the others were sort of big amounts, but just like a one and done, which feels like a Band-Aid, doesn't it? I wonder if this one being done in a different way and giving the economy time and everything time to settle down, or if it'll somehow seem better. The VIX, you're watching the VIX in the 20 range. Bitcoin, which the traders right away noticed this morning as it was rolling lower, saying it was cratering. I mean, they see these big, very volatile moves. Any final thoughts here, Ben?
Well, I just think, again, in terms of we're headed into the quarter end, so we are going to see some interesting volatility as we head into the end of the day here today. But, the indices are rolling over at some key levels. They're starting to get back some key areas. The ES back below 4,600. The Dow still holding above 35,000, as you mentioned at the top of the show. But you've got the ES here. You can see it's been rolling over, and again, off the most recent highs up around 46.31. This is a good look at the move up that we've seen basically since mid-March. A nice run-up as we recovered, came off that 4,100 level. I want to point out, here you can see the ES, much like the other three, the NASDAQ, the Dow, the Russell, well above the 50-day moving average. And I want to point out the ES, while holding above the 200-day moving average. Again, while the Russell's still below it, the ES, the NASDAQ, and the Dow are above it. But yeah, the VIX has come off as well. And, it just seems like we're seeing a little bit of cautious optimism headed into the end of the month. A lot of focus on Russia, a lot of focus on energy prices, commodities in general, relatively elevated, and how the Fed's going to handle them. But don't forget, all of this kind of stacking up as we head into tomorrow's jobs report. I think that's going to be the next focal point for traders, for investors, as we head into the end of the week.
Without a doubt, I'll be waiting. With bated breath, I'm waiting for that report. Thank you so much. Ben Lichtenstein, host of Futures here on the TD Ameritrade Network. Now let's get the bigger picture. David Darst is with us, Chief Investment Officer at Americana Partners. David Darst, I'm so glad you're with us. You're with us on such a monumental week. This is our first week back at the New York Stock Exchange, where you and I, when you were at Morgan Stanley Wealth Management, you and I used to meet here all the time and have our smart chats. We have the end of the month, end of the quarter, and a big jobs report tomorrow. So much to discuss. How are you feeling about the markets?
Well, let me just say it's tremendous to see you on the floor of the exchange, just like our many years together. The jobs report, I think, is one of the positives, Nicole, and that's the strength in the labor market. And that's a good thing. Still got unfit jobs, The February number, 678,000 jobs. The consensus number for tomorrow is about 550,000 jobs. So really, one of the things that's an advance in the market, the March 6th lows, Nicole, has been the absence of bad things. And the absence of bad things would be the Fed being even more restrictive in its commentary. Yes, the Fed paying attention. So people have been able to see that in a positive light. Corporations, earnings comments and outlooks for the coming year, not shortfall in earnings, difficulty managing the higher inflation environment that we're in. So this has been a rally. And by the way, don't forget, Nicole, Apple, which is 8% of the stock market. Apple's gone from 150 to 177, and it has led the market up. There's been a tremendous amount of erosion beneath the surface, as you know. So you've got about 40% of the NASDAQ stocks are down 50% from their 52-week highs, 21% of the S&P 500. So there's been some erosion beneath the surface. But your point, your focus, you and Ben just now on the jobs market is appropriate. I think that's going to set the tone for the Fed's meeting May 3rd, 4th. People are looking for 50 basis points. Fine. That's, I think, baked into market prices. So for the market to advance here, we need positive things rather than what's been the driver so far has been an absence of negative things. You've got plenty of negative things going on. You got the Fed tightening. You got the economy slowing. You got profit comparisons slowing. You got the yield curve flirting with inversion, Nicole. We've talked about this for years. And, of course, the geopolitical backdrop, which has been so tough on not only the human suffering and the tragic images that we've been seeing overseas, but also their effect on food prices, energy prices, the fact that we've had to release all this, a million barrels a day from the Strategic Petroleum Reserve. So to get another move higher, it's not the Fed, it's not energy prices. It's got to be some good things rather than the absence of bad things, Nicole.
You see, that's the big difference, right? It's how we phrase those words and the order in which we put them in. Let's talk about some of your picks today, and I like how you put them into different categories. You had a defensive play, an energy play, a technology play, and an agricultural play. Let's do a couple of these. So we'll start with defensive and energy. The defensive play, you have CL, and for energy, you have COP. So tell me about these names and why defensive and energy now.
Well, Colgate is a product that everybody comes into contact with every day. They've got the #1 market share globally in toothpaste, of course. You know, they have Ajax, they have soft soap, they have Irish Spring and all that. Noel Wallace, who's their CEO, he's done a great job in terms of focusing the company on cost containment. It's got a 2.5% dividend. The dividend is very well covered, Nicole, only a 64% payout ratio. So they've raised, love this, they've raised the dividend every single year for 60 years in a row. So this Colgate is a solid, component of a portfolio, and that this is not something it's not technology. It is not a race card. It's just a solid sedan, $64 billion. And that stock, listen to this. The market's doubled since the lows of March 2020 at the height of the pandemic onset. This stock is up only 25%. Everybody's been focused on the tech companies, the meme companies, the SPAC companies, the IPOs, and they've sort of left this one alone. It's been sort of like, I don't know, a relative that nobody pays much attention to, but they're solid. And that's why we put this in the list of stocks that we want people to take a look at. In the energy sector, Nicole, you've got ConocoPhillips.
Let me say this, because I'm almost out of time. So you still have agriculture, you have Deere. You have ConocoPhillips for energy, and you have Google Alphabet for technology. Talk about one of those.
Okay, let me talk about Google. Let me tell you, that thing, that 45% increase in their cloud revenues in the fourth quarter. That thing is just a monster. And we all talk about we want to have quality tech. This is quality tech. $140 billion in cash, $75 billion in revenue fourth quarter, $300 billion a year. 30% return on equity, Nicole. This is a stock that if you're looking for one of the tech companies, and you know what? The thing is down only 2% this year with the market down about 4%. They've got an 86% global market share of the search category. And YouTube has got a 76% of the video showing category. So this is a stock, $140 billion in cash. YouTube, $35 billion. All of that flows to the bottom line. So this is one of those quality ones that you do want to pick up. Don't neglect Deere. Don't neglect ConocoPhillips. And I'm sorry that I got so caught up in toothpaste today for you. But you want to own this Google. They've got basically down 2.2% for the year, and this is a $1.86 trillion market cap that can continue to grow. This is one that has lots of advantages working in its favor right now, and they are a monster in terms of their cash position and in terms of their market dominance, and they're going to continue that.
Well, we are so thankful. I love when you talk about toothpaste. You have a great smile. You bring us some great ideas here that are actionable, that people can look at each one of them. And you can now come and have an interview on set when you're in New York. David, thank you so much. David Darst.
I can't wait. And you know I'm going to bring you an apple. You know that.
You always bring me an apple, and I love them. Thank you. Americana Partners, David Darst. Thank you. Later this hour. He's right, I do, I love the apples. We'll discuss the U.S. historic move to tap into the strategic petroleum reserves and what it means for the energy markets. And we have to take a look at advanced micro devices, why Barclays downgraded this stock, and a breakdown of Walgreens earnings, the beat, what we need to know as the shares are trading to the downside. And up next, we're joined by Charles Schwab's Chief Global Investment Strategist, Jeffrey Kleintop, to take a closer look at international markets and the odds of a recession. Stay with us.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes to
Oh,
wait.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see you. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back to the Watch List. I'm Nicole Petalides, live at the New York Stock Exchange. Let's take a look at the biggest movers in the market right now. Discount retailer Five Below was upgraded over at Citi. The analysts lifting their price target to a rating of a buy from neutral, with a price target up to 205 from 176. Citi says there is still very long runway for growth, fueled by highly productive and profitable store expansion. Check out Norwegian Cruise Line. A few stories circling here. The first is that it is climbing after announcing a collaboration with Huna Totem to develop a vessel docking facility in Alaska. The privately funded project will consist of a docking facility for Norwegian's 3 brands, a cruise ship terminal, and facilities for rail and bus access. Now, I should note, Norwegian, Royal Caribbean, and Carnival are all leading the S&P 500. This as the travel warning has now been lifted for COVID from the CDC, and that gave this group a boost. Morgan Stanley downgrading HP to underweight from equal weight. The firm is more cautious in the near term, saying PC demand data points are deteriorating. The analysts also cut HP's price target to $31 and $34. And here's a look at Walgreens. Walgreens is down about 5%. Did have an earnings beat, but the company said it saw growth across all of its categories, including a consistent demand for COVID-19 tests and vaccines. Now, Walgreens said it plans a strategic review of its UK-based boots business after rumors of exploring a possible sale. We'll discuss this more with our panel. And take a look at Bitcoin, as we do every single day. It's at 45,710, sold off earlier in the day around 10 a.m. and is down about 3.2%. It is our pleasure to bring in a very special guest, and that is Jeffrey Kleintop, Chief Global Investment Strategist of Charles Schwab. Jeffrey, great to see you. So glad you're able to be on with us. Thank you so much. Taking a look at so many different elements in the market. I'll start with the talk about the yield curve inversion. And it seems that everybody's saying it's not the 210s that we should be looking at. In fact, it's the 3-month 10 that we should be looking at. Would you agree, and what would you tell us?
I think we get down to this war of the yield curves. I like mine. No, I like mine. I think it misses the big point. The yield curve that investors should focus on is all of them, literally every spread between every treasury yield. I think looking at all the yield curves is important. Currently, only 8% of all U.S. Treasury yield curves are inverted. Now, in the past, that climbed over 50% before every past recession, meaning more than half of the yield curves were inverted ahead of recessions in the past. To me, that suggests the odds of a global recession are now probably above average. Usually it's somewhere around, usually we don't see any inversions. Usually it's around 0. So 8% is more than normal, but they're still relatively low, still below 50% here in the near term. I don't know why people focus so much on the 2 to 10 year. We know that the last 4 times the 2 to 10 year curve inverted, the S&P was up an average of 29% before it peaked 17 months later. So I think it is important to take a look at all of them and not just focus on one.
I think that was a good answer. I don't know that I've heard anybody say make sure you watch all of them. You're keeping us very busy. Tell me about the global picture and what we need to know, because we watch the European markets, right? First losing quarter in 2 years. We're wrapping up our quarter here at home. The traders are bustling around here as we get into the last hour of trading. What are we seeing here for the last quarter and going forward? What could be changing or different?
Well, one of the things I think is really interesting, given where we stand today, the last day of the quarter, is looking out into April. April has been a great month for international stocks. And if you take a look back over the last 9 or 10 years, April has always seen a gain in the EFI index, the International Index of Developed Markets. Haven't seen a loss, averaging 3%, by far the best month of the year. Now, that could be coincidence, but I think it's more tied to the earnings season. When we see where those numbers ramp up, it's just as we get into the earnings season. It's the first earnings season of the year where businesses really provide their outlook and their guidance for the year. And I think they've got some relatively good news. Despite the conflict, the war, we really haven't seen much in the way of downward revisions, even in Europe. Estimates for 2022 earnings are above where they were at the start of the year. That means we may hear good things from corporate leaders. Obviously, there's still a lot of uncertainty. I don't mean to dismiss that. But the confidence we may hear from business leaders that they are managing this environment and are sticking to their earnings targets could, again, bring back another, echo what we've seen in the past year with another positive April for investors.
We're getting the jobs report tomorrow. You're also watching PMI, right? I mean, 50 means expansion. Tell me these numbers, what you're watching for.
Yeah, so the jobs report, I mean, I think we're baked into some pretty significant rate hikes here, so that may be less important than it usually is. I'm watching the PMI report, which comes out tomorrow, the global PMI. So this is taking in all the major countries around the world and looking at their Purchasing Managers Index. This has been a really good indicator of where profits are headed. Again, I'm back to focus on earnings right now. I think that's really going to matter for the month ahead. And generally, this is a really good indicator. Usually 3 months ahead, you can see it in this chart, of analysts' forecasts for earnings. So the PMI tells you 3 months from now where analysts are going to be forecasting earnings. And it's actually about a year ahead of where earnings actually go. And so that key threshold of 50, when we're above 50, earnings are growing and the economy is growing. We're below 50, earnings are shrinking. We're pretty far away from that. And the preliminary readings for March on the PMI that we got from the US and Germany and France and Japan were pretty resilient despite the war. They only saw a small dip. So if that's confirmed tomorrow, Nicole, I think we could feel more confident about solid single-digit earnings growth this year, and that may bolster investors' confidence in an environment of uncertainty.
Yeah, just a quick thought on the word recessions that's been thrown around. I actually heard Liz Ann Saunders, I was listening to her on the radio, and she was saying, we got to dust off the recession playbook. What are we looking at? How worried are people truly about a recession?
Well, I think investors are becoming more concerned about it, although we can see stocks are not that far off of their highs for the year. Consumers don't seem to be concerned at all. I'm watching a lot of high-frequency economic data, everything from traffic patterns and buying gasoline and going to the movies and dining reservations and all these types of things, really not showing any pullback in activity, even in Europe, where the energy crisis is most acute and the proximity of the conflict is most intense. We're just not seeing a rollover yet. So investors are moderately concerned about recession, but consumers doesn't seem to have affected their behavior yet.
Right, and we have to see what the Fed does for a soft landing.
Yeah, that's for sure.
Jeffrey Kleintop, wonderful to see you. Thank you so much always. Thanks for being on with us. Jeffrey Kleintop, Chief Global Investment Strategist with Charles Schwab. Coming up next, let's take a closer look at crude oil, which has pulled back. We'll learn more about why it's so important now to tap into the reserves and what it could mean for gasoline prices going forward. Coming up.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave them thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Welcome back to the Watch List. I'm Nicole Petalides, live at the New York Stock Exchange on the corner of Wall Street and Broad Street. Now, the White House announcing plans to tap into the U.S. Strategic Petroleum Reserve. So I want to talk more about this with Bob Yager, Director of Futures Division, Mizuho Americas. Bob, thank you so much for being with us. So we quickly saw oil sell off. This is unprecedented. A million a day, could be as much as 180 million over the next 6 months. What are your thoughts on this? Is this a good move? Is this a Band-Aid like some of the others have been referred to?
It's a good move. It's a big number, so it had a nice impact out of the box here this morning. We were down at 7% at one point. We've drilled lower a little bit after Biden came on to talk about the issue. But in the meantime, we had rallied back by a good 3-4%. And I think that's going to ultimately be the nature of this issue. It's a headline type situation. Headline hits the tape, all the weaker specs bail on their position. You're down 7%, and the market starts to creep back higher. I think we'll have an impact by tomorrow, maybe into early next week. But this headline doesn't even kick in until May. The barrels don't even hit the market until May. So I have a feeling that this will be a slightly bearish development, more of a Band-Aid than a permanent solution.
And there it is. And somebody who's a pro in oil saying that. And so that's the concern, because everybody's paying so much at the pump, right? And it really is painful. And the president acknowledging that. The idea, the plan here is to be accompanied with a diplomatic push around the globe and working closely with the International Energy Agency to coordinate a global effort of reserves to be released. But that hasn't been decided yet. How important is that to go along with what we are doing here at home?
It helps, but this kind of game plan has not worked in the past. Of course, this one is not as big. This one is much bigger than the plans that we had in November and the one that we had at the beginning of the war in March. But they have basically been one-day phenomenon, headline sensitive, and the next day you move on to the next headline, and that's what dictates price direction. I mean, you're going to
talk about this.
We're going to add 1 million barrels a day.
Yeah. Can I jump in, because I want to know what you really think? I mean, it's very evident that people have said this is a Band-Aid. You've noticed that this round of reserves will be yet another Band-Aid, and that this is really not going to work, and this is really not the issue. So what needs to happen so that people can pay less at the pump and we won't be as strapped?
First of all, we have to replace 2.5 to 3 million barrels of crude oil. We're about a third of the way here now with this plan. But like I said, it doesn't kick in until May. We take a lot of barrels off the market with this Russian war. You just can't replace them. It's a lot of volume. You're going to get higher prices. There's just not. The market was already tight. EIA crude oil storage here in the United States is at a 3.5-year low. Distillate storage, that's heating oil storage, was at a 14-year low. So we're at really beaten down levels, and this is just not magically going to add a lot of barrels to the global flow. We're stuck with high prices here. We were at high prices before the war even started, and now we've supersized it because we've lost the Russian barrels.
Do you think that we retest highs on oil or move back in the upward direction?
I think that we start to drift higher. I think that we're not even close to the all-time high of $147, believe it or not. But $130 during this episode right now, I think we start to drive towards that level. It's just too many barrels off the market. At the same time, here in the United States, we're emerging from COVID. People want to drive. We've really not seen that many signs of demand destruction. Refiners are running the refinery at all-time highs because they want to make enough gasoline for summer, because they anticipate a lot of people driving, and that's going to bid the price even higher.
Yeah, Bob Yager, thank you so much of Mizuho. It's great to chat with you about this important topic today. Really appreciate it, and I think you really summarized those real big moves that we saw today, right? When you saw it down 7%, down 5%, but the big picture, and to your point, is that you believe it will continue to drift higher. More pain at the pump, folks. Bob Yager, thank you, Director of Futures Division of Mizuho Americas. Thanks for joining us. Still ahead in the second half of our show, let's take a look at shares of AMD. Why are these shares falling? Let's get some details that are really putting pressure on this name in the semiconductor realm. Michael Keeley's all over that. And take a look at some winners and losers in the S&P 500 on this last day of the month, last day of the quarter.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device. Welcome back to the Watch List. I'm Nicole Petalides, live at the New York Stock Exchange. Thanks for being with us. 90 minutes left in the trading session. We're expecting a very busy close. It's the end of the quarter, and you'll always see some high volume here. The S&P right now is down about 26 points at 4576, but could clock into another winning week. The Dow is down 242, 34,986. The Nasdaq's down more than 0.5% at 14,980, and the Russell small caps pulling back about 1/3%. We're watching Advanced Micro Devices, which has been under pressure. It's down about 8% for this week. Michael Keeley, contributor for the TD Ameritrade Network, is taking a close look at this name because Barclays comes out and is talking about several names, which had included AMD. Is this a PC boom and bust talk? What is this?
It has been, Nicole. That's exactly right. In tracking this development, we can point to analysts that already were of that opinion that there are hardware sales revisions to the downside that are likely forthcoming in this industry, and a lot of that is traced to the influences of analysts going out there and doing their channel checks with each of the companies themselves, and then those firms that these firms supply to. And so they've got a bit of a lead time on that typically, but this go round, it's been more clouded than ordinary with these, these ripples of an undercurrent that, hey, things might not be as strong as they appear on the surface from an earnings standpoint. And we have to admit, AMD has had an impressive run at earnings, including their most recent report where they pretty much blew every metric out of the water. And they had good things to say about the rest of this year. So the analysts are a bit out of consensus when you assume that, hey, this is a couple that are now downgrading and reducing price targets. That's not universal. The average price target for AMD sits at the present at about $150. Although you will often find that analysts do pile on top of some prominent news of other analysts that are changing their tunes, so to speak. And that is what's developing here. So Morgan Stanley also of that opinion with Eric Woodring that said, we've likely got multiple compression that's forthcoming, and these inventory levels are too high. They've been saying that for a while, but that does make one wonder, hey, all that pulled forward spending that firms did to supply data centers, to get the chips where they were needed, so to speak, looks like it might have been overkill with the inventories that a lot of these companies are now having in front of them. The analysts are saying, we don't think that the demand perspective is going to be quite so strong going into the future. But again, that's not an entirely consensus view. And you pointed out the drop in AMD shares. It was the biggest drop to the downside out of the entire S&P today to this point. However, not year to date, but over the last year, AMD shares are up over 35%. So, a correction in the midst of a longer term updraft.
Yeah. Yeah, and I was looking at HP, which actually is holding on, but Dell would be another name that would go into this. And Dell, in fact, is to the downside, also downgraded today. This one was downgraded, I see, over at Morgan Stanley. So you're on to something talking about this, because this group is coming under some pressure here. As I said, the PC boom, because everybody got one during the pandemic, at home, at work, work away, whatever, and now maybe a little bit of a pause. I won't call it a bust.
Although what's debatable, Nicole, is how much weakness we may see in the gaming segment, because that's another key contributor for this firm. And analysts really divided on that, with some analysts saying, hey, the gaming has peaked in terms of the last few years worth of resurgent growth in the pandemic. And then others that are saying, no, you wait. We're going to see more amplitude on gaming.
Well, gaming is another story. The gamers I know, I have to pull the remote controls out of their hands. They love it too much. Michael Keeley, good to see you, contributor, TD Ameritrade Network. Thank you, Michael. Now let's get right over to Jim Lowell, CIO at Advisor Investments, to have a conversation about all these economic data we've been getting in. A week that could clock in our third winning week, though we're under some pressure here. Your thoughts on the big picture, Jim?
I think the biggest picture, Nicole, is that the S&P 500 looks like it's going to end the first quarter down between 3 and 4%, as opposed to down 15, 20 plus %. This has been one of the most volatile periods in the marketplace, and I know investors' patience has worn very thin for all the known reasons: Russian aggression, China, COVID, inflationary pressures, increased talk of recession. There's a lot of things that investors are sort of weighing on their minds and that are weighing on their mind. So the fact that the stock market has clawed itself back to fairly close to the flat line, I think will be the lead story coming out of Q1.
I think that's a very good point you made, Jim. I don't think we focused on that enough, how, it's not as bad as it could have been. Because, after we finished January, people were like, oh, February would be better. And then February and March came and it wasn't much better, but it's better than it was or could have been. That being said, another positive point within your notes that grabbed my attention was about the consumer. How are they feeling overall? Because that's what drives GDP.
No question about it. Consumer sentiment, consumer confidence certainly plays a heavy hand in terms of consumer spending, and consumer spending drives our economy. Look, it's awfully hard to discount the U.S. consumer when the jobs market is as bullish as it is. In Q1 alone, we created 1.5 million new jobs. An employed consumer is awfully hard to bet against, and I'm not willing to do it despite all of the known issues that overhang that consumer. And I do think that the consumer sentiment has basically reflected the fact that the consumer is nervous, and rightly so, for all the known reasons. But I think we continue to see them be able to spend due to a very robust job market. For every job seeker out there, there are almost 2 jobs available to choose from. So this is an absolute bull market for employees, those seeking new jobs, more interesting jobs, better paying jobs. That's a consumer that's going to spend, not rein in their horns.
Right. We have don't fight the Fed, don't fight the tape, and you're saying don't fight the jobs data, that there's plenty of jobs out there, and that's why people are, taking 2 jobs, or they have the churn, they quit, and they go find a different job. So that's an interesting point, Jim. I do want to get to the approach to investing. I see you say cash reserves for defense and offensive plays and the tactical bond approach. Tell me what you're advising investors, big picture. For equities, for bonds, what should a portfolio look like here now and maybe towards the end of the year?
So in one word, for all markets, it's quality. We don't think this is a time to try and go down to the weak kittens in the litter and hope they claw their way up and over and above the high quality names in any capitalization range, in any marketplace. We'd like battleship, balance sheet, blue chip, U.S., mega cap multinationals. We like foreign multinationals so long as they derive the lion's share of their revenue from the U.S. or from China, from major players, i.e. not within their own fold. On the bond question, The Bloomberg Aggregate Bond Index is likely going to be down lower than the S&P 500 for Q1. That'll be a rude awakening for many investors who just assume that bonds do not go down. They can, in fact, go down, but they still play, we think, an essential role in terms of ballast for the overall portfolio. Without bonds in the mix, awfully easy for a stock portfolio to turn turtle. And then cash reserves, as you mentioned, both for defense and offense. This is a marketplace that we think is going to continue to hand us both. And we do think that for individual investors, perhaps dollar cost averaging their way into this marketplace over the next 6 months makes more sense than trying to time some sort of major lump sum investment.
Right, and as far as these large caps that you're looking at, the multinationals, again, you're looking for quality. I'd love to know about your exposure overseas, internationally, China. Any quick thoughts on that?
So China remains a conundrum for a range of issues. Long term, we think China makes sense. Near term, they've just taken a turn to, rather than inflicting their own markets with self-inflicted wounds, to try and heal it and their economy. That's a net positive. We do think that the global economy is fractured, but the duopoly between U.S., China, the two world superpowers, two world super economies, is likely to be able to ride through whatever near-term volatility we see.
Right. Thank you so much, Jim Lowell. It's great to talk to you, CIO of Advisor Investments. A good conversation, and I appreciate you taking a look at all the elements here in the markets at this point. And I like what you said about, look, it could have been so much worse as we wrap up this first quarter. Thank you, Jim. Nice to see you.
Thank you.
Still ahead, I'm ready to discuss Walgreens. Walgreens Boots Alliance. But is the Boots part getting ready to be spun off? The company just had its quarterly report. Stock's down 5%. We have an expert panel to explain.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy. Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more intraday movers to keep on your radar. Citigroup reiterated its buy rating on shares of Disney, saying there are still pandemic headwinds at play. The analysts noted that Disney's first quarter parks, experiences, and products revenue exceeded last year by 6%, with EBIT rising 14% year over year. But they believe these segments have not yet fully recovered from the pandemic, which could lead to further upside. Mizuho upgraded APA Corporation to buy from neutral with a raised price target to $56 a share. The analyst increased his long-term oil price forecast to $70 a barrel from $61, while his 2022 through 2025 estimates are up $16 a barrel on average. He said this was driven by an increase in estimated U.S. unconventional oil volume, and thus resulting in an increase in capital intensity. APA shares are higher today. And Carlyle Group is also higher after signing a new advisory deal with Fortitude Reinsurance. According to officials, this deal is set to boost fee-paying assets by $50 billion. Carlyle also raised roughly $2 billion for Fortitude from the reinsurer's existing investors and will commit up to $150 million from its balance sheet towards the total. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Pedalides.
Jenny Horn, thank you so much for that report. Welcome back to the watch list, live from the New York Stock Exchange as we're getting ready for the closing bell. I want to take a look here at Walgreens Boots Alliance. The stock has been to the downside. It released its earnings this morning, but you can see that it is on a downtrend. Let's have our analysts talk about this one. Brian Tanquilut is with us, healthcare equity analyst at Jefferies, and Chris Atkins, president, capital finance and capital markets at C2FO. Thank you both for being with us. As I comb through the notes, you have some similar comments and some that are different from each other. So Chris, I'll start with you. You're obviously, everybody's watching the COVID numbers, and that certainly provided some support. But going forward, you have concerns about inflation and wages. Chris?
Yeah, absolutely. Thank you for having me, Nicole. So I think what investors are seeing here is that the beat on earnings came from cost control and the ability to increase prices by Walgreens, which allowed them to stay ahead of the inflation curve and allowed the ability for consumers to pay up a bit to keep ahead of that. I think you'll continue to see reasonable earnings out of Walgreens Boots, but I think where investors are more concerned is the COVID tailwinds. Are those ending, and are the inflation, supply chain, and other pressures, labor pressures, going to catch up with them?
And thank you for that. Also, Brian, I wanted to ask your thoughts on COVID and whether or not that's really going to keep them afloat, because this is one of the things Chris was discussing. But also, what you noted was a lot about the strategy shift and moving more into healthcare and Village MD and care-centrics and some, but that the execution risk is real. Tell me, Brian, your thoughts.
Yeah, no, thanks for having me, Nicole. So first, just on the COVID side, right? So if you look at the earnings beat this quarter, the bulk of the beat came from COVID. And as Chris mentioned, that is going to taper off, whether it's vaccinations or COVID testing, right? So there's that concern. Now, as we think about the other factor here with the weakness in the stock today is that they beat the quarter, and yet they did not raise guidance for the year. So and they called out reinvestments in the business, specifically in the healthcare side of things, as you mentioned. So as I look at Village MD, it is a money-losing business today, and they incurred, a big chunk of losses there that I think will carry over into the back half of the year. And as they build more of these Village MD locations, they're planning to build 200 clinics a year. They will run up more losses going forward. So it will be a drag on earnings as they implement this strategy of expanding further in healthcare.
Yeah, and that's why you said you have a hold rating at this time, because there is some execution risk. So hold over at Jefferies. Chris, I wanted to ask your thoughts here as they're continuing to this expansion. They certainly have stiff competition from the likes of CVS. They also, is there still any litigation that could hit this company for opioids? They say they already paid it all off. Your thoughts, Chris?
Yeah, for sure. I mean, obviously they're fighting a multi-front battle. I think where the tailwinds from COVID will become headwinds is when you look at the labor shortages, inflation. The consumer is starting to get caught up with, right? It's because you had a lot of free money from the government that then is tapering off, and now inflation is back. And so I think that's really, when you look at retail, that's the big danger. And so one of the things here at C2FO, we interact with the supply chain of folks like Walgreens and other very large retailers, where we're trying to help them, their supply chain get ahead of these headwinds, because it really went from tailwind to headwind, and you've got to stay ahead of that. And the way to do that is through a working capital marketplace like C2FO, where you can control your cash flow a bit.
Yeah. Let me turn your attention to another topic, and that is what's going on in the UK with Boots. Brian, I don't know if you have thoughts on this one. First of all, I just got used to saying Walgreens Boots Alliance, right? Square, I got to call Block. Facebook, I have to call Meta. Google, I have to call Alphabet. And Walgreens, I had to call Walgreens Boots Alliance. And now it might not be Walgreens Boots Alliance anymore. So, Brian?
Yeah, just Nicole on that one, right? So obviously there's a lot of buzz around the sale process going on for the Boots asset in the UK. Look, I mean, I think on one hand, strategically, investors would like a streamlining of the business, especially given the volatility we've seen out of that Boots segment, right? So I think a US-only Walgreens business will be viewed positively by the investor base. Now, the flip side of this, though, is if you sell Boots, say, for $8 billion or whatever the number might be, the question is capital redeployment. And, you know, I think that with investments that the company is making in places like VillageMD or CareCentrix, and these businesses are dragging, right? I mean, they're presenting earnings drags to the company. Investors are asking the question, are these guys at Walgreens good stewards of capital? Are they good deployers of capital? So in thinking about redeploying the proceeds from the potential Boots sale, there is that big overhang or question mark on, will they be able to redeploy that profitably to where it is accretive, you know, where the sale of Boots is accretive to the equity value. So I think that is a big question mark. It's a concern, obviously. And so until we see or hear from them what they want to do with all the cash proceeds from a sale of that company, you know, I think that this is kind of a wait and see kind of stock for now.
Yeah, I think you guys hit all the hot topics that we are thinking about when it comes to Walgreens after the quarter and now the future of this great company. So much to discuss going forward. Thank you both, Brian and Chris. I appreciate it. Brian Tanquilut of Jefferies and Chris Atkins, thank you of C2FO. We appreciate it. And thank you, friends, for being with us here on the Watch List every single weekday at 2 p.m. Eastern Time, live from the New York Stock Exchange. I see you at 11 and 2. Thank you for joining me here. We're getting ready for a very busy close. It's the end of the month, end of the quarter. Traders are looking for imbalances as we speak. So they'll be hustling and bustling around here. But keep it right here because Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
After the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Good afternoon and welcome to Market on Close. Stocks are down a little bit here. They've pretty much been under pressure throughout much of the session. Some follow through to yesterday's weakness puts the big bullish rip that we had on hold for a moment. Still got time left in the day though, and still have a big important day tomorrow with the employment report in the morning. And we've also got PMIs and a check-in on the economy in many different forms. So it's going to be a busy Friday. But right now it's a little bit up in the air on who's going to win the week. Started off strong and then fizzled out here as we do get some pressure, but bears haven't been able to really drag the market too far here in the session, despite trying. There's been some dip buying, but a lot of early strength in the Russell faded, so that small cap index still having a lot of trouble with 2100. NASDAQ, though, pretty firm, holding 15,000 still. S&P down 0.5%, so just a bit of a breather being taken here for a second day in a row. Not a lot of deep downside in the indexes. There are a few very notable moves, though, especially in tech. This morning, we discussed analyst notes out on AMD, HPQ, and Dell, all those with cautionary notes from analysts, and it shows as tech is under some pressure and chip makers are getting hit here today. So with all that, though, there's enough offsetting force in some of the reopened trades. Airlines are doing okay. Cruise lines are having a great session. So there is some stuff working here. Some of the retail is doing all right, okay, as well. But for the most part, red across the board. Energy stocks are doing all right despite the big drop in crude oil, as we are going to release 1 million barrels a day from the reserves. WTI doesn't like it. No surprise there. More supply comes online. Crude goes down. In terms of the Russia story and the latest in Ukraine, the president does make us wonder really about that headline from earlier in the week about Russia drawing down forces around Kiev. President Biden saying that there's not a lot of clear evidence of that just yet. So words versus actions. I say we stick with actions. Let's look for the empirical evidence that there's something really changing. But WTI still down is notable. Dollars up too. So we do have some firming of the greenback right at that 98 level. That's the one box that didn't get checked out of the 4 that I listed last week for bulls to get the all clear. Pretty much got everything else they were looking for in terms of technical price action, strength in Apple, strength in Tesla, and a higher high in the NASDAQ compared to last month. But we still haven't seen that dollar really retreat just yet. So that's important because as it does hold firm, I think we need to keep in mind that there is still a major policy regime shift happening. That's what originally put the market under pressure. And we're going to get a fresh thought process update tomorrow on the Fed's hiking path when we see that employment report. If wages come in warm or if the number is as good as last week's jobless claims, then clearly we are locked in. And more of the major Wall Street banks are pointing to a 50 basis point hike and then another 50 basis point hike after it. So May could be that double hike. We've also heard Fed speakers this week generally coalesce their language around 50 basis points too. So that is going to be a big test if we actually see that priced into Fed funds futures and we see the market rally despite it. That is massive if we can make new highs in this market while the sell side and the Fed and traders are all agreeing on some sharp interest rate hikes. That would be really impressive. I mean, it's already been impressive, 17% since Powell announced the first hike. So it doesn't seem like the market's got too much of an issue with the Fed's path at this point. But still, we are off those highs. And technically, if we pull back, all of this could very much fit within the downtrend. Let's look at the chart of chip makers as an example. AMD down 7% today after a very rare bearish note on the stock. Generally, analysts always love this thing. So to see a note actually wax cautious and particularly point out the growth story as being a little bit overdone for AMD. It's a longtime favorite, so down 7% is very notable. And chips do give another example of a lot of recent strength. Nice big bounce here up off the lows, but still below the previous high, and then obviously off the big high up top. So really important group, the heartbeat of the tech sector, under some pressure now about 2 days in a row. It's not a big decline, but it's a notable decline, especially when you consider what some of the language was around the note also on HPQ and Dell, with an analyst saying that Barclays analyst saying that there's really some trouble here going forward for demand in the tech hardware space, and revenue growth that from the COVID era is just going to be impossible to match. So those stocks down as well. Problem is AMD, NVIDIA, and all the big names still sell into those stocks. And HPQ had just made a new high this week. And so reversing and dropping a lot of this language combining today, I think, is an important reminder that it's not just that we're dealing with interest rate hikes sucking out valuations, but we're also dealing with real growth prospects for these companies that, as good as they may be, they just are not going to live up to what they were during COVID. It's impossible that they're going to live up to what they did during COVID when we had such a huge push forward of demand. That's the growth rate. Still could be a big market to go, but you're really seeing analysts capitulate a little bit from the bullish side and those targets getting taken down, acknowledging it's going to be a tough road ahead for companies like AMD and others that benefited from the big tech adoption during COVID. All right, that being said, what's working today? Anti-beta, BTAL fund, doing pretty solid, 0.75%. Value stocks doing a little bit better than growth. Dividend payers generally holding on more on volatile days. Bitcoin's not working. Gold's having an okay session. But generally, when we do get weakness on days like today, it pretty much matches the blueprint that we've been using for the whole year, which is underperformance of growth relative to value, outperformance of dividend, and then outperformance of the anti-beta fund versus the high beta fund. Last few days here on the show, you might recall I was talking about SPHB, the high beta fund, which is what you want to own if you think stocks are going up. If you think we're going to go sideways, or we're going to go down, or we're just going to have rotation that favors companies that have not been those big momentum trades, then BTAL, the anti-beta fund, is a pretty good way to express that view. On the year, it's up 4%. So it's keeping up with the S&P dividend fund, SPYD here that I've got, just to give an example of where we are on some of these main factors and themes in 2022. Dividends up 4%, anti-beta up 4%, value is flat, only down 11 bips, and then growth, SPYG, down 8%. So for the most part, we are seeing more of the same, with that weakness on days like today showing up most in tech, and actually a pretty good performance from some reopening trades. Royal Caribbean is rocking and rolling today. Tom's got a trade on that we're going to check out in the options corner. And the airlines are solid too. Earlier this week, we talked about host hotels breaking out and the resorts and travel hospitality stocks doing pretty well. Royal Caribbean chart is looking pretty nice right now. Looks a lot better than the AMD chart if you're looking for potential for strength. Really, you've only got a couple bucks potentially for Royal. It's already gotten above this big trading range that kind of served as some equilibrium around 80 bucks. So we're cruising through that, no pun intended, pretty easily. So if we clear 88, 86 bucks, it could be smooth sailing for Royal. Pun definitely intended that time. All right, let's talk some more stocks with our guests. We got a busy show here and a lot of good guests joining us. Tammy Tintra begins our conversation, founder and CEO at Family Financial. Tammy, welcome to Market on Close. Thanks for joining us.
Thanks, Oliver. Glad to be here.
It's been a really great 2 weeks for bulls, and they found their legs right after Jay Powell hiked. So does that mean the boogeyman of interest rates is not as scary, or should we give it a few more days to percolate?
Well, I think in general, there's a consensus that rates will escalate a little bit higher than expected. And, you know, I think as long as there are those expectations set in the market, the trajectory seems to be less volatile. But you never know. There's always something that can happen. The market doesn't like surprises. So I think he's doing a good job of navigating the rate environment. But I guess we'll see tomorrow.
How do we assess right now what is short-term surprise and what's long-term and what's trend? I mean, kind of the same question in a different way, but it seems like a lot of this weakness started before Russia invaded Ukraine, before China had this big COVID breakout. So how does that inform our stock picking or our investment process?
Well, as far as I'm concerned, I see them as buying opportunities. I mean, there's certainly some headwinds in the market, as there will always be. And yes, inflation is something that we're grappling with, but where borrowing rates have been so low, we've got to figure out how to control inflation. And so if the market can just be slow and steady, we'll win the race. If there are surprises that come out that we don't know, I see that as a buying opportunity.
Some stocks that you like are in the big cap classic winners category from the last couple of years. Apple, Amazon, Zoom, you're dipping into one of the worst performers as well. But I want to talk Apple first for a sec because it's got bigger bearing on the broad market. Tammy, what about this slowdown in the SE phone? Apparently, they're already cutting back some of the production, according to a few articles from the last couple of days.
Sure. Well, Apple's been a leader in hardware sales, and relative to their peers, their revenue is 26% above relative to profit margin. Their dividend growth is strong. They're projecting a 6 to 7% per year dividend increase, and their security has been steadily building in the hardware and operating systems. So I think as the world continues to move to a more secure digital platform, including payment systems like the blockchain, Apple devices are positioned as a leader in privacy and security.
Okay, the bread and butter, the phone, and though, does it show any potential overestimation by Apple on how much of the market they need to have? Do they need to have the low end and the high end? It seems like the SE is not quite hitting the way they expected.
I don't think that will have a tremendous impact on their trajectory. We are positive on Apple and in the long run, so we're not really focused on that.
Okay, let's talk some Zoom. It's been the dog of the post-COVID, if we call it that, era. What changes? How does it turn around? What needs to happen for the stock?
Well, Zoom is still a market leader in the video conferencing by a wide margin. It's synonymous. It's become a household name. I'll Zoom you. Net profit margins of 33%. The PE ratio 20% below the tech sector make it an attractive buy at the $120 price point. They did grow their revenue by 55% in 2021. So I think it's normal to see that leveling out and prices coming down, but we definitely like it.
What about the competition for Zoom? It seemed like they had a nice mousetrap that people clung to pretty quickly. I don't know how I didn't even realize that Google Meets had become so smooth, and I discovered that about 3 months ago. I haven't used Zoom since. Aren't there going to be a bunch more people like me?
I don't know. I mean, if you use Zoom and you use the other ones, I mean, Zoom just is a superior product. So yeah, I'm sure that there will, anytime there's something that is a leader in the market, that breeds competition. So I think it's better for the overall space. But at the price levels right now where Zoom is, we're definitely positive on it.
Do they need to do some kind of a deal? They tried to do a deal, didn't work out with the Ring. They've talked about doing their own phone. That seems to have kind of fizzled. Do they need to have an ace up the sleeve, though, beyond just what we already know them for?
I think it's always hard when you're a new company that's just gone public trying to determine which markets that you want to expand into. They're doing what they're doing very well. And I think they just need to be cautious into what lines of business they expand into.
Okay, Zoom down about 2.5% today after a little bounce here off the lows. Tammy, thanks for the thoughts here. Appreciate you getting us started.
Thank you.
Sure thing. Tammy Trent, founder and CEO at Family Financial, sticking with Apple, Amazon, and trying for a comeback in Zoom. All right, let's take another look at another group that was a big winner. It's also come under pressure, and actually relative to the rest of the market in the last couple of weeks of this rally, the home builders haven't done jack squat. Let's talk about the group. Ed Cofrancesco joins us, CEO at International Assets Advisory. Ed, the home builders can't seem to keep the big rally going despite how much we hear about a lack of supply. The mortgage rate apparently is becoming a pretty big problem for them. What's going on here?
Well, we think that the mortgage problem is not as big as some people anticipated.
Okay.
Quite frankly, a lot of these home builders' greatest growth over the last few years has been in the Sun Belt. People moving from the Northeast and other places like that, coming to where taxes are lower, cost of living is lower. And I have to tell you, our firsthand experience, people on the field, on the ground, a lot of people buying from these home builders, not financing, they're paying cash. So they may not have been as going up as much as we would like during this rally, but we still like the home builders. Yes, as interest rates rise, it will definitely cool off the real estate market, but the greater trend of people moving from expensive and high tax areas to warmer and low tax areas continues. And I have to tell you, our firm is based in Florida, and the growth here in Florida, people come on vacation and no longer leave, it seems.
That is correct. I was at a wedding in the Bahamas, which is a pretty quick trip from Florida. It was basically all people from Fort Lauderdale, Palm Springs, or Miami. And I will say, I think, I'm not going to name names of who was there, but they've got some pretty nice properties, and they were all selling. Every single person I talked to, they had just such big price gains. They were either selling, buying a different place because they wanted to be next to the ocean instead of the lake, or they're closing out a home that they had in Brickell or apartment to finally get a bigger one in Miami because the sales were just so powerful. How does that massive price increase, though, change the outlook here for housing? I mean, how do we keep up the house prices that were the highest since, what, 07?
I mean, nationwide, is there a bubble? Yeah, probably. There's probably a bubble. But I always remind people, residential housing is much more micro market than a macro market. When Florida crashed in that 07-08 period, particularly in Orlando and Fort Myers and Tampa, those were our three biggest areas that crashed. We crashed over 50%. The same was true in Greater Phoenix, Las Vegas. But nationwide, we crashed. But within a year, New York, who had only went down 10%, was back up. And so it took years for Florida to come back. It took years for the Valley of the Sun in Arizona to come back. It took years for Vegas to come back. Different markets. Every market is micro. Yes, they're macro trends, national trends, higher interest rates that have an effect. But this is very much being driven by the great relocation, the great redistribution of our population centers here in the United States. So we may see the markets cooling off in certain places, but I don't think the bubble is going to burst anywhere near as big as it did 14 years ago.
So do you want to own these stocks at this juncture? I mean, we're making new lows today for just about all of them. New 52-week lows. Wow, KBH after earnings last week just keeps selling. Pulte ticks down today with a big sell-off, down 5%. Pretty ugly charts. Is this dip buying territory, or should we let them settle?
We think we're close to really being in the dip buying territory. Again, these are not going to be 10-year plays or 5-year plays. We're looking for trading opportunities, something that'll work for the next 6 months, 8 months, 9 months. And that's what we believe that we have. Now, we're not going to go out and tell you this is something to put in your portfolio, forget about it, and hold up until you retire. But we do think there's opportunities here at the home builders.
Mortgage rates, I'm looking at a chart from Freddie Mac right now, the 30-year fixed mortgage interest rate, the percent change in that metric from 4 weeks prior, up 24%. That's just in March. So since March began, up 24%. It's the biggest 4-week increase in history, according to Freddie Mac's data. Do we need to see bonds or something different change then to cue that comeback? What happens if we stay at these elevated levels? Is this a call that depends on something in the bond market?
Absolutely not. We think that, again, that so much of the retracement that we've seen in these home builders downward has been caused by people looking at rising interest rates and expecting it to have a huge impact. It's having an impact, but it's not having a huge impact. So we think that as they start reporting more and more numbers down the road, you're going to see that there's sales. They just still cannot build houses fast enough in the Sun Belt. Houses, you can't buy spec homes. It's not well you buy spec. Can't. Spec homes are bought as soon as the ground is broken on them. It's crazy.
Yeah, no, I've heard.
We think that, I think this is something that you're going to continue to see. We expect to continue to see throughout the summer. People who have a reason to move actually need to move now before interest rates go higher. And again, so many people that are buying are cash buyers. Plus, we have so many institutions. I'm going to tell you again, in Florida, some of the largest buyers of homes have been institutions no less than Blackstone. Blackstone has been the single largest buyer of homes in the greater Orlando area for the last several years. So I don't think that the interest rate environment is going to stop them from buying homes.
Okay. Ed, thanks for the take here. Like the contrarian trade, looking for a bounce back in a group under pressure right now. Appreciate it, Ed. Thanks a lot.
Cheers.
Ed Cofrancesco is the CEO at International Assets Advisory. Mortgage rates on the 30-year up 24% this month. Biggest in a month-long period ever, according to Freddie Mac. And the stock's making lows as we speak. Kind of seems to me like we need something to happen for bonds, but maybe a trade that is overdue for a bounce, according to our guest, Ed. All right, so far we've got persistent bulls in Zoom, in home builders. At least for Apple, it's somewhere close to a high, but there's a lot of persistent bullish appetite, it seems, at least from our guests. Okay, let's come back and talk about that yield curve. We've got the father of the yield curve analysis. Well, everybody thinks they're a father or uncle or grandfather of yield curve analysis, according to what I've seen on Twitter. But we got the real deal up next. Campbell Harvey from Duke joins us. Don't miss it.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
90 minutes after the dust settles from the opening bell, Trading 360 brings you Wall Street's best traders, analysts, and technicians to give you a 360-degree perspective on markets. We focus on the hottest stocks driving market headlines and spotlight disruptive companies and new technologies exciting today's investors. Watch Trading 360 with Nicole Petalides weekdays at 11 a.m. Eastern on the TD Ameritrade Network.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Let's talk some yield curve. Now that we got the stock picks out of the way, back to everyone's favorite subject of this past week. It's bonds. Joining us, Mr. Campbell Harvey from Duke University and possibly the father of the yield curve analysis. Everyone thinks they're an expert on it now. Campbell, maybe you've got some competition, maybe not. Professor of Finance at the Fuqua School of Business at Duke. Thanks for being here, Campbell. Appreciate it.
Great to be on the show.
Okay, so give us the straight facts here. Remind us firstly what your study showed when you first looked at the yield curve and found that recessionary indication.
Yeah, so my study is actually my dissertation at the University of Chicago, and that goes back to 1986, so a long time ago. And what I found was that the slope of the yield curve was very useful for forecasting economic growth. And when you got that strange situation where the long-term yield was lower than the short-term yield, that's called a yield curve inversion, that happened to precede the recessions in my sample. There weren't that many recessions in my data, but the dissertation was accepted. And then after I published the dissertation, we've had 4 recessions, each one preceded by a yield curve inversion. So 8 recessions, 8 yield curve inversions, and no false signals yet. I'm sorry.
Yeah, the 10-year 3-month is the one we're looking at right now. That's the one you use, right, Campbell?
Yeah, so in my dissertation, I looked at a long-term rate and a very short-term rate, so 3-month. And that's a choice that came out of the economic theory in my dissertation. Of course, there's many different ways to construct the yield curve. So there's different maturities that you can look at. For example, a popular one this day is the 10-year minus 2 years. But in my dissertation, it is 10-year minus 3 months. And again, that has inverted 8 times before the previous 8 recessions.
So what is the main difference you found then? We'll get to now next, but then what was the reasoning behind the 10 to 3 month instead of the 10 to 2 or 30 to 5 or something else?
Yeah, so the whole idea here is that the interest rate is really interesting because it's got 3 components. One is expected inflation. The other is the expected real interest rate. And then there's also a risk premium built in. That risk premium is fairly small for U.S. Treasuries. But that real interest rate tells us something about economic growth, real economic growth. So if you're looking to forecast, let's say, the next year or 2 years, you want to look at a short-term interest rate and then pair that with a longer-term interest rate. So it's really important to have the short-term information. And even though in the media, there's a lot of attention paid to the inversion of the 10-year minus 2 year, we do not have an inversion of the 10-year minus 3 months.
Yeah, the opposite. We're sitting at the highs. I mean, this is pretty wild stuff that there's such a difference. I mean, every curve is basically flat except for this one. What do you think it means, Campbell? Highs for the 10-year to 3-month, lows and inversion for the 10s to 2s.
Yeah. So this is what I think, that there is some hiking coming that's well expected. So a number of Fed hikes that will disproportionately impact the short-term rate. So what we're seeing right now is likely temporary. And I expect, looking at the 10-year minus 3 month, that we will see significant flattening when we have the next hikes. So I think it's reasonable to expect that the short end is going to follow kind of like the 10-year minus 2 year and flatten out. Will it invert? I don't know. However, and this is really important, any flattening is bad news. So you don't need to invert. A flat yield curve means very slow growth.
Right.
So it might be that we dodge a bullet, we have the soft landing, but it means slower growth.
So what's so interesting here, the spread being very important, the slope, to your point, being very important, even if it doesn't invert, flattening could mean slowing. But there's also an element of nominal value, right, where we held rates at 0 for so long that the 90-day rate is coming off of 0 as opposed to even the 5-year or any other duration has a little bit more to subtract, to pull out from the 10s. So the 10s to 2s a little bit flatter because the 2 is higher than the 3-month. What role is that playing, and how does that kind of fit into the overall environment we've been in? I mean, is there something here that's uniquely happening about coming off the lower bound, or maybe it's throwing the 10s to 2s off but keeping the shorter term suggesting a little bit of strength? How does that fit in, Campbell? The actual level, the nominal value of that 90-day rate?
Yeah, so this is basically a result of Fed manipulation of the yield curve. This is all the Fed. So as I said, it's expected that the Fed is going to have 6 or 7 additional hikes. Those will impact disproportionately the short end of the curve, and we'll just see it follow. So I fully expect a flattening. So maybe what we're seeing with the 10-year minus 2 year is just a preview of what's going to happen over the next number of months. And again, any flattening is bad news.
Yeah, okay. So it's, right now, if they're going to hike, that 90 days is going to keep going up. But the 10-year particularly, the implication that if I could editorialize would be that your view, if this is going to follow the 10s to the 2s, then it probably comes from the 10s going down further because the 10's been going up with the 90-day, and that's the problem right now why this hasn't gotten flat. And the 90-day will keep going up if they're going to hike, right?
Yeah, that's the thing. That the 90 days got a lot of room to go up with these hikes.
Yeah.
So right now it's like 0.5%. So if we have like 4 hikes, that takes it, like hugely up, and we get a significant flattening. So I think that again, what we're seeing is a preview of a flattening from the 10-year to the 3-month.
Maybe this is the market not believing that he's going to pull the lever that many times or something like that. Okay, very interesting stuff. Yeah, because it's priced in, right?
Yeah, no, I doubt it. Yeah, the market, I think, has figured this out. And look, the policy, the Fed policy, it's basically designed to slow the economy. So we've got 7.9% inflation, and you hike rates to slow things down. So it's not unreasonable to think that the yield curve, all the way along, from 10 years to 3 months, will flatten over the next number of months. And that is indicating slower economic growth. Whether we have a hard landing, I don't know. I don't see that right now in the yield curve, which is good news. But the implication overall is that we're heading to slower economic growth.
Okay. A great conversation. Thanks, Campbell, for clearing it up for us, as always. Appreciate you being here again. Thanks a lot.
Thank you.
All right, and a reminder, by the way, the last time we had this conversation on the inversion, it didn't look like we had imminent risk, but we got the recession anyway, so it worked. Maybe because of COVID, but it still worked. Spooky stuff in markets. Okay. Thanks again to Mr. Harvey, Professor of Finance at Fuqua School of Business at Duke University. Let's talk about that Royal Caribbean trade next. Tom's joining us for some options on Texas Instruments, Baidu, and then RCL, which is up 3.5% right now.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our portfolio management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
All right, Let's talk some options trades with Tom, standing by in the TD Ameritrade newsroom with a few picks for us on what he saw in today's action. Royal Caribbean, it seems like you spotted some call buyers, Tom, but you didn't tell me until I got out of my position earlier.
Yeah, and stocks continue to move higher. Royal Caribbean up 4%, but you're also seeing gains in Carnival Cruise Lines and Norwegian. Also, Royal Caribbean up 10% so far this month, and for the year now it's positive. So outperforming the overall market. Wells Fargo came out with a note a couple days ago, positive on Royal Caribbean, price target of $93. Industry leading technology. They're expanding their fleet by 33%, 40% pricing premium. So the demand is there, right? We're seeing it across the board. CDC just dropped their warning about COVID risk on cruise ships. So it's got people excited about this particular sector. You can see that rebound so far in the latter stages of March in there. And call buyers were out in force, not only in RCL, but also in Carnival and Norwegian. A lot of call buyers there also. But one that stuck out to me today is in June 90 strike calls. Trader bought 5,000 of those for a debit of about $4.30. That takes that break even to $94.30 over the next 78 days. It's about 10% above the current share price in here. And with that rise that we've seen in the stock price, implied volatility has fallen very sharply. So you're paying less of a premium for these, but you still need a move of about 10% above the current share price for this stock to be or for this option position to be profitable. Question for you, Oliver, is have you been on a cruise, and do you want to go on a cruise?
No, I just thought it would be a good way to hedge my overall short equity position, because I have the most optimism that these are companies that maybe have been overly punished. It seems like all the tech stuff is looking at peaking growth, but the reopen trades to me seem like they still have some potential for surprise. I mean, it seems like the big problem we've got is that people are not putting their money back into some of the COVID services and entertainment and tech stuff. It seems to me like they're putting their money in groceries and then possibly travel if they can get it. So if there's one group that might see some spending despite inflation, I mean, the prices are very high. There's a lot of demand for people to go back out. There were tons of cruises when I was at the beach this past weekend. You could see them everywhere. So I don't know, it just seemed like a good trade to be in. But again, I got out earlier. So I guess now we watch to see how this trader does.
Yeah, but remember, if you looked at some of the earnings that we had this week, and RH is a perfect example, high-end furniture, right? They're seeing a pullback in the amount of sales that they have because people aren't buying things for their homes anymore. They want experiences, and the people that are flush with cash are going towards travel and experiences at this point. Right. And I think that's why you're seeing the surge in the last few weeks in a lot of these stocks. And it's not only the cruise lines, it's the travel companies and it's the airlines that have rebounded pretty significantly over the last several weeks.
I've also found that they're a pretty good oil proxy. So trading USO is really expensive right now. Vol's pumped up. The energy stocks are pretty pumped up. So if one had a view on a pullback in crude, they could express it through a long position in these. They've been pretty inversely related. So I think that component of it as well was appealing over the last couple of days too. So, all right, crude oil down, RCL up. We'll see if it's more than a day or so, because if they keep rallying this stock, it's going to start to clear some really interesting hurdles on the chart. Same with airlines too. Now back basically at a level that they were at for much of last year. So the whole reopen trade at an interesting juncture. And Tom, you've got another bullish trade in Texas Instruments, despite the sell-off in chips today and a 1% drop in Texas.
Yeah, and you have to wonder if it's under pressure a little bit from that AMD downgrade.
Think so.
The outlook for some of the chip names, and are they at the late end of a pretty good cycle? Shares are almost flat this year, just barely negative, but it's rallied 10% this month from 52-week lows that we saw in February of about $161 a share. And if you wonder if the aggressive spending that they noted on their last earnings call might be impeding maybe potential growth. And I mentioned that AMD downgrade, some of the chip names getting hurt today on the back of that. But I think somebody taking a more conservative bullish stance here as far as unusual option activity. Traders sold 10,000 June 160 strike puts that are far below $25 out of the money to the downside, but you've got 78 days till expiration, so it's duration. They sold 10,000 of these puts for that neutral to bullish stance for a credit of $2.67. That break even of 157.33 to the downside is about 15% below the current share price. So giving themselves a nice cushion in case we see some additional volatility and maybe another pullback in the markets towards those February lows. But put volume is about 3 times normal daily average volume in here today. But somebody selling puts to take a bullish view.
All right, so selling some downside and hoping this thing doesn't totally fall apart. Hey, Tom, real quick, 30-second drill because we are out of time. But Baidu's down 7%. The trade you saw here, something bearish. Is it put buying, call selling?
Buying puts in here. The SEC coming down on some of these companies. They provided an update status on the Holdings Foreign Companies
Delisting
Accountable
risk.
Act. Possibly delisting, right? You're seeing BABA down, JD.com down also on this. But they were in there buying puts in the June cycle, I think, or April 8th weeklies. I'm sorry. 8 days till expiration. They expire next Friday. They were buying the 130 strike puts. They bought about 12,000 of those earlier on in the session. They paid a debit of $325 for those. So that break even of $226.75 to the downside, that's about 5.5% below the current share price. On this, put volume is about double what we normally see. But remember, these stocks about 2 weeks ago got a big bump that said that because China and Beijing came out and vows to keep the market stable for their overseas listed stocks. But this is kind of pushing back against that report.
Yeah, major yellow, possibly red flag here after the fade. I mean, right in line with the recent downtrend. That's a really long-term chart for Baidu, but if you pull it up and look at it in the past couple of weeks, it's, I mean, pulling back right where you'd expect on the chart. Could get ugly. All right, thanks, Tom. Good stuff. So some optimism in the Royal Caribbean trade, but a little bit of a fade here in Baidu. All right, when we come back, let's talk some Bitcoin. Going to check in with our regular guest, Mr. Bob Iacchino, who apparently bailed on his Bitcoin position, and he told Ben, not me.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
I'm Maria Schrader. Here are a few stories to watch this hour. Macy's announced it will open a new fulfillment center in China Grove, North Carolina in 2024 as part of its strategy to meet e-commerce demand. When fully operational, the 1.4 million square foot facility is expected to make up almost 30% of Macy's digital supply capacity. Macy's will spend $584 million on the project. Argus called International Paper a well-run company with a strong track record that will see high demand for its products and services after the pandemic. The firm notes North America earnings show higher selling prices for corrugated boxes and container board, with sales volume for both staying stable. Argus has a buy rating on International Paper. And UBS initiated coverage of Western Union with a neutral rating and $19 price target, calling it a fairly valued money transfer leader. As the market for digital payments expands and more competitors enter, the analyst says digital pricing will remain a key factor in determining market share. UBS also notes Western Union's exposure to Russia and Ukraine is a risk to its performance. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Welcome back to Market on Close. We always like to keep track of our guest position, the traders who join us regularly and are kind enough to give us some insight. Last week, Path Trading Partners Bob Iacchino dropped this little bomb on Mr. Ben Lichtenstein.
What's interesting, and I think Oliver's going to be mad that I'm telling you this because we talk about Bitcoin a lot. I sold out of everything yesterday. I sold out of every last cryptocurrency that I own. I would rather buy Bitcoin up at 70,000 again in smaller quantities when that sort of overhang is out of the way, when that cloud is cleared, than keep it where we have it right now and watch it go down 20, 30,000. So I no longer hold cryptocurrencies. Again, I think I will probably hold them again, but the regulatory picture needs to shake out.
Okay, so Bob, my only question is, you couldn't wait for me? Were you saving it for a birthday gift?
I'm actually upset with myself, Oliver, but you take too much time off.
Okay.
I just can't wait for you. I'm always at the desk. You're always at a beach, at a casino. I don't know where to find you anymore.
Hey, yeah, you do. You found me in a casino one time. All right. So, Bob, how come and how are you feeling about it as it stalls out here around 48,000?
I mean, I feel fine about it. I'm almost not watching it. You and I have talked about this before, where when I'm out of a position, I'm out of it. I try not to pay too much attention to it. I am planning on getting back into Bitcoin, but it seems to be a little bit longer of a journey than I can really do looking at it day to day. Part of the reason I don't look at something day to day once I exit it is because either I'm going to watch it go up and be mad that I exited, or watch it go down and think I'm smart. And I didn't exit it because I think I'm smart. I exited it because
maybe a little bit.
We do everything. No, I'm no smarter than anybody here. Everything we do is based on risk. Okay, everything. And the risk to Bitcoin for me, going into four figures, into the 9,000, 8,000 range, right now is too high.
Wow.
Nothing affects an active trader's psychology like losing gains.
Okay, where's that coming from, Bob? What in particular? Because even though you are very disciplined, it seems, at least from what you tell us and the way you've traded Bitcoin, you've outlined to us that you do like buying on breakouts, something that I think makes a ton of sense for BTC in particular. Even a mega cynic like myself said the breakout from 20K back in 2020 was a clear buying opportunity. So I like that thought process you have about rather owning it higher up, because that's kind of how this thing works. But you generally still didn't ever really want to just dump all your holdings. So what changed here?
What changed was Russia, Ukraine, and the way the West handled Russia. Now, this is not me taking a position on that at all. That's not what it is. But even today, the EU passed anti-privacy legislation specifically aimed at crypto. A couple of weeks ago, we had President Biden talk about needing to work with some of the giants in the industry to properly regulate it. And then a week later, the EU basically says anything €1,000 or up has to be reported, regardless if there's any evidence of insidious behavior or not. It just has to be reported. Even a bank, you can get $9,000 cash out and they don't have to report it. So it seems targeted to me. And this is what bothers me. There's never been a time in my career, and again, I'm not taking a stance on this, but there's never been a time in my career where I can remember a certain segment of the global population or the global powers just basically turning the money off for another major power. Maybe not. That the EU Parliament had passed it. Coinbase is against it. CoinDesk, the media service that I follow the most on crypto, is against it. All the industry leaders say it's going to stifle innovation. Is stifling innovation good for this asset class? No.
Sure.
So I need this all to shake out. And I told Carolyn last week, I'd rather buy it at 80,000 or 75,000 than continue to hold it here. And I think she thought I was nuts, but it goes to the point of where everything we do is risk-based. So if I have 2 Bitcoin at 40,000 or 1 Bitcoin at 80,000, it's the same amount of risk to zero. So I'd rather make less and have less at risk.
Sure.
And just kind of lay comfortably in with my 200 and some odd percent gains, 300% gains almost that I had on the prior position.
Very interesting. All right. A bit of irony here. As many expected this conflict and the sanctions to bolster the case for crypto, but really what it did is just put it even more directly in the crosshairs, right? Put it front and center. Yeah, okay. All right, thanks, Bob. Love the analysis, the update, the appreciation for a momentum asset to wait for it to break out. Bob Iacchino, founder, chief strategist, Path Trading Partners. Thanks, Bob. Always appreciate the transparency from our guests and how they're thinking about things, especially when it comes to a big change like that. All right, when we get back, let's talk some more about how the inflation and the response by the Fed informs stock picking in a growth portfolio. Apple's so close to those highs, but the broad market's slowing down a little bit today as chip makers in particular pulled back. But there is still some reopening strength out there. Maybe some concert goers, cruise lines, and airlines could work. We'll be right back with another stock picking guest.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, They're made by them. Thinkorswim by TD Ameritrade.
Okay, we got some time until the bell. Let's talk some more stock picks as the NASDAQ makes lows of the session. Some selling pressure here, day two, but not doing too much to reverse the last 2 weeks of straight up gains led by Apple and some of the classic giants. Still in the good graces of Jim Gullen, portfolio manager, William Blair's large cap growth fund. So you're sticking with Microsoft, Alphabet, some of the big ones, Jim?
Yeah, absolutely, Oliver. Nice seeing you again. Yeah, I mean, these companies are really tied to a really powerful secular trend, which is the shift to the cloud. And even though we've gone through some turbulence over the past few months, these trends are still in place. And we saw really strong numbers in the fourth quarter with Azure growing over 40%. You look at Amazon with Amazon Web Services growing 40%, Google with Google Cloud growing over 40%. And this is still early in the process. I know I've been talking about this for a couple of years now, but these companies are very well positioned in terms of the shift to the cloud. Also, a company like Accenture, integrator, a consultant that's helping companies do this shift, is well positioned. And the stock has pulled back this year a bit due to a variety of reasons, but we really like the long-term outlook for all these companies.
Right now, Apple's real close. Alphabet, too, had a nice little run, but still kind of making this trend of lower highs. Microsoft, though, is the one I'm particularly interested in, as it's struggling here above $300, just a tad today. We've seen these cloud companies purchased for like a decade because of their growth, and that's the hang-up for me, Jim, is even as they continue to create this market and dominate this market, Microsoft, do they ever see the growth that they did? Because these were stocks that people bought that growth for. I guess Microsoft also has got the earnings, obviously. It's not like a smaller cloud play that might have some major problems if its growth slows. But does that still factor into this company at all when it's going to be hard to beat that COVID cloud adoption?
Yeah, now the growth is still there because, again, as I said, the cloud is still early. If you look at the number of workloads that have actually transitioned to the cloud from corporate enterprises, it's probably around 20-25% of workloads. And we think ultimately that gets to about 65 to 70%.
Wow.
And then the other factor you have to think about is as you shift to the cloud, it gets a lot easier to create new workloads, new applications, just given the speed and agility that you get versus being in the on-premise data center where it may take months to spin up a new application. So we're still very early in the process. We think we still have a good 5+ years of growth for all these cloud companies. And again, these companies are well positioned in terms of taking advantage of that growth.
Jim, the workload...
And they also have earnings and cash flow.
Sure, oh, absolutely.
Some of these companies that have gotten walloped over